Good morning. It is 9 a.m. on Thursday, February 10th. This is Yahoo Finance Live. I'm Julie Hyman. That's Brian Sazi. He's down at the Nasdaq today. We're up at the Nasdaq, I suppose, depending on where you are. The heat is on. That's the big headline in the morning. Consumer prices rise at the fastest pace since 1982, up 7.5% year over year. Core, that is excluding food and energy, up 6% year over year, and both of them rising about 0.6% month over month. We'll break down where those pressures were coming from in just a moment. Let's also talk about the effect on the markets here this morning. We are seeing futures take a hit on the back of these numbers, the Nasdaq in particular, as we have seen this acute sensitivity to interest rate expectations in large cap technology. That is playing out once again this morning, with Nasdaq futures off 1 2/3% and S&P futures off 1%, Dow futures off about 0.4%, and of course the 10-year as well, because that is where the equity markets are taking their cues this morning. A surge in 10-year yields up to 1.9798%, bouncing around a little bit there as we are seeing expectations ratcheted up quite a bit in Fed funds futures markets. What's being priced in for what the Fed is going to do at its March meeting? Perhaps a higher likelihood of a 50 basis point increase. We'll talk about that as well. And there's a lot of evidence of the rising prices being seen in all of the earnings reports. Here's one example. Pepsi CFO Hugh Johnston is going to join us shortly to talk about how much Mountain Dew and Doritos are going to set you back in the coming year. Plus, Mattel CEO Ynon Kreiz will join Saz to chat that company's numbers. Mattel shares are surging 8% after it said sales will rise as much as 10% this year. Plus, Disney's comeback, streaming and parks beating estimates. The shares up 6%, and we'll get to that in a moment. But first, more details on these CPI numbers. Brian Chung is with us right now to talk to us about them. And we talked about the big increases year over year. On a month over month basis, we're talking about a 0.6% increase here. Brian, break down the numbers for us.
Yeah, well, the numbers breaking about a half hour ago, so let's unpack on a month over month basis. Prices rising in the United States across the board by 0.6%. On a month over month basis. If you index it over a year over year period, 7.5% was the growth that we had seen in the report. That is well above the street's estimates of 7.3% and continues to ratchet up the already high reading that we had gotten of 7% covering the previously reported month of December. Now, on a core basis, even when you strip out those more volatile components of food and energy, you still get a 6% year over year increase in the core figure. But what's more unnerving about this report beyond just the headline number are kind of the components that underlie it when you take a look at specific parts of the CPI as reported. Used cars and trucks. This is something where a number of economists that had hoped inflation would fade later this year would see more of a decline in the price changes. Instead, what we saw was a 1.5% increase still between December and January. Airline fares still up 2.3%. Owner's equivalent rent, which is a much stickier component when you consider people getting locked into leases and mortgages in a hot housing market, that up by 0.4%. Not all categories increased, though. Take a look at some of the travel-related expenditures that actually declined, perhaps because of the Omicron variant. Hotels and motels down 4.2%. This is, by the way, on a month-over-month basis. And then cars and truck rentals down 7%. So there's something for everyone in this report, but overall the story very much remains the same. Broad-based categories increasing in prices over the course of December and January, which definitely spells a little bit of an interesting conundrum for the Federal Reserve as they continue to weigh how fast they want to tighten policy. But again, the big headline coming out of the BLS this morning, the highest year-over-year increase since 1982. By the way, guys, that was when Physical by Olivia Newton-John was topping the Billboard charts. So it's been quite some time since then.
Something good that happened in 1982, definitely. Brian, what this means effectively is that the wage gains that Americans have been seeing are more than erased. In other words, that average hourly earnings, that adjusted average hourly earnings number really stuck out to me, down 1.7%. It's a smaller decline than in December, but still, Americans are effectively taking a pay cut because of this inflation.
Absolutely. And I do want to caveat that by saying that, anytime you look at an aggregate figure, right, the lived experience is going to be different depending on what community and what specific household that you're looking at, because just because you're in an area where you're seeing higher price wage increases doesn't necessarily mean that's the same place or same geography of the country where you're also going to see, any sort of price increases at the store. But what we're seeing is that at an aggregate level, yes, it is indeed part of the picture that if you're taking the wage gains that we see as reported by the monthly numbers in the employment report, and then you subtract it by the amount of inflation, which is very high on a year-over-year basis, you're probably not making out as good as you're seeing in terms of the nominal amount of increase on your paychecks on a biweekly or monthly basis. So this is indeed affecting Americans, and that's a big reason why this has become such a big political issue. I mean, inflation that clocks in at 2 or 3% usually isn't something to become the kind of cornerstone of a presidential speech, but we've seen Joe Biden talk very frequently lately, anytime he has the podium, about the impact of inflation on Americans. That's because this is becoming a huge, and already is becoming a huge political issue for him. Now, of course, all eyes are not just on the White House and Congress where they engineer fiscal policy, but on the Federal Reserve as well, where the extraordinary monetary stimulus has obviously led to some sort of demand push that is leading to inflation that is not fading as fast as Federal Reserve officials had originally hoped or messaged in the beginning of 2021. That's going to be a very interesting story as we get to that mid-March meeting where the Fed is expected to start raising rates. Whether or not the 7.5% print maybe nudges them towards a more aggressive 50 basis point hike, which, by the way, we haven't seen since 2000, remains to be seen.
Yeah, and there's a lot of talk about the Fed being behind the ball because of all of this. So we're going to talk more about that in the next hour and weave it into all of our conversations throughout this hour as well. Thank you so much, Brian Cheung. And speaking of one of those conversations, we've gotten a lot of earnings reports. We talked about a lot of them yesterday, Saz, where companies are raising prices, right? Chipotle, the Yum Brands portfolio brands. And then we've got plenty more evidence of all of this today, right? We had Pepsi and Coca-Cola reporting their numbers. Unilever talking about that its profitability is not going to return to 2021 levels for 2 years because of cost pressures. Kellogg. So there's a lot of companies on the list here where we are seeing real world specific examples of what those macro numbers are showing.
Yeah, Julia, look at this graph here. All big name companies, products by and large, many of us consume each day, if not each week. And what you are seeing right now in corporate America is them trying to push through another tsunami of price hikes because they themselves are seeing a good bit of commodities inflation, labor inflation, transportation inflation. These themes from last year, they didn't go away because the calendar changed. They have continued into this year. And I think a lot of companies in last December, they tested some price increases. They worked out okay. So they're coming into this year pushing through more price increases. I spent some time on the Pepsico earnings call this morning, and they were talking about potentially pushing through more price increases this year to protect their profit margins. So if you're a consumer, and we all are, get ready. Get your wallet ready because these price increases are coming. And Julie, anecdotally, I was in the aisles of Target the other day trying to pick up some deodorant. I picked up the usual container I buy. That was $13 a pop. I put it back on the shelf. I traded down to something that was $7. It was too high for me.
Well, so the trade down effect, we have been hearing from analysts really over the past month or so that was not happening. If that is starting to happen, that might indeed be the peak. And there are a lot of economists who are saying this month, January, was going to be perhaps the peak in the rate of inflation increases, that we should get a slowdown in those increases since after this point. One of the key determinants of that is going to be, are consumers at some point going to rebel? What is going to be the sign of that rebellion? Exactly what you did.
Well, where do you rebel to?
Choose a different product based on price.
There's nowhere you could go. All of these products are going up in price. And by and large, I think why the market has stayed so optimistic here on corporate earnings and sales is look what Chipotle CFO Jack Hartung told us yesterday. He basically said we can charge whatever we want and people are still buying our products. He has not seen any resistance to these price increases. And until they see resistance from consumers, a lot of these big companies are going to push through price hikes to try to protect their profits.
Well, you're the first line. You're the first sign of that resistance, perhaps. Not with burritos. But with deodorant.
I am wearing deodorant. I am wearing deodorant. I can confirm.
Just a cheaper one. Okay. I'm sure it works just as well, Brian. All right. We got to talk about...
No comment.
We got to talk about Disney here this morning as well, because speaking of price increases, This is another company where we saw some price increases at its parks, for example, and also other ways for the company to make money at its parks. We'll dig into that in just a moment. But first of all, the headline numbers, as we see the shares rise 6%. Earnings per share pretty much blowing away estimates here. $1.06 is what Disney reported. 57 cents was the estimate. Revenue also coming in ahead of estimates. And then if you break down what that revenue came from, parks seeing a comeback here, both in revenue and also importantly in operating income, and also, of course, the media and entertainment distribution and that part of the business doing well. Disney Plus subscribers up 11.8 million, which was well above the around 8 million that analysts were estimating. And so now the total subscribers just under 130 million. So that's part of the story. And then to go back to the parks for just a moment here, the parks operating income was $2.45 billion. You see the revenue there, over $7 billion. The actual park attendance, I thought this was really interesting, Stas, was lower than in 2019, but people are spending more. And as someone who went to a Disney park last year, can tell you, that was me. They introduced this whole Genie Plus. They introduced more lightning lanes. In other words, they introduced more ways to separate you from your money when you are in those Disney parks. And considering how good they are at that already, it is quite a feat. And that is paying off when it comes to that operating income number.
Yeah, I think for a lot of families, Julia, you're at that point where you have to weigh, do I want to buy a new car for my family or go spend 3 or 4 days at Disney? Because the price hikes, just based on what a lot of these Disney blogs are saying out there at the hotels, for drinks, rides, they have gone through the roof. So a lot of inflation also helping the parks business, which I think a lot of analysts on the street forgot that they existed here. The business swung to a $2.5 billion operating profit, $119 million loss last year, part because of these price hikes. Bob Chapek on the earnings call last night talking about how that momentum in attendance appears to have continued into this year, despite that inflation, despite it being costing more to visit various Disney parks. Also, let me just follow up too. Earlier in the week, we previewed Disney Plus. Disney Plus on the street, analysts were looking for 7 million net ads in Disney Plus in the quarter. They came out 11.8 million. That is a big, big beat. And they also talked about last night, they are not backing off their expectations for when this streaming platform could hit profitability in 2024.
And let's talk about also the sort of streaming strategy, if you will. The company repeating the growth in streaming is not going to be linear. And they're also sort of seemingly figuring out what the streaming release strategy looks like versus the theater release strategy, right? And deciding that some films are worth releasing in the theaters and some are not. So we're seeing that sort of learning process in real time. The Marvel movies, for example, it looks like that those are going to be released in theaters first. Bob Chapek on the call saying Doctor Strange, the next Doctor Strange installment, is going to go to theaters in summer. Encanto, which you're looking at right now, was a huge hit for Disney. And also, we don't talk about Bruno, which we have talked about on the show before, a huge hit for the company and for Lin-Manuel Miranda, who wrote the music for that musical, if you will, that cartoon musical. And so, it's interesting watching that strategy be formed in real time. We're going to talk more about this with an analyst a little bit later on. One more quick note, and that's about Bob Chapek. This is the first quarter of a Bob Chapek not under Bob Iger, right? Iger stepped down at the end of last year as executive chairman. Chapek now rounding out 2 years at the helm of the company. So it's interesting as he continues to put his stamp on it, what these numbers look like, Sas.
Yeah, no, it's a very good point, Joe. I'll also add, too, I was listening to their earnings call, and if you're one of those apes out there holding AMC shares, you should be terrified by this Disney Plus number and their content rollout plan. The fact they might be dumping more content on Disney Plus to meet their profitability goals and their efforts to reach about 260 million new subscribers or net subscribers on Disney Plus by 2024, that means you will probably be going to the movies list.
Yeah, good point. All right, we are going to take a quick break. When we come back, we're going to continue this inflation discussion, this earnings discussion, all of the points meeting today. We'll talk to Pepsico CFO and Vice Chairman Hugh Johnston after the break.
almost time for the Pepsi Super Bowl halftime show with artists from my generation, such as Dr. Dre, Snoop Dogg, and Eminem, and Mary J. Blige taking center stage. But first, there are earnings from the company paying for the sizzling big game show. PepsiCo is out with better than expected sales and profits for the fourth quarter, despite being hit by inflation. The company sees organic sales rising 6% this year, with core earnings up 8%. Joining us now is PepsiCo Vice Chairman and CFO Hugh Johnston. Hugh, always good to see you. Look, I was just on the call briefly. The earnings call just wrapped, and you talked about you want to protect profit margins this year in this high inflationary environment. What does that mean? Does that mean you're going to have to take more price increases?
Yeah, good morning. Great to be with you all as well. Yeah, obviously, look, the whole world is quite inflationary right now. I mean, everyone's talking about it in the media, and obviously consumers are talking about it as well. When we deal with inflation, the first thing we actually look at is how can we drive productivity? How can we make our company more efficient? And as a result of doing some of those moves, we don't have to take as much pricing as we otherwise would. Well, with levels of inflation and commodities as high as they are right now, we clearly are going to have to take some pricing. Now, we've been investing heavily in our brands. We've been investing heavily in product innovation. And because the world is a bit of a stressful place, the simple pleasures that our products give people, I think they're generally finding they're worth paying a few pennies more for. So, yeah, you'll see pricing up a bit. We right now are in a place where we should be able to keep our margins pretty well intact for the year. And as we get to the fourth quarter, we'll see if we have to take a little bit more pricing or not. We'll react to the facts in terms of what the prices of commodities are at that time.
Is this the type of inflationary environment, Hugh, where you have to break that glass and try to push through 10% price increases this year overall for the year?
Yeah, it'll likely be high single digits, and it remains to be seen. Based on the inflation that we know of right now, and as you know, we tend to buy commodities out about 9 months. We've got our pricing in place for that. For the fourth quarter, we don't buy out to the fourth quarter until a bit later in the year. Once we have some visibility into that, we'll decide what the next round of pricing looks like, if any. But based on what we see right now, yeah, it's going to be high single digits to 10%. And that is very much a function of the input costs going up as much as they are.
Hugh, I know you saw the overall CPI number that we just talked about for January rising 7.5%. I also mentioned that most economists think we are at least going to see a deceleration from here, hopefully, that rate of increase will start to go down. Is that your view as well, that even though some level of increase is going to be sustained, it'll hopefully be a little smaller as the year goes on?
It's a great question, and it's one that's always hard to estimate. Obviously, there's economists out there with a wide variety of forecasts. What we do is we build scenario plans around various levels of inflation and then say, okay, if this were to happen, what would we do? The fact is, it is so hard to predict, and that's exactly why we buy commodities ahead by about 9 months, because at least it gives us certainty in terms of the input costs that we have. And to the degree that we have to take more pricing, we can do it in a thoughtful way. We don't have to react sort of in the moment. So candidly, hard to guess whether inflation will come down in the second quarter, third quarter, fourth quarter. Candidly, supply chains are tight right now, so it remains to be seen.
You know, amidst this backdrop of inflation, Hugh, lost in the sauce is your sales are still growing. Now, in the beverage business, quarter over quarter, your sales actually accelerated. What is going on with consumers? How are you seeing them spend differently now compared to a couple months ago?
Well, the good news in the beverage business is two things. Number one, we're ubiquitous. We basically exist everywhere. If you're in home, we obviously have products in the large format stores that people tend to take home. If you're out of the home, we are all over the convenience stores and vending channels and the like. If you're going to a restaurant, we've got pretty good market share in restaurants. So what we see as much as anything is, and this sort of occurred at the earlier part of the pandemic, there was really a return of consumers to the big brands. And I think part of that was driven by supply chain. We were available more than perhaps a lot of the smaller ones were. But as those consumers came back, I think they discovered that they like the variety that we provide. They like our ingredients list. They like the product innovation that we've done. And as a result, they've come back and they've stayed. So we're seeing sort of continued demand increases from consumers across all channels because of the fact that they really appreciate the strong brands and they appreciate the product innovation that we've been able to create for them.
Hugh, ahead of the Super Bowl, it reminds me to ask what the mix looks like in terms of at-home consumption versus out in the world consumption, and what trends you guys are seeing right now.
Yeah, both are actually continuing to grow pretty strongly. This notion of the home as the hub, where it's both a place to live and to some degree for many people a place to work, is a notion that I think is continuing and is likely to continue. I think that that's permanent change that we've seen. The restaurant business and what we call food service business is growing about 30%. And so that piece has come back quite strongly. And then even the convenience store businesses, which sort of gets to a different angle on away from home, growing close to double digits. So we see really across the board behavior toward more consumption of our products. The mix is going to change a little bit based on obviously, how much people are out versus being in their homes. But I think, what we're likely to see is good growth regardless of where consumers go.
Hugh, Brian Sozzi is very excited about some kind of Mountain Dew alcohol hybrid. How big is the opportunity for you guys in alcoholic drinks, and what can consumers expect?
It's a great question, and we have a terrific collaboration with the Boston Beer Company to leverage our brand, the Mountain Dew brand, and their expertise in producing low alcohol products. And frankly, I'm excited about it. I'm optimistic about it. This is our first foray into this area, so I think we're going to learn as we go. I don't really know how big it can be yet. The second piece of it for us is we are building a distribution capability so that we can actually bring these products to market. So, we basically get the product from the Boston Beer Company. They produce the product, and then we put it on our trucks and we bring it out to the marketplace. That's a separate but perhaps interesting growth opportunity that we're going to learn about over time. The market is obviously quite huge. How successful we're going to be in it remains to be seen.
Okay, lastly, Hugh, really quickly, Super Bowl pick, and who are you most excited about in that halftime show?
I'm excited about all the performers, so I couldn't be happier about the halftime show. More than anything, I'm rooting for a good game. So we have a lot of Rams fans and we have a lot of Bengals fans who like our products, and we love them all. So I'm not going to make a prediction on the game. I'm just rooting for a great game.
That is a very diplomatic answer. I like it. Hugh Johnston, good to catch up with you. Pepsico CFO and Vice Chairman. Thanks, Hugh. Appreciate it. And coming up next, full-on earnings madness today, as we have been watching, not to mention what is happening on the inflation front. We'll talk about numbers from the likes of Uber, Sonos, Twitter, Coca-Cola. They're all coming up. Welcome back to Yahoo Finance Live. We are watching futures this morning that are indicating a lower open, and that's after we got that big CPI print, Brian Sozzi, 7.5% increase in prices year over year. And now traders are trying to figure out, what does that mean for the Fed? Does that mean now the Fed could raise 50 basis points? I'm seeing a lot of chatter this morning that because they haven't sort of telegraphed it yet, that it's not so certain, that there would need to be some Fed speak to that effect before they would make such a move.
I have a tremendous respect for the CPI, Julie. But again, we just had Hugh Johnson on over at PepsiCo telling us prices this year might have to go up, at least from their standpoint, 10%. Given the cost increases, that's significant. That is huge. And Pepsi's not alone.
Yeah, no, definitely not. We're hearing from a lot of other companies throughout this earnings season that are talking about raising prices this year. And there is also a lot of commentary around all of this that the Fed is behind the ball. So a lot of concern about what all of this is going to mean for the economy. We are seeing some curve flattening happen this morning. What does that mean? Basically, the spread between the 2-year and 10-year Treasury note is narrowing, and that implies concern about economic growth as well. So we're watching all of this very carefully as we see futures indicate that lower open, and we take the opening bell on this Thursday morning. And there you've got the NYSE and Nasdaq opening bells this morning. By the way, the CEO of Black Rifle Coffee Company is going to be on later in the show in the 11 to 1 program. Let's talk about some individual movers that we are watching this morning, even as we see the futures pull back. That Nasdaq still showing the yesterday move upward, likely to see a similar magnitude move downward here this morning on the back of CPI. There you have it, off by 1.8%. As we mentioned earlier, it's really big cap tech that has been so vulnerable to changes in interest rate expectations, to changes in inflation expectations, and that is the case once again today. When it comes to individual movers, though, it's a little bit of a different picture, Brian Sozzi. Let's talk about Twitter, first of all. What's interesting about Twitter is it reported its earnings this morning. The numbers weren't that fantastic, but it did announce a stock buyback, and so that helps matters sometimes. The shares are up 3.5% right now, but they had been bouncing around this morning and were higher at one point. There is a $4 billion stock buyback authorization they announced. You can see earnings beating by a penny, revenue missing just slightly, and the company also talking about daily active users, average daily active users, up 6 million in the fourth quarter. 217 million is the total now, and that's up 13% from a year earlier. It looks like the read on this quarter for Twitter is that it wasn't hit too hard by some of the tracking changes that Apple put in place. And so there was a little bit of relief being expressed in the shares early on. That seemingly has melted away, though.
You read enough of these earnings reports, Julia, like you and I do, and you pick up on certain things. One thing I picked up on here, and this is a tone of what we also heard from Snap when they reported last week, you get the sense Twitter is dealing with these Apple iOS challenges. Twitter is doing it pretty well. Ditto Snap. Now, you and I, we spent some time with Facebook's CFO, and my takeaway from that was that they're still battling. Facebook is still very much in the middle of trying to overcome these challenges with these new privacy issues, whereas Snap and Twitter, for whatever reason, maybe it's because they're smaller, more targeted, more focused companies, they're able to overcome these things a lot better. And then secondarily, I do like that Twitter came out here and reaffirmed their 2023 goals. There was concern on the street if they can hit those goals, just given the competitive nature of the market, those Apple iOS changes. Twitter's saying they can hit 315 million daily active users by 2023, and they see $7.5 billion in sales plus by 2023. I suspect a lot of folks on the street were encouraged to see that, even if the stock price is not rising as a result.
A couple of other notes on the quarter. First of all, this was the first quarterly report overseen by the new CEO, Parag Agrawal, who was the CTO before Jack Dorsey unexpectedly resigned at the top of the company. And on the conference call, he said there was urgency to execute on the company's new strategy. Part of that strategy includes developing a new sort of ad product and ad platform. That's after Twitter had sold MoPub, which was its prior ad product platform. That caused a little bit of a hit in the quarter, and the company is now talking about sort of recovering from that as it develops its new product. So it's sort of dealing with that as it's also dealing with these new tracking measurements because of the Apple changes as well. So both of those things keep in mind, new leadership here, and also some new ad products to keep an eye on when it comes to Twitter. I want to move to Uber. Because we're watching that stock as well here this morning. Uber shares up a little bit, about 1% here. Let's hit the highlights for Uber here. Overall, EBITDA at the company beating estimates for Uber. You can see they're at about $86 million. Gross bookings up 51% to just under $26 billion. And revenue there up 83% to $5.8 billion. So Uber, it looks like performing well sort of across its platforms, but delivery in particular. Monthly active platform users, that's of everything Uber does, a record $118 million. And there's a comment from Darakosh Rasahi, the CEO, in his statement that stood out to me on the mobility side of the business, that is the rideshare side of the business. He said, while the Omicron variant began to impact our business in late December, mobility is already starting to bounce back. And he said gross bookings were up 25% in the most recent week compared with a month earlier. So just as we have seen the case count start to come back down, businesses that are reliant on people getting out there have been doing a little bit better here, Saz.
Yeah, and generally, Julian, I'm fascinated by where the likes of Lyft, and we talked to co-founder John Zimmer yesterday, where Lyft and Uber are in their life cycles. Finally, these companies are being able to string together couple quarters of being adjusted operating profitable. That was not the case when they came to public markets a couple years ago. And keep in mind, those adjusted operating profits are coming despite the volatility in bookings here because of the pandemic. But both companies saying that they've seen trends or demand bounce back in the latter part of January. I would argue that Uber here, noting 25%, a 25% increase in bookings in the latter part of January, sounded a little bit stronger in terms of recovery than what we heard from Zimmer yesterday at Lyft.
Yeah, I think that's fair to say. As we see those shares move up, although they were sort of bouncing around a little bit as well. Finally, we want to talk about Sonos here this morning. The smart speaker maker up 5%, and that's after adjusted earnings per share beat estimates. $1.02 is what they reported. Revenue coming in, rising about 3% year over year, $664.5 million. That was ahead of estimates. And the company for the full year is raising the lower end of its revenue forecast a little bit, is now looking for revenue of $1.95 billion to $2 billion. The lower end of that had been $1.93 billion. And it looks like that they are raising the lower end of their EBITDA forecast as well, Saz. Sonos has really been a consistent executor here in this market.
You know, we always tease Sonos CEO Patrick Spence. He'll be on later on in the program to talk about results, about what is coming next. Please tell us. He remains very tight-lipped in terms of new products, and I understand that's his style, cool dude, totally get it. But he did, I think, send some very strong signals on that earnings call last night that Sonos has a couple new products coming this year. One might be in an existing category, so perhaps a new, some form of new upgraded speaker. Let's keep in mind, though, they have started to push into the car space, which is which could be a pretty big opportunity for Sonos. And there has been speculation recently of them getting into the headphones market. Whether any of those products will come to market this year in big form, to be determined.
And Spence, as you mentioned, coming up later, he'll be on at 12:15 today, and you can press him on that. I'm looking forward to hearing what he has to say. Before we go to break, I want to check on shares of Disney right now on the back of that company's better than estimated earnings report. The shares are up by nearly 6%. Coming up, we're going to dive into the company's latest quarter with an analyst who sees a strong road to recovery thanks to the company's strong franchises and loyal customer base. We'll be right back. Some relief for shareholders of Disney being expressed this morning. We're seeing the shares bid higher by about 5%, and that's after revenue and earnings came in ahead of estimates. And also importantly, a couple of other things went right for the company last quarter. Disney Plus subscribers rose by 11.8 million. That is more than estimated. And the company's parks income also coming in better than estimated. Let's talk more about these numbers right now. David Hager is joining us, Edward Jones, senior equity analyst. David, good morning. So what stood out to you as sort of the biggest surprise in these Disney numbers and biggest turnaround from what we saw last quarter?
Well, certainly, I think the biggest surprise was in the parks and experiences segment with very strong revenue and operating profit from that business. And in particular, I think here domestically in the U.S. parks, the results are really above where they were prior to the pandemic in the December 2019 quarter. So, certainly that we see as a positive sign for the future, as well as parks are still being operated at lower than full capacity. And, certainly the international parks are by no means at full capacity at this point. So that certainly gives us confidence in terms of the future profitability out of those operations.
But David, the theme of this morning is inflation. Red hot CPI report, numerous companies telling us they're coming out raising prices. Disney is among those companies. How concerned are you that Disney is trying to be just too aggressive with pricing at the parks, and that might hit consumer demand during the summer?
Well, certainly the company saw an impact from, they indicated about a 40% increase in per capita spending, or per person spending. Now they attributed a lot of that to spending on food and beverage and on the both Genie Plus and Lightning Lane capabilities, which helped drive that growth. There certainly seems to be a lot of pent-up demand, though, as we move away from the pandemic towards experiences and going on vacation again. And it certainly looks like the company is continuing to see strong interest in attending the parks. So, certainly the rising prices in the economy right now don't appear to be having an impact in terms of demand of visitors to the Disney parks.
I want to turn to streaming because it's been so interesting to me. A lot of Disney critics or those that were skeptical of the company's streaming strategy have pointed to the idea that they're going back to the well for their new content, right? They're relying on their existing franchises and just spinning them out as far as they can. But thus far, does this quarter prove that strategy is actually working?
Well, certainly the company's relied a lot on some of their traditional franchises, whether it be on the Star Wars front or with the Marvel series. But the company in total is spending $33 billion on content this year, and about that for sports rights and the rest of that for other types of programming. So, certainly one of the focuses going forward looks like it's going to be on more general interest content and expanding beyond those franchises that Disney has historically been relying on with Disney Plus, and trying to further expand the base, beyond that, the loyal followers that they've had so far, and continue to grow the interest amongst other viewers.
David, Disney Plus added 11.8 million subs in the quarter. Street was at about 7 million. If one is trading a company like a Netflix or a Disney, is the read there that Disney Plus is taking market share for Netflix, and that's why Netflix's quarter a couple of weeks ago, their outlook wasn't that great?
Well, I don't know that you can necessarily attribute Disney's strength to taking away share from Netflix. Most streaming subscribers are subscribing to more than one service, and I don't know that they necessarily view Disney Plus and Netflix to be interchangeable. And subscriber bases with Disney Plus perhaps being a little bit more family oriented and having the fan base around Marvel and Star Wars. But certainly in the streaming market, we feel like there's going to be room for multiple services, and certainly Netflix emerged early on as a leader and the disruptor in the streaming space. But we view Disney as being one of the few companies that have the breadth of content and the ability to.
It sounds like we're losing you,
David.
To
certainly give Netflix a run for the money. So
Dave,
do you still have me?
we're having a little bit of trouble with your audio, David, so we're going to leave it there. David Hagers, Edward Jones, Senior Equity Analyst. Apologies for that. And coming up next, we're going to continue our Disney conversation, expand it out with Mattel's CEO after the two companies just renewed a toy deal, plus earnings and Mattel's big plans for 2022. That's next.
Shares of Barbie maker Mattel are moving higher after better than expected earnings. A few things of note here. First, Mattel says its turnaround is over and it's now in growth mode. And two, the company released pretty compelling outlooks for 2022 and 2023. Let's dive on to this with Mattel Chairman and CEO Ynon Kreiz. Ynon, always good to see you. Thanks for taking some time this morning. Last year was a big year for toys for Mattel, but also the industry. Is there any indication that this may slow down a bit this year?
Well, Brian, this was another exceptional quarter and year for Mattel. We outpaced the industry and gained share globally for the second year in a row and in every measured market. We had the highest annual growth rate in decades, with growth in 6 of 7 categories where we operate. And in each of our power brands, Barbie, Hot Wheels, Fisher-Price, and American Girl. So we were not just riding the wave of the industry, we outpaced the industry and continue to grow. And we say the headline is that our turnaround is now complete and the company is in growth mode. The strength of the company is broad-based and we expect to continue to gain market share. And as you mentioned, with strong growth in 22 and 23 and are not stopping there.
Is part of the story, Ynon, on market share gains that So many families are spending more time in their homes and buying more toys.
Part of it is driven by COVID-related demand, but a lot of it is really about the strength and resilience of the toy industry. The industry has been growing for 10 consecutive years. It's expected to continue to grow for the next through 2025 by Euromonitor at over 5% CAGR and reach $100 billion in 2023. It's a strategic category for retailers. It's experiential. It drives foot traffic. The items are not expensive. And parents forever will spend money on children, especially when it comes to quality product and trusted brands. Play is here to stay. And we are leading the industry with momentum. Mattel was the #1 toy company in the fourth quarter. And we see demand for our product at levels we have not seen in years. And this is beyond COVID. We believe the industry will continue to grow. And within that environment, we will outpace the industry and grow even further.
Is this the year, though, Ynon, where toys go from accessible in terms of price points to expensive, just given everything we have been seeing here with inflation?
Well, inflation is a factor, clearly, and this is not unique, obviously, to the toy industry alone. We see it across the economy. But the items are still, relatively speaking, are accessible. And parents, as I said, will continue to prioritize investing in children, especially for product that help develop, inspire, and entertain. This is the language we speak. We invest heavily in design and development. We make sure that our product have cultural relevance and brand purpose that gives it value beyond the play system. And with that, we expect to continue to engage consumers and really talk to families, talk to parents, and be their partner in entertaining, developing, and inspiring their children.
Have you had to raise prices?
We did raise prices in the third quarter of last year, and it is one of the options we consider given these times of inflation. But when we raise prices, we always keep consumers in mind. We are being very thoughtful and are committed to maintaining the highest quality and the best value for consumers.
You pulled off quite the coup recently, Ynon, getting some business from your longtime rival Hasbro in that Disney Princess business. How did you do that?
Well, this was a great win for Mattel. Disney Princess and Frozen together are one of the crown jewels of the Walt Disney Company. Incredible wealth of characters and stories. And it is important for Mattel for three reasons. It scales our portfolio as the global leader in the dolls category. It adds another accretive growth driver, both for top line and profitability for us starting in 23. And also it strengthened our position as a partner of choice for the major entertainment companies. It was also symbolic in our own in our own transformation journey and a symbolic milestone. And we expect to grow it from the current levels, given our capabilities, expertise, and the fact that we know how to develop and grow evergreen franchises. So we're very excited about it. It's a meaningful win, and we expect to continue to grow from the current levels.
And Ynon, it does seem as though, just off this deal and staying on it, that Disney is placing a lot of confidence in Mattel and your leadership. A lot of these things were not in place before you arrived at the company. Do you see more opportunities to win more business from Disney over the next few years?
Well, we worked very hard to improve our capabilities, to strengthen the company, and to position ourselves for growth. You see it in the numbers, you see it in the momentum. We have been growing for 6 consecutive quarters and gaining share for 6 consecutive quarters. And this is following years of restructuring and strengthening the platform. We are positioning the company as a partner for all major entertainment companies. Given our scale, our capabilities, our global reach, the fact that we sell product in about 490,000 stores globally, this is a huge commercial network. And this is under 70% of our business because we also sell over 30% through e-commerce. So we have a very large commercial infrastructure, very strong supply chain system that is a competitive advantage, and obviously tremendous design and development capabilities that at the highest level. This is something we invest heavily in, and we're very excited to see how Disney is trusting us, and likewise other entertainment companies see Mattel as a partner of choice.
Well, it's good to see all your hard efforts there starting to pay off, or continuing to pay off, I should say. Well, I'll leave it there. Mattel Chairman and CEO Ynon Kreiz, always nice to get some time with you. We'll talk to you soon. All right, and before we head to break, let's take a look at Coca-Cola here. Shares are on the rise after the company reported better than expected sales, better than expected profits. Also came out saying they see organic sales up 7% to 8% this year. That is looking pretty strong, just given everything a lot of these big packaged food companies are seeing in terms of inflation. And we'll be right back.
Well, we're watching stocks that have been taking a hit after this morning's CPI report. That read coming in at 7.5% on the headline number year over year, 6% when you back out food and energy. Stocks coming off the lows a little bit of this session, but one move that we do want to highlight as well is that in the 10-year yield, which earlier this morning touched 2% for the first time going back to August of 2019. And look, it looks like it's there again, up 7 basis points. This is something that investors have been waiting for a while, and now this latest inflation print pushed it over the edge. We're going to talk more about that inflation print in just a few moments with Michael Darda. Also coming up in the next hour, we're excited about this conversation with Fanatics founder and CEO Michael Rubin. He's getting pumped for the Super Bowl and his famous Super Bowl party as well. We'll be talking to him about the demand for jerseys, sports betting, and much more. We'll be right back.
Welcome back to Yahoo Finance Live on this inflation-filled Thursday. I'm Brian Sazi alongside Julie Hyman, and there is lots to hit on over the next hour of market action. Stocks right now seeing some mixed to downward action following that really eye-popping CPI release, 7.5% increase on the headline, causing the 10-year yield to approach 2%. Lots of things moving right now in the markets. But here are some other things we are watching for you at this moment. Don't call on a comeback. Disney is the top trending ticker on the Yahoo Finance platform this morning as the company blew away analyst profit forecast last night. Credit goes to a comeback quarter in the theme park business, which hauled in almost $2.5 billion in operating profits. I have more on Disney's quarter on the Yahoo Finance homepage, so give it a like and give it a share. Earnings madness. We are keeping a close eye on shares of Uber and Mattel. Uber shares are getting some love as execs said demand is bouncing back from the pandemic. Over at Mattel, CEO Ynon Kreiz just told me the company is back in growth mode. Investors seem to agree with his hot take. And the Super Bowl party is for QB jerseys. We're live with the founder of sports apparel giant Fanatics, Michael Rubin, head of the big game on Sunday. Rubin continues to make power moves in all areas of sports, so you will not want to miss this interview. But first, over to Yahoo Finance's Jared Blickery. And Jared, I don't want to miss your market sit here.
I'll tell you what, my focus is on the 10-year, and Julie was just highlighting that. Let's take a look at the Wi-Fi Interactive because we just hit 2.0% for the first time since August of 2019. It was up 7 basis points. It's come a little back since then, but I want to show you a 3-year chart. This is the first, as I said, the last time we saw this number was about the middle of 2019. We skipped over this here, but you can see this is a big psychological level. Let's take a look at 10-year. On the 10-year. This is a 10-year chart here, and this has been in play for quite some time. So a lot of focus here. And let's just take a second to look at what happened this morning in the futures. This is going to be the S&P futures intraday since midnight, and we took a big leg down. You don't usually get a reaction this strongly off of CPI, typically not a market mover. That's how above consensus it came in. 7.5%, 0.6% for the month. That was a 2 standard deviation move. And as Bloomberg noted before the report came, that tends to be concomitant with downdrafts in stock, and that is stocks, and that's exactly what we're seeing. Energy is a respite. We can see that's up about 0.8%. That's probably an inflation play right here. We also have materials, financials, and communication services. And let's take a look at the energy sector. That is leading, and we can see some outsized gain by BP. It looks like that stock is up 1%. Marathon, that's up about 1%. Devon Energy, that's up about 2%. And then we take a look at the bank stocks, and those are really flying. Morgan Stanley hit another record high on the open here, and we're seeing a lot of financial stocks, including insurance companies like Travelers, really benefit from the yield curve. Now, I should mention that even though yields are pushing higher, the yield curve is contracting. That means the short end is racing higher, and the long end is pretty much standing still. Want to check in, on the Nasdaq here, and we can see a lot of red on the screen. We got Apple, Amazon, Alphabet, Microsoft, Tesla, and Nvidia all down, but less than 1%. We got some outliers to the upside. Micron, Datadog, that's up 15%. A lot of these are just earnings stories. So a little bit of weakness here, but it was good to see the market, the dip bought after that CPI report when the market opened here.
Thanks, Jared. Appreciate it. So a lot of action to watch there. Let's dig more into the CPI report and the reaction to it today, as well as the extrapolation as to what it's going to mean for the Fed, of course. Michael Darda is with us, chief economist and macro strategist at MKM Partners. Mike, it's good to see you. So 50 basis points, is that what we're getting in March? Or do we still need to see the additional CPI report that's coming out between now and then, and maybe get a little Fed speak? What do you think?
Well, I'd be a bit surprised if the Fed went 50 right out of the gate. I think with these numbers and the way the economy performed last year, you could certainly make a case for 50, but the reason the Fed probably won't do that is because if they did, market expectations would, reset to 50 at, each subsequent meeting, and they probably don't want to take the risk of taking that step and then having to reverse course. So they're probably going to start out more gradually. They still have 7 meetings this year. They can raise rates at every meeting by 25 basis points if they decide that's called for. And they can also pick up the pace of rate increases later on. But let's take a step back here and just recognize, even though we have 7.5% headline inflation and 6% core inflation, excluding food and energy, the Fed's actually still doing QE. It has not wrapped up the taper, and short rates are at 0. So to say they are behind the curve is a complete understatement.
Michael, to that end, do you think we're seeing a upward price spiral in this economy?
You know, we do have a broadening of inflationary pressures. I'm hearing some economists say, well, the inflation's really been driven by the goods sector, and that's going to cool off as the pandemic recedes. Keep in mind that if we look at services inflation, excluding energy services, we're still running at pretty high levels, around 4%. And the trend for this cycle has actually been above the last cycle. So if you extend the trend growth path of services inflation, excluding energy, from the beginning of the pandemic, we're running above that. Rents are rising fairly rapidly. Wages are also rising. And all of these variables are above the trend growth path of the previous cycle. So the idea that this is just some kind of a narrow inflation that will disappear on its own, I think is wishful thinking.
So what is going to happen from here, Mike? I mean, is this 7.5% print, are we going to see smaller prints from here on out? Is there a risk even of seeing this level or higher persist? Because it seems like, I mean, we keep hearing these calls that the supply chain is easing a little bit, but I don't know if it's enough to make a difference.
Yeah, I think we have to be careful about head fakes. And so we very well could be at a point where these headline inflationary pressures are peaking on a statistical basis. But keep in mind, if the inflationary pressures are broadening out, that's a floor that continues to rise in terms of how much inflation will fall and how sustainable that decline would be. The other thing to keep in mind here is, one failing that's happening in Wall Street research right now is lack of any kind of a coherent model of nominal income determination. And that basically means if the Fed is behind the curve, on the curve, or in front of the curve, and how we make the macro assessment from there. If they're just going to start out very gradually and they're going to continue to be behind the curve, we really should not expect the economy to slow dramatically and for inflation to plunge in a sustainable way. So yeah, these numbers could be headed down at some point in the near future, but my opinion is we're likely to see inflation at least 100 basis points, if not more, above what would be consistent with the Fed target, which is 2% average inflation targeting. So we're way above that now. I think we're going to continue to be above it, and the Fed's likely to be behind the curve for most of, if not all of the year, which could set us up for some potential challenges going into 2023 if the Fed has to get more aggressive then.
Before you came on, Michael, I was sharing a recent story of mine where the cost of my deodorant that I used all the time essentially doubled. It's almost $14 a pop right now. And what did I do? I traded down to something that was $7. Have you seen price increases in your own life, and have you tried to trade down as a result?
Well, yeah, everything is up. I mean, obviously, food and household products, rents, and we're seeing a lot of pressure on prices in leisure and hospitality. So just try booking a vacation somewhere. So I think we're all seeing it in our everyday lives. I'm certainly seeing it. And the question is, if you still have a very hot economy that is rapidly closing in on full employment, and potentially beyond that, can we really expect a full-scale reversal of these inflationary pressures? And I don't think so. So the overall headline CPI might ease a bit, but we're still going to likely be dealing with overall inflationary pressures well above what we were accustomed to during the last cycle. And that will continue until the Fed tightens enough to slow overall aggregate demand in a sustained fashion, and then inflation will come off. But until that happens, we're going to be dealing with persistent above trend inflation, in my opinion.
Yeah, something to look forward to. Mike Darda, good to see you. Thanks so much, Chief Economist and Macro Strategist at MKM Partners. Well, before we go to break, I want to give you another mover that we have been watching, and that is Tapestry, the owner of Coach and Stuart Weitzman. The company coming out and raising its forecast for the full year. It owns Kate Spade as well, by the way. Sales last quarter were up 27% in constant currency terms, and that's as we have been seeing a sales pickup for pretty much all of those brands there. The company now saying for 2022, fiscal 2022, revenue is going to be about $6.75 billion. The forecast from November was $6.6 billion. And by the way, tomorrow we're going to talk to the Tapestry CEO about these numbers and about what she is expecting here in 2022. But coming up after the break, we're going to talk Peloton's new CEO. He just had his first all hands meeting, but didn't go that great. We'll talk about it next. The state of California is suing Tesla over allegations of operating a, quote, racially segregated workplace at its factory in the San Francisco Bay Area. California's Department of Fair Employment and Housing filed a lawsuit alleging discrimination and harassment of black employees following hundreds of complaints from Tesla's main plant in Fremont. Tesla responded to the lawsuit in a blog post claiming the department, quote, declined to provide Tesla with the specific allegations or the factual basis for the lawsuit. The suit says that there was racist graffiti at the facility and supervisors and managers used racial slurs. A solar storm caused more than 36 SpaceX satellites to tumble out of orbit. The company said a geomagnetic storm made the atmosphere denser, which increased the drag on the satellites and essentially knocked them out. The satellites hit by the storm were in a temporary position and are now in the process of re-entering the Earth's atmosphere, where they will be incinerated. SpaceX still has 2,000 satellites circling the Earth. And Peloton held a virtual meeting yesterday that was meant to introduce new CEO Barry McCarthy, but it got cut short after former employees joined the meeting and fired off comments related to this week's announced job cuts, reporting all according to CNBC. Former employees commented in the chat and accused the company of being, quote, tone deaf, CNBC reports. Peloton slashed 2,800 jobs earlier this week. The company offered employees affected cash severance and a 12-month subscription to Peloton. And Saz, this is just the latest report coming out on this company that shows that maybe just switching the position at the top is not going to sort of wave the magic wand and make everything better, especially since, I didn't mention it there, but Barry McCarthy was joined by John Foley, who left the CEO spot but is still the executive chairman at Peloton.
Yes, and like we were talking about yesterday, executive chairman is different than chairman. Chairman, you show up at these meetings virtually, you collect a check, and then you go out and spend that check on lots of giant stakes the next couple of months. Executive chairman, you're still involved in many respects day to day, as Foley appears to be here. Now, Barry McCarthy, he's an accomplished executive. He has been around the block, has seen many rodeos. Netflix's longtime CFO, architected Spotify's direct listing, was their longtime CFO. I would bet that he did not see this coming yesterday. It's embarrassing for the company. Frankly, it's an embarrassing way for him to start as the new CEO of this company. But it speaks to this bigger picture inside of Peloton, is what is the culture right now inside of this company, given how far they have fallen from grace over the past year. Anytime you do this type of mass layoff, it impacts your culture, and it will take many quarters to recover from it.
And to be fair, right, is there any good way to do a layoff? I suppose there are different gradations of bad ways to do a layoff. And there were reports coming out as it was going on that people only found out that they had been laid off, for example, when their Slack ability was shut off. So it's unclear how this latest situation happened where these employees who had been let go were commenting. It's also unclear whether it was also current employees who were making some of these criticisms. Anyway, you slice it, as you point out, the culture seems to need some work, looking from an outside perspective. All right, we're going to take a quick break. When we come back, we'll be talking more about inflation. We've got a new poll on how people are cutting back on spending. It's not just Sazi and his deodorant trade down. There are other people doing this as well. We'll be right back.
CEO after CEO is telling us here at Yahoo Finance they are raising prices on consumers because of labor inflation, transportation inflation, and commodities inflation. So is this latest inflationary wave sitting well with consumers? Yahoo Finance's Inez Ferre has been looking into this and joins us now. Inez, I've been sharing all morning my deodorant story where I traded down because the brand that I was buying was just too darn much. They just jacked up prices too much. What are you hearing from your contacts?
You're not the only one. I spoke to one woman, Ligia Murillo. She owns a small business. She cleans houses. She has 14 houses that she cleans along with her partner. And she said that she's seen a little bit of a service cutback in the sense of 3 of the 14 houses that she cleans are now cutting back on their hours for cleaning. But as far as she's concerned, her own buying patterns are changing. We wanted to get an idea of how people's buying patterns are changing with this high inflation. And she's telling me when she goes to the grocery store, she has stopped buying beef. She says she is now substituting that for chicken. She has changed her insurance for her house, for her car, to one that's less expensive. She and her husband have now also cut back on they've canceled their local newspaper, the Norwalk Hour in Connecticut. They are cutting back and they are not buying clothing. They haven't bought clothing for months. She says that this inflation is making her angry. I'm quoting, I'm angry at the government. She also says she doesn't understand how older people with fixed income can kind of cope with all of this inflation, and also people that have children. Now, as far as the data is concerned, I did speak to Omar Sharif from Inflation Insights, and he told me that people are reacting to higher prices on goods that have gone up by quite a bit. So, for example, he highlighted the beef example. He said over the last 6 months, in real terms, adjusted for inflation, spending on beef products has gone down by more than 10%. Now, they don't have data sets on per income. So if you're a lower income or if you're a higher income. But just to give you a snapshot of what PayPal said in their last earnings last week, John Rainey, CFO, said the following. He said, we've seen weakness around spending in our lower income cohorts. This was a cohort that certainly benefited from stimulus in prior periods earlier this year. And we're seeing the effects of inflationary pricing around that, where there's a more elastic demand curve around that. So you're getting some snapshots, even though you may not have the actual data zeroed in, you're getting some snapshots as to how this is affecting people, consumers across different income levels.
Well, there's a lot to unpack there, including the idea that is this now growing pushback going to mean that we are going to see deceleration in these price increases? That remains to be seen, obviously. But I want to zero in. I know we did a Twitter poll, but before that, I want to zero in on what she said. I'm angry at the government. I find that so fascinating, and I think that's a fairly widespread sentiment, right? We just had President Biden actually commenting in reaction to CPI and acknowledging the pain that people are feeling. Why does she blame the government? I would love to hear if she explained to you that line that she's drawing.
She did. And she basically said to me, since Biden came into office, she has seen the prices skyrocket. So she's correlating these price increases with the change in administration, because she says when he came into office, now we're seeing these big price increases. Now, we have seen inflation going up for months now, but in her view, she's seeing the most acute inflation recently.
Very interesting stuff. Okay, so let's get to that Twitter poll, because that's also really interesting. You ask people more broadly what they're doing. Talk to us about the poll.
Yeah, that's right. So we put out a Twitter poll on Yahoo Finance. We said, is inflation leading you to buy fewer goods and services related to housing, food, and gasoline? And you can see there that 50.7% said yes, 59.3% said no, just paying more money. There's no really getting around gas, food, and housing, because that makes up a big part of people's budget. And in fact, Nielsen IQ also came out with a survey going into 2022 and basically said that this year people are expecting to spend more on utilities, on groceries, on home basics, and they're expecting to spend less on discretionary items and going out and items outside of the home.
Well, and as if my deodorant keeps going up in price, if it hits $20, I'm just not buying it anymore. I'm going to start walking around with bars of soap under my armpits, just being real here. Inez Ferre here, top reporting as always. We'll talk to you soon. All right, do stick around. Much more ahead on the markets. And also, we'll have a really interesting chat with Michael Rubin. He is the founder and CEO of Fanatics, ahead of the big game. Stick around.
Fanatics has been getting in some serious shape during the pandemic, including acquiring the Topps trading card brand. And as we prep here for the Super Bowl, we want to bring in Michael Rubin. He's Fanatics founder and CEO, and also, of course, part owner of the Philadelphia 76ers. But we got to start with football, don't we, Mike? Let's talk about ahead of the game here. I'm curious what jersey sales are looking like, especially as you compare it to pre-pandemic, you know, and with the flows that we have seen of people being able to go to games and not being able to go to games. What's the status right now?
Yeah, so first, NFL business overall and Fanatics business has been great. NFL was up 30% in revenue last season, and in the playoffs, they've been up 40%. So spectacular growth from the NFL. When you think about the Super Bowl, I'll tell you something that shocked me, and I think it will shock you. If the Bengals win the Super Bowl, they'll be the biggest NFL champion ever in the history of Fanatics in the NFL. And that's because there's so much built-up demand from a city that hasn't won the Super Bowl before. I'm actually friendly with the owners of the Rams, the Kroenkes, great family. So I'm a little bit torn. Do I support my friends? Super Bowl's here in LA, or do I support Fanatics, who's told me it's 2-1 in revenue, Bengals to Rams?
Mike, do you have any Joe Burrow jerseys left in stock here?
You know, jerseys have been selling incredibly fast. I'm sure we have some, but I will tell you, with all the supply chain challenges this year, with Cincy being such a small market, it's definitely going to be a very in-demand jersey today. So I know we have some, but we're definitely not as in stock as any of us would like to be, with this being a small market team. Probably 2 years ago, it was probably number 31, 32, 30 in the NFL sales. And this year, if they were winning the Super Bowl, they'll be the number one team without question.
Tom Brady, official. He is retiring. Michael, what have you seen with his jerseys? And when you see that type of generational player retire, how does that impact the business moving forward?
Well, first of all, nobody has ever sold more jerseys in the history of our company and in the history of sports than Tom Brady. He's a literal jersey selling machine. We thought when he played for the Patriots and won 6 Super Bowls with them that nobody would ever sell more jerseys. Then he went to Tampa Bay, which was at that point one of the least purchased NFL teams, made it the #1 team. And when he retired, yet again, so many people bought his jerseys. And you know what? This guy, played just such an incredible season last season. I don't know. I'm still hopeful maybe some way he decides that, this retirement thing's not for him. And after you leave him at home for a few months without the stress, maybe he gets convinced to get right back in the game. We love Tom Brady and the jersey selling machine that he is.
Well, luckily you got some other jersey selling machines as well, even if they're not quite as big as Brady. I want to ask you about another side of the business too.
So many. That's the great thing about the NFL. We have every year there's new players, new rookies. I mean, that's the great thing about Fanatics is one year you're gonna have a team that nobody cares about. The next year they can be the #1 selling team. The same thing goes with players. So that's our business. But I'm a little extra special with Brady and how many jerseys he sold versus what a great guy he is.
Yeah, I think you're not alone, certainly, in that sentiment, Mike. I want to ask you about a rare part of the sports business that you're not in yet, and that's sports betting. And going into this, Axios is reporting there are 45 million people eligible for betting ahead of this Super Bowl that weren't eligible last time because of all of the states that have now legalized sports betting. What's your current thinking on this space?
Yeah, so for Fanatics, as you know, we started in the merchandise business. That's where our roots are. Really began with the business in 2011. And really for the next 8 years, we were solely focused on building the merchandise business and really just improving the experience for the fan. Beginning about 2 years ago, we started really transforming our business into a leading digital sports platform. And as part of that, we have not only Fanatics Commerce, which is our merchandise business, we have our NFT business, we have our trading card business, but online sports betting and iGaming is a business that we think for us will be a very significant business long-term. I'll put it out there. We want to be the #1 player in the world long-term. So a decade from now, I'd be disappointed if we weren't the top player in the world, both in online sports betting and iGaming. We're just getting started. I do not think this is a business that you need first to enter into. I think this business, like a lot of businesses, so many people got into it early because of how big it's going to be, and it will be that big. And there's been so much money invested and in a lot of cases lost. And I think this business will become a good business long-term. It's a very tough financial business today. People investing not hundreds of millions of dollars, but billions of dollars in losses this year, and will continue to do so. And from our perspective, we have probably the most digitally oriented transactional commerce brand, and we have the best database in all of sports. So that's a real structural advantage to help Fanatics become the ultimate leader in this business, and at the same time give a better experience to the fans. So I'm super bullish on the business. I think it's going to be a big business long term, and we certainly want to be a major player in the business long term.
Do you think that you guys would buy your way into that business, or do you think you would develop it internally?
Yeah, so right now we have a very aggressive organic plan that includes leveraging our brand and our database, and kind of buy and market access in most states. That said, as a company, I think we've always been somewhat acquisitive when we can find a way to get capabilities to move more quickly to ultimately, better satisfy sports fans with trading cards, collectors. And so ultimately, I'm sure that we'll buy pieces to accelerate our growth, but kind of the whole, framework of our plan is an aggressive organic plan in North America. Outside of North America, I think there's a lot of business that makes sense. In North America, to be honest, there aren't things that I want to buy at this point. I think they're just too expensive.
Well, let's focus on something you did buy, $500 million for Topps, Michael. To use the football pun, you wrote a playbook on how to get an M&A deal done really under the radar. How did you do this deal, and what's next for Topps?
Yeah, for us, it was all about the vision of really, continuing to grow the trading cards business. The trading cards business is a very interesting one. It's one where you have many manufacturers that make trading cards. They then sell them to distributors, not to retailers. There's distributors selling to retailers. The retailers sell them to resellers. The resellers put them on eBay, and eBay kind of sells them to collectors. And what we realized is we took some learnings from our Fanatics Commerce business, and we applied that toward the trading card business, that we could build a much better business. So we essentially went to all of the rights holders said, hey, why don't we create a new company, majority owned by Fanatics? We'll give you guys equity in this new company, and we can really improve the collector experience within trading cards and places where you could not only buy the primary cards, but we could create a secondary marketplace, a bunch of other ancillary services, build more of a direct-to-consumer business. So once we created that, Topps became a great way to kind of, move forward in our timing of getting into this business. So we're super excited about the business. Topps is the most iconic brand in trading cards, been in business for 70 years. I think when someone thinks trading cards, they think Topps. And we've, welcomed 350 great members of the team to not only help us build the Topps business, but also to take over the NBA business and the NFL business that will move over to us within the next 4 years once their deal ends with Panini.
Mike, the trading card business is so fascinating to me because it has been such a cyclical business, right? It has become really hot again during the pandemic as people have gone into their attics and pulled out their own old cards and needed something to do during the time when they were sitting at home. But definitely it has had some long, slow periods in its history. So jerseys are pretty stable, right? When you're getting into a business like this, how do you think about that cyclicality?
Yeah, so first of all, you're 100% right. And I think there's reasons why that's happened. The two biggest reasons I'd say is the new model of trading cards is generally now a property, whether it's, Pokemon or whether it's Star Wars or whether it's Major League Baseball or National Hockey League. They pick a partner. In the old days, you had so many partners making their own, similar property trading cards, and that was a broken model. And so that got fixed, and that set up a lot of growth. But here's the problem. You have this really big business, and no one is marketing the growth of the category overall. So when we think about this business, we think about today, a business that's $10 or $15 billion, essentially has no marketing spending. If you think about any other consumer product, whether it was, a pair of Nike shoes or a Gatorade drink or a Pepsi drink or, cosmetics, marketing is a big part of what they do. We believe to really grow this industry overall, and we think we're going to be the person that's most responsible for growing the industry, we need to aggressively market and get more collectors into the business. So we're thinking about two things. How do we exponentially grow the amount of collectors in the business to grow the market? And the second thing is, how do we make the collector experience much better? And so I'm highly confident that when we begin marketing for the first time and improving the collector experience, that we can get consistent growth. Obviously, the other thing that's going in our favor right now is alternative investments are far more interesting for the younger generation. And whether it's investing in art, whether it's investing in NFTs or crypto or trading cards, this is where the younger generation is. And trading cards are a great place to invest, but we still need to introduce it to so many more people. This will kind of surprise you. There's probably only 5 million collectors today of trading cards. And my goal would be, how do we have 50 million or, 100 million collectors or hundreds of millions of collectors? So I think there's a huge opportunity for us to really grow this market.
And Michael, when you're not doing big deals and running Fanatics 24/7, oh yeah, you're also an owner in the 76ers. Now, there were some reports a couple years ago that you kicked the tires on buying the Carolina Panthers. The Broncos are up for sale. Do you want to throw your hat in the ring?
No, not at all. So you're 100% right. I did get close and serious about buying the Panthers in 2018. And had that happened, I would not have had the opportunity to focus in on Fanatics and really transform the company from the original Fanatics commerce merchandise business to today really creating the leading digital sports platform. If we really execute on the opportunity we have in front of us, this can be one of the most valuable companies in all of technology. It could be the most valuable company in sports long term. And to me, that's something I'm so excited about. Owning a sports team takes waking up and going to bed every day obsessed with winning championships for your city. And I don't have the time and energy or really the ability to have the distraction to have any further ownership in sports. So certainly I'm a 10% minority owner of the Philadelphia Sixers. We have a great group of people who like each other. But I'm not interested in making any further sports investments across any league. It's not that I don't believe sports is a great place to invest, is that I believe the best use of my time is in leading Fanatics, through this, digital transformation, building the leading digital sports platform.
On these 76ers, Mike, where does Ben Simmons end up?
Look, only time will tell. We've got a great general manager in Daryl Morey, great ownership group led by Josh Harris and David Blitzer. And today's the trade deadline at 3:00. We've got got about 4 hours left, and that's what makes the NBA so exciting. Things happen all the time. Look, Ben's a great player. He's a 3-time All-Star. We're missing him today. We'd love to have him back on the court, and only time will tell.
And finally, wrapping it up and getting back to the Super Bowl, I think you said Bengals from a business perspective, Rams from a sort of personal and friend perspective. I have to admit, I'm new to your Instagram feed, and I'm fascinated because, like, it's very entertaining. I'm going to be watching on Saturday because you guys have a big Fanatics Super Bowl party. Gives you plenty of time to then, I guess, recover for before the game on Sunday, right? So, like, what are you looking forward to as your highlight of the weekend? You got your party, you got the halftime show, you got the game itself. What do you think?
So for me, I hate to admit this, I don't look forward to any of it. It's just kind of like Fanatics building this business. Tomorrow we host a lunch for 100 of the kind of most important people around the Super Bowl. On Saturday, we have what's always, the Super Bowl's best party of the weekend. And then we have the game on Sunday. We have tons of friends where Robert Kraft and I share a suite together and, curate a great group of friends. All of that is, it's fun for me, but I'm always just pushing. I'm sleeping like 3 hours a day right now and just going on pure adrenaline.
Wow, you and Brian Sozzi are
we got to hang out, Michael. I got to get your email, man.
I got you. We're going to tell you where to find me, and I look forward to it.
Michael Rubin, Fanatics founder and CEO. Thanks so much. Hope you enjoy the weekend, even though it will be also work for you. But thanks for your time today. Appreciate it. All right, it's time for the stat of the day, folks. The S&P 500 has performed better and posted positive gains with greater frequency over the past 55 Super Bowls when NFC teams have won points. That's according to LPL Financial. Oh, that's when NFC teams have won, excuse me. The average gain when the NFC has won, 10.8%, compared to a 7.1% gain for AFC wins. Coming up next, new data shows that foreign investment in U.S. commercial property has exceeded pre-pandemic levels. So is now the time for you to buy. We're going to discuss on the other side of this break.
Welcome back to Yahoo Finance Live. Looking for investments that can flourish against an inflationary backdrop? Then try real estate, says our next guest. Sam Dojan is the founder of Financial Samurai and joins us now. Sam, good to see you this morning. Give us some reasons why you are keen on real estate here.
Well, I mean, if you look at inflation, and it's hot high school summer, 7.5%. That's the highest in 40 years. And inflation is great for rising rents, rising property values, and real estate is also a hedge against inflation. But the real key here is how much inflation has risen since a couple of years ago. We're talking about 2.5% to 7.5%, whereas mortgage rates have gone from, let's say, 3% average on the 30-year fixed to about 4%. So in other words, what we're seeing is we have negative real mortgage rates. And when you have negative real mortgage rates, that's a great opportunity for buyers. Buyers should be borrowing all day long because there's great value in borrowing. And there are other reasons for buying real estate. Inventory, way down right now, down 30 to 40% year over year. If you look at the average tenure of home ownership, it's gone from about 4.5% to about, 4.5 years to about 11 years. People aren't selling their homes anymore. Why should they? If they sell their homes, they're gonna have to jump back into the fire. And if you look at US consumers, they're cashed up. Corporate balance sheets, individual balance sheets higher than ever before. And then if you look at the multiplier effect, in the past, people would just buy a home, pay it off, pay down debt, and then retire comfortably. But now people are looking at real estate and saying, well, it could be a viable investment for my retirement, for my children. So the multiplier effect could go from one property for one household to maybe 2 properties or 3 properties per household. And then the final point I want to make that I don't think anybody is talking about, I've looked everywhere online, all the real estate research houses, is that foreign investors are licking their chops, waiting to buy US real estate. So the pandemic has been bad for most of us. However, what the pandemic has done is throttled foreign real estate demand for the past 2 years. Pre-pandemic, foreigners were buying $100 to $150 billion of US real estate every single year. And then that changed. If you look at the data from the National Association of Realtors, that dropped to about 54 billion in 2021. So in other words, there's probably about 100 to 200 billion dollars of foreign real estate demand for America. And why not? I mean, US, we've crushed it. 2021, the S&P 500 was up 27%, whereas MSCI emerging markets down 5%.
So Sam, so you make a good argument here for real estate. My question is how? What is the best way for people to go about it? Because even if you're borrowing in order to buy real estate, if you buying a home is a big chunk, right? So what are the creative ways maybe, or how should people be thinking about how to invest in this space?
So you can buy physical real estate, obviously, your single family homes, your multifamily properties, or, and most people just take out debt, or you can buy real estate ETFs like a VNQ, or you can buy private real estate syndication deals, which are becoming more and more. You're seeing firms like Fundrise, CrowdStreet, they're offering the ability to buy commercial institutional real estate for retail investors. So you don't have to go all in with a mortgage, but in a negative real mortgage rate environment, it makes sense.
Good tips indeed. We'll leave it there. Sam Dojan, founder of Financial Samurai. Good to see you. Have a great rest of the week. All right, coming up, Kohl's is again being attacked by its activist investor. More on this straight ahead.
More activist news when it comes to Kohl's, and Brian Sozzi's got the lowdown for us on a new, perhaps, slate of directors suggested.
Yeah, Julie, this one's getting nasty. Jonathan Duskin over at McCallum, who has been waging an attack against Kohl's for over a year, putting forth 10 new board nominees this morning for Kohl's. Let's keep in mind that Kohl's board is 14 members, so essentially Duskin is saying he wants to get rid of all of these folks that have been helping to drive Kohl's shares really into the ground over the past decade, along with their operating profit margins. A couple things here. First, Duskin is nominating himself to the board. He's also on the board of City Trends, very experienced person right there, of course. Number two, he's also calling out and ratcheting up his attack on Kohl's chairman, Frank Sika, calling him, quote, a lame duck. He's also saying, quote, it is alarming that the company has designated an outgoing chairman with a 34-year tenure as the voice of the future. So this one is getting nasty. A lot of mudslinging going out there in the trenches. I should note, per the usual, Kohl's didn't return our request for comment.
Yeah, well, we'll see if they return any of the calls from McCallum. It doesn't seem like it's it's going too well thus far. We got to get another check on the markets, as investors continue to digest the CPI numbers, as well as all these companies that we have been documenting that have been coming out and talking about raising prices. We've actually seen stocks come up, well up off the lows of the session. The Nasdaq, remember when we opened up this morning, was down about 1.75%, 1.8% or so. Now it's only down about 0.5%. The S&P down about the same. The Dow is off by about 1/3%. As our Jared Blickery pointed out earlier, the pressure here being felt in areas like utilities and real estate, also tech, which is sort of a newer interest rate sensitive group. Utilities and real estate, the more traditional interest rate sensitive groups. What's up today are the stuff that's benefiting from inflation, right? You got materials, you got energy, you got financials, which tend to do better when rates are higher. And we have seen that 10-year yield go up to 2%, which is a threshold that a lot of those in the bond market have been waiting for a long time and have been puzzled that we haven't gotten there before now. So this is really sort of a milestone today that we are getting to that point, both in inflation and in the market reaction to it.
Hey, Julie, how do we get invites to that Michael Rubin party for the Super Bowl? I didn't get mine yet, but it sure seems like fun.
It does. It's because we make such sparkling conversation with all of our inflation talk. Maybe we're too much of a downer, so that we won't get it.
I'll be on the lookout in my email box. Maybe it'll come through.
Something tells me the guest list there too is a little inflation proof or price increase resistant. Just a guess.
Just a guess.
Did we mention who the entertainers were at that party, by the way? I'm not sure if we mentioned.
Go for it.
Doja Cat, Megan the Stallion, Lil Baby. It's like a mini
We fit right in.
show.
We fit right in.
At that party.
Yeah.
Yes, we do.
Yep.
All right, we're going to leave it there on this Thursday morning. Akiko Vegeta and Brian Chung are going to take you through the next 2 hours of trading. We'll be back tomorrow.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brian Chung. We are seeing stocks sliding as inflation hits a 40-year high. The Consumer Price Index out this morning, pointing to a faster than expected increase in prices, sending stocks lower. We've got all three major indices in the red right now. Also, the yield on the 10-year Treasury note spiking on that inflation data, hitting 2% for the first time since August 2019. Disney regains its magic as the company sees a rebound in its theme parks. Subscriber numbers from Disney Plus also helping to lift the stock as shares move higher on quarterly results. Plus, Black Rifle Coffee providing a jolt to public markets. The stock debuting in its first day of trade here. CEO Evan Hafer is going to be joining us later this hour to discuss the company's big debut on the New York Stock Exchange. We are beginning this hour, though, with that inflation data out this morning. Brian, we knew it was going to be pretty painful here, but we're talking about CPI hitting a 40-year high now, an annual gain of 7.5%. Food and energy, certainly significant jumps on that front as well. We're going to break that down in just a bit, but let's turn to Jared Blickery for a breakdown on the market reaction today. Jared, certainly those yields on the 10-year in focus here as we saw that spike on that data this morning.
That's right. In general, rising yields usually a good sign for equities, but when there's a shock to the market, especially when you hit a big number, sometimes it causes a little bit of a disruption. You can see the major indices down from 1/3 to 0.5%. The Russell 2000 up about 7 basis points. Now, I want to go to the S&P 500 futures so we can see what happened at 8:30 a.m. this morning. We got a big spike down and then a big spike up, just like nothing happened. 7.5%. I was in kindergarten at the time, and I'll tell you what, if you've been listening to the first 2 hours of programming, you'll know that Brian Sozzi's deodorant prices have doubled recently. So he's looking for other brands. I imagine a lot of other people are too. Materials and value, those are the accelerants today. We see material up over 1%, energy right behind it up almost 1%. And you take a look inside and you can see Devon Energy up 3%. We've seen a lot of these stocks, high flyers recently. And then you take a look at some of our leaders, IPO, Ark Invest, cannabis, bets, that's gambling. All of these sectors are outperforming, so good to see that here. Also, I would note that when we saw that buying on the dip in the S&P 500, pretty good sign there. So let's round this out with a look at the Nasdaq 100, and we can see Tesla is the only mega cap in the green. It's up about 0.2%. Also seeing Apple and Microsoft down 1%, and there's going to be a lot of focus on, some of these earnings names that we have in focus today, guys.
All right, Jared Blickery, thanks so much for that. We did get some reaction from the White House today on the back of that data, with the president saying in part, well, today is a reminder that Americans' budgets are being stretched in ways that create real stress at the kitchen table. There are also signs that we will make it through this challenge. He goes on to say, well, today's report is elevated. Forecasters continue to project inflation easing substantially by the end of 2022. Let's bring in our first guest for the hour. We've got Matthew Lazzetti. He's Deutsche Bank Securities Chief U.S. Economist. Matthew, let me just have you respond to that. What we heard from the president today to say, look, we know the number is bad, but it's going to get better this year.
Sure. First, thanks so much for having me. I think that has been the base case. But I think what is worrying from the inflation data this morning was not only that it missed to the upside, but it was the nature of that miss. We had new vehicles prices flat, and so that was expected goods prices kind of coming down from the very lofty levels. We also had a negative print in terms of lodging away, so hotel prices were negatively impacted due to Omicron. But the worrying development here is rent inflation. It was the highest month-on-month since 1992. We saw healthcare services inflation accelerating. And so these persistent items that I think the Fed will be very focused on pretend for upside inflation risks as we go throughout the year. So no doubt, I think we will be coming down on a year-over-year basis. The question is, to what level? And I think it's going to be a much higher level than forecasters have anticipated and the Fed has anticipated as of late.
Hey, Matthew, Brian Chung here. Great to have you on the program. Now, you've just got a note hot off the presses in reaction to the CPI, noting that this could be a doubling down on policy tightening, obviously referring to the Fed's next meeting in mid-March. A lot of chatter about the possibility of a 50 basis point rate hike in one move, which hasn't happened since 2000. seems like that would be pretty aggressive and might signal perhaps a little bit of market uncertainty in the future. What do you see as the Fed's response to this?
Yeah, so far from Fed officials, we've heard that they're keeping all options on the table. They're not discounting the possibility of moving by 50 basis points or moving by meeting to meeting, but they have kind of guided away from 50 basis points rate hikes. We heard it from Cleveland Fed President Loretta Mester. We also heard it from Raphael Bostic yesterday. But they've also, I think, indicated that they're going to be focused on, are we seeing evidence that inflation pressures are in fact dissipating as they anticipated? I think this morning's data certainly does not provide that evidence. And then it also provides evidence beyond the near term that this is a bigger picture problem. It is a broader problem. It has migrated into services, and those prices are going to remain more elevated for longer, causing the Fed some issues. And so I think you have a Federal Reserve that is currently at zero. It's adding to their portfolio through March, despite the fact that CPI inflation just printed 7.5% and the unemployment rate is 4%. The market has moved to price it at roughly 50-50 probability. And I don't think that the Fed will want to surprise in a dovish direction at the moment, given where inflation is. So we do anticipate that at this point, the Fed actually does raise rates by 50 basis points in March.
What is the case for the Fed still adding to their portfolio? We're talking about 40-year highs here.
There's no fundamental case, to be sure, to be adding to a combination at this moment. I think when Chair Powell has been asked about this in the past, it has been a sense of not wanting to surprise the market. So winding down QE relatively gradually over time, guiding in that direction. And then he thought that that opened up enough opportunity to be able to respond to upside risk to inflation. And I think they will end QE in March. But I think what we're seeing in the inflation data, what we saw from the jobs report on Friday, both the resiliency of the labor market to Omicron, but also the very significant acceleration of wages, tells them that they just need to get moving quicker. And so we see the 50 basis point move in March. We see 175 basis points of Fed funds tightening throughout the course of this year, along with the quantitative tightening or the drawdown in their balance sheet that we anticipate. It is a meaningful shock, we think, to financial conditions, to monetary conditions. And I think it does raise some questions about, can growth remain resilient as the Fed fights inflation as we get out to 2023 and 2024?
Okay, I want to drill down on this more because it seems like the consensus might be changing here, but to call for a 50 basis point hike in March is indeed an interesting call here. Would that lead to volatile mispricing? And is that something the Fed wants to do here? Not quite on the level of a Volcker shock, but doing so would really kind of make markets, and not just in the bond markets, I mean, broad portfolio positioning would shift pretty dramatically if the Fed did that, right? Because the spectrum right now is very wide in terms of people calling for 3 to 7 to 8 rate hikes this year. If the Fed goes by 50 basis points, that goes all the way to one direction. Could that really mess things up and actually risk perhaps a tightening of financial conditions so dramatic that it might actually induce a recession?
So I think that has been the key reason to not go down this route of 50 basis points, because once you open up that box, you're not going to be able to control market expectations for where the Fed funds rate goes from there. And so I think as of up until today in this inflation print, that was a very compelling reason for the Fed to not go 50 basis points. To me, the recent data is signaling something that is very different. It's a broadening out of inflation pressures. It's an acceleration in those components that you should be worried about. And so the risks, I think, have shifted from not wanting to kind of lose control of the narrative about being behind the curve and being able to control market expectations to, you actually need to tighten financial conditions. You need to reset policy in a better way. And you do not want to, I think, surprise in a dovish direction at this moment. And with the market pricing it, roughly 50-50 at this point, and I anticipate you will hear Fed officials that are more open to it over the next several weeks, I think, pushing up that market pricing. It won't necessarily be a surprise when we come to March, but I do think it does open up the path, as you mentioned, to the upside. The volatility that we can expect should be much greater. The fact that the Fed won't be able to guide about this path significantly, I think, induces a lot of volatility, a lot of uncertainty. And so it does create issues. It does create problems, but I think those problems will help them to tighten financial conditions and get the economy back on track and inflation back on track.
Well, Matthew Lazzetti, we appreciate you stopping by to help us make sense of this latest data. Deutsche Bank Securities Chief U.S. Economist. Let's turn our attention back to the markets. Brian, some big earnings out, and we're starting with Disney here because that stock is getting a big pop from a strong performance, especially in their theme parks. That division alone earned $2.5 billion in operating income. We're going to get to Disney Plus numbers in just a bit, but I'd be curious to get your thoughts on this one, Brian, because this is kind of that first quarter, maybe not the first quarter, but slowly we are starting to see some COVID restrictions ease as well. And that it's obviously giving a big boost to where Disney stands on the theme parks right now. It certainly points to, again, what we've been talking about throughout the earnings period, which is these companies who have a more diversified portfolio and offering tend to do strongly. And Disney saw strength not just on the theme parks, but also on streaming.
Yeah, and when we take a look at the numbers for Disney Plus, the headline number, 129.8 million paying customer, that's as of the year end, 37% year-over-year growth. So, I mean, they are really surging a big ways from the 2019 launch of Disney Plus, which feels so long ago, but really in the span of a business, at least for Disney's history, long history isn't very long at all. But obviously, the big focus is on the virus. And when you mention the parks, obviously, there's concern about the zero COVID policy in China affecting their businesses and their theme parks out there. But on the movie side of things, what we saw is that Omicron, and this is a rare case for the businesses that have reported earnings so far, they really blew through it. I mean, Spider-Man, No Way Home having record numbers. And I think that underscores how Disney, despite Disney Plus, is still doubling down on the movie theater experience. That's what Bob Chapek, the CEO, said on the earnings call yesterday. So take a listen to what he said with regards to how the company is thinking about that.
I want to reiterate that we continue to see value in the movie-going experience, especially for big franchise blockbusters. And given the performance of titles like Spider-Man, No Way Home, we are looking forward to kicking off our summer slate with another Marvel franchise film, Doctor Strange and the Multiverse of Madness. That said, audiences will be our North Star as we determine how our content is distributed. And we do not subscribe to the belief that theatrical distribution is the only way to build a Disney franchise.
So that's the North Star that they're referring to. And then one last point I want to make, look, they've got the movies, they have the Disney Plus subscribers, but one important note is that Hulu should not be overlooked. When you take a look at the average monthly revenue per paid subscriber on a year-over-year basis, yes, Disney Plus up 15%, but Hulu plus live TV, which in many cases is an $80 per month cost, that's up 16%. That's a huge boon and a testament also to the cord-cutting trend as well, Akiko.
Well, and also a testament to Disney having that strength in the bundle as opposed to just that one subscription with Netflix. A lot of comparisons being made, although it feels a bit like apples to oranges because the structure is a bit different and Disney Plus or Disney's not as reliant on the streaming side right now. Let's look to another stock that we're watching today, and that is shares of Twitter. Announcing their earnings today. They basically missed on earnings, revenue, user growth across the board. But you're seeing this stock up here because of that $4 billion in share buybacks. And, you know, this is the first quarter, Brian, under new CEO Parag Agrawal. Of course, Jack Dorsey stepped down in November. They did point to some of the weakness that we've seen in other social media companies, too, in terms of ad spend, although we did hear the company's CFO saying that he thinks things are starting to pick back up in Q1.
Yeah, well, the change in management is obviously a huge story here. And I think that's one reason why perhaps investors are piling in here because they're excited to see what this new chapter of Twitter is going to look like. But, you know, I got to point out that their efforts to better monetize their product still feels very much like throwing things at the wall when you consider, yes, they have Twitter Blue now. You have the super follows, you have tip jars where people who have substantial followings on Twitter can make use of those. I don't think you or I are using either of those. You know, we're using our blue checks just to tweet at support at airlines for the most part. But really, I mean, when it comes to these new products, I just don't know how much things like, for example, the Ethereum or an NFTing your profile picture, all of these kind of still feel a little gimmicky. But again, you have new leadership, so it remains to be seen over the medium run whether or not maybe the new CEO can take it in a different direction. Yeah,
and you know that's kind of been the weakness for Twitter for a while. And there's questions here that could be raised today that says, look, you had $4 billion in share buybacks. Could that money have been spent elsewhere to try and expand the tentacles, if you will, to bring in additional revenue drivers? By the way, we should mention monetizable daily active users at 217 million. And the company says they're still on track for that goal to reach 315 million by 2023. That is still intact, but we'll be watching to see if they can, in fact, keep up, not just on the revenue side, but keep users engaged in the face of more competition.
And, I think just a modest suggestion here for management, if you have so much cash to burn where you're doing share buybacks anyway, maybe you should just distribute it to the people providing the content, like me and Akiko. Maybe we can get a little bit of that Twitter cash. Are we gonna
get a tip jar? I mean, is that for
No,
$4
it's a
billion?
tip jar for Twitter
That's
to give us money, is my proposal here.
Okay. I like that idea.
This idea is free, folks, although it does come at a cost to my Twitter account, but let's leave that there. Shifting gears to another stock on the move this morning, it is Canada Goose, the maker of those big heavy jackets, having a rough go at it, down over 15%. That's after they lowered their fiscal 2022 revenue. They're now projecting revenues in the $860 to $867 million. That's in US dollars range. That's a 4 to 6% cut from its last round of forecasts. Keep in mind that China's a huge market for them. So if you're wondering why COVID has an impact on a jacket maker, the Olympics would have been a huge boom for them. But because of the zero COVID policy, that's going to hurt the traffic to their stores. But management said on the earnings call, they are hopeful that online sales will make up for it. Well, coming up on the other side of the break, Uber is jumping as the ride-hailing giant signals its pandemic slump is in the rearview mirror. We'll break down the company's latest earnings results after the break. Welcome back to Yahoo Finance. Taking a look at shares of Uber, up almost 4%. That's after they reported after the bell yesterday on Q4 earnings. They beat revenue estimates and increased ride bookings by 67% year over year. Here to break down more of Uber's quarter is Yahoo Finance's Dan Howley with the numbers. Dan.
That's right, Brian. Let's take a look at some of those numbers. And as you said, they beat on revenue expectations and adjusted EBITDA. For revenue, they were expecting $5.4 billion. They came in at $5.8 billion, and Wall Street was expecting $64 million on adjusted EBITDA. But they actually came in, Uber came in at $86 million. So a big beat there. And then, as you said, mobility gross bookings up 67%. One of the things that I want to point out there is the airport-based gross bookings. That was up 200% year over year. Obviously, that's a really strange comp because we were looking at kind of the depths of the COVID crisis. But then quarter over quarter, they were actually up 24%. And that kind of takes into account some of the Omicron surge that we had seen. So that's a good sign there. Delivery bookings year over year up 34%. Again, that's a strange comp just because this point last year, a lot of people were still doing deliveries. They're still continuing to do that, though, because they were up about 5% quarter over quarter, and they're moving deeper globally into the grocery delivery game. And I think one of the things to look for, though, into the future is how delivery continues to evolve, because that was really what Uber was placing its entire bet on as mobility kind of sank during the entirety of the coronavirus pandemic. So mobility fell apart, delivery really rose. They invested heavily in that. So we're going to have to watch to see where that goes as people continue to start feeling more comfortable going out into the world, maybe going out to do grocery shopping, maybe going out to restaurants, who knows? So that's something to really look out for. But another thing of interest from this report was actually their advertising business. They saw a run rate of $225 million through Q4, and that's higher than they had expected in Q2 of 2021, which was an initial run rate of $100 million. So really a good quarter here for Uber, a good catalyst going forward, and B of A basically having this to say about it following the report. Big picture, Uber remains a recovery stock, and with mobility demand rebounding, Uber is positioned to benefit from scale, efficiency, and cross-platform tailwinds missing during COVID. So obviously doing very well as people start to get back out there, more drivers. And I can say on a personal note, I've been using Uber a lot more than I previously was. I usually used Lyft, but pricing on Lyft can't match Uber right now. It just doesn't seem like there are many Lyft drivers as there are Uber drivers, at least in my neck of the woods here in Queens.
Yeah, Dan, it does feel like Lyft is often higher than Uber at least when I do a comparison. You mentioned some additional color that we got within the earnings report. It kind of speaks to the exposure that Uber has from their other holdings, whether it was holdings of Didi because of that sale over in China, or in the previous quarter, it was about their holdings with Grab over in Southeast Asia. I mean, can you speak to that a bit in terms of how big of a hit they took in the quarter as a result of the declines we saw specifically in Didi?
Yeah, I think that's going to be an ongoing headwind for them, especially as we continue to see the kind of crackdowns that we've seen in China as far as some of the regulatory issues there, specifically with Didi on its own. That was a big problem with some of the data that was being collected. China really basically saying, look, we're not going to allow the kind of extensive data collecting that the company had been doing. And obviously, as you said, Uber's exposure there as a result of the deal that they made years ago. So that'll be a continuing headwind for them, but not necessarily a massive one. I think the big deal here is their continued expansion into grocery delivery. That's something that a lot of companies are going to are doing, especially fast grocery delivery. That's that 10 to 15 minute time frame. They're not getting into it specifically, but they're working with partners to get into it as part of the delivery line. So we'll have to see how that grows. But it looks like Uber really continuing to do well as a recovery, specifically as B of A said in their note. But, I can say, again, as just a personal anecdote, I've been going out more, doing more with Uber, feeling more comfortable getting into a car. And I'm still ordering a lot, though not as much as I used to. So we'll have to take a look at how delivery holds up as people continue to kind of evolve through this COVID crisis. And hopefully this is the final tailwind.
Yeah, those delivery fees, or just fees in general with some of these food apps, they do add up, right? Now you can just go out to the restaurant and eat, or at least pick up directly. Thanks so much for that, Dan. Coming up, trade tensions are rising as truckers blocking a key passage between the U.S. and Canada enter its fourth day. The developments as protests expand to other countries and companies like Ford are forced to cut production. That's coming up next. In our worldview today, Russia and Belarus have launched joint military drills as Western leaders scramble to avoid a crisis in Ukraine. The 10-day exercise involves roughly 30,000 troops in Russia's biggest deployment to Belarus since the Cold War. And it comes one day after 6 Russian warships arrived in Crimea for naval drills in the Black Sea. On the diplomatic front, Russian and Ukrainian negotiators met in Berlin to ease tensions along the border with 100,000 Russian troops already stationed there. UK Prime Minister Boris Johnson met with NATO Secretary General in an effort to ease tensions along the Russia-Ukraine border, while his foreign secretary met with Russian Foreign Minister Sergei Lavrov in Moscow. Dozens of protesters have been arrested in New Zealand following demonstrations inspired by Canada's so-called Freedom Convoy. More than 120 people were charged with trespassing and obstruction outside of Parliament, while lawmakers moved to shut down access to the grounds to demonstrators. The protests began Tuesday with more than 100 truckers marching to push back against COVID restrictions and vaccine mandates. Meanwhile, over in France, officials are scrambling to get ahead of planned protests this weekend, with thousands of convoys expected in Paris. Police have stepped up patrol there and threatened to revoke licenses of drivers blocking traffic. The protests, of course, all began in Ottawa. They have brought communities in the city to a standstill since demonstrations began over vaccine mandates for truckers crossing the U.S.-Canada border. Dozens of people have been arrested and at least 80 criminal investigations launched. The violence has prompted Toyota and Ford to now temporarily halt production in Ontario. Toyota shut down 3 factories, while Ford said it is halting its engine factory partly because of shortages. And at the Beijing Olympic Games, it is back-to-back gold for U.S. snowboarder Chloe Kim. The California native defended her gold on the halfpipe on her first run, while Salt Lake City's Nathan Chen finally captured his first gold in men's figure skating. Chen erased his disappointment from the Pyeongchang Olympics with an impressive long program. He now becomes the 7th American to capture gold in men's figure skating. And Brian, I actually stayed up to watch this. It was a late night, 12:30, I think is what he skated. But I mean, what a win. It's nice to see the U.S. back on top, but especially Nathan Chen also having endured so much pressure over the last 4 years after what happened in 2018.
Yeah, certainly. And there is kind of an inversion between him and the fantastic Japanese skater Yuzuru Hanyu, who tried yesterday to salvage his individual program with the quad axel, is at least how I understand they describe it. And he fell and then fell on the next move as well. But I mean, look, a storied career for him, having won gold in the previous 2. So I guess Nathan Chen now taking the crown from Yuzuru Hanyu, but very interesting to watch. We'll see. I think tonight's the Super G. So I think Michaela Schifrin will have another chance to hopefully get back on her skis. But obviously she's had a really rough go at it, at least in the last 2 events.
Yeah, we will all be rooting for her, of course, but also nice to see Chloe Kim win. By the way, Torrance, California, which is my hometown, not often mentioned on national broadcasts. It was nice to see that, right? Hometown girl winning gold back-to-back.
I feel like, just to be fair, I feel like all of the winter athletes from the United States are all from California for some reason. I feel like Nathan Chen is like the only exception being from Utah, but as a New Jersey guy, like I don't see any New Jersey representation over there. So, just pointing that out.
And Colorado. Michaela Schifrin's from Colorado.
Well, that makes sense. And to be fair, there's not many mountains in New Jersey, but we'll leave that there for right now. Let's take a look at a trending ticker on this Thursday morning. Shares of PepsiCo on the move. They dropped earnings before the bell. They beat on the top and bottom lines. Obviously, a big focus for them is on price increases. And what's interesting is that company management did say on the earnings call this morning that they do face pressures to keep prices low on things like their multi-pack beverages, so 2-liter bottles of Pepsi, 12 packs that people might be buying for the Super Bowl. But, because Pepsi's in so many businesses, they've got chips, they've got premium drinks. Outside of that, price increases could indeed be fair game. And that's what CFO Hugh Johnston told us earlier this morning. Take a listen.
We've got our pricing in place for that. For the 4th quarter, we don't buy out to the 4th quarter until a bit later in the year. Once we have some visibility into that, we'll decide what the next round of pricing looks like, if any. But based on what we see right now, yeah, it's going to be high single digits to 10%.
the next round of pricing. And obviously, given the inflation numbers that we saw this morning, maybe consumers will be able to take those price increases. Management saying that consumers, quote, follow us in spite of higher prices. Well, coming up on the other side of this break, Ark's Cathie Wood still getting attention. She is doubling down on her plans to invest in disruptive innovation companies, at least as they define it, but not in the way that you might expect. We'll explain after the break. Well, Cathie Wood's Ark Invest has had a rough few months, to put it lightly. Its main strategy and its main Ark Innovation Fund down 50% over the last year. But Ark hoping to take on a new look with a fresh fund that's apparently going to be a little bit different from its current ETF. So for more on this, let's bring in Yahoo Finance's Alexandra Semenova, who's got the details on the new offering. Alexandra?
Well, Brian, as you said, Cathie Wood is doubling down on her bets on disruptive innovation, but with a bit of a different approach this time. Ark Invest has filed to launch a new fund that will focus on investing in private companies. The investment vehicle, which will be known as the Ark Venture Fund, is going to mimic the same investment themes that her ETFs do, focusing on sectors such as artificial intelligence, financial technology, and internet companies, among others. And all of the sectors that follow the innovation theme that Cathie Wood has become known for. On the financial technology side, the fund is expected to invest in companies that develop and use blockchain technology and also may have exposure to cryptocurrencies such as Bitcoin. This also opens the door for Cathie Wood to invest in many more companies in these innovation sectors that are private and in the growth stage. This is a big move for Ark Invest, which manages a family of actively traded ETFs. According to the SEC filing, Ark Venture is set to be a closed-ended interval fund, which is a type of investment strategy that does not trade on an exchange and periodically offers to repurchase shares from its investors. A spokesperson told me that the fund is currently under the review by the SEC, and we'll get more information on that once that review process is over. Brian?
Really interesting, Alexandra. I mean, obviously, Ark really wants a win here, but the focus on these private securities and the fact that this is a closed-end fund is really interesting. Why might Cathie Wood be interested in what might be a bit more of an illiquid market?
Well, this move comes during a challenging time for Ark Invest's other funds. Ark Innovation, the firm's flagship ETF, has lost more than half of its market value from its peak as investors brace for rate hikes and dump these type of high-risk assets that Cathie Wood is known for investing in. And it's also seen massive outflows by investors. The Ark Venture Fund will focus on illiquid or not easily tradable securities, which will limit investor exits during times of volatility like we've seen. By locking investors into these private assets, they'll have to stay the course for a longer time horizon, and they won't be able to exit during times of market turbulence. And the SEC filing says, quote, shareholders should not expect to be able to sell their shares regardless of how the fund performs. Brian?
Okay, I'll pick it up from here. Alexandra Semenova, thanks so much for bringing us that story. Coming up, Black Rifle Coffee Company getting a jolt as the coffee company goes public on the New York Stock Exchange through a SPAC deal. We're going to be speaking with the CEO on the other side of the break. We'll be right back. Veteran-owned coffee maker Black Rifle Coffee Company is getting a big jolt on its first day of trading. The company going public via a SPAC merger on the New York Stock Exchange and ringing the opening bell, and you see the stock there up more than 20%. Black Rifle Coffee is an all-American brand devoted to causes helping veterans and first responders around the country. The company is also pledging to hire 10,000 veterans throughout its business. Let's bring in the CEO and founder of Black Rifle, Evan Hafer. Evan, great to have you on today. Congratulations on the listing. I'm curious first to get the timing of all of this. I realized you're de-SPACing today. You've come to market through a SPAC merger, but this is kind of a choppy time for a lot of companies to consider coming to the public markets. What drove this decision and why now?
Well, you know, I've been at this for about 8 years. I started this company in my garage 8 years ago, been able to build this as a mission and purpose first business for the last 8 years. This is a promise that I owe to the customers, which is continue to evolve the company and continue to push forward to hire 10,000 veterans and serve, I think, the finest cup of coffee in America for the people that continue to serve and love this country every day. So, this was a promise that I made several years ago. This just is a commitment to fulfill that promise. We know the market's choppy. We don't pay attention to the conditions right now because we're looking at this company 10 years, 15, 20 years down the road. It's never going to be a great time. There's never going to be the perfect time. Today's the perfect day for this. I'm super excited. Couldn't be happier with the New York Stock Exchange.
Well, tapping the public, it's Brian here, by the way. Tapping the public markets is a good way to do some fundraising. You have your partners, Silverbox, Engage Merger Group, and I think Engage Capital LLC as well. What do you hope to use the proceeds for? Is the idea to kind of increase your brick and mortar? I know you want to take on Starbucks. What are you planning on deploying the capital for?
Well, I don't really look at the competition out there. We're not going head to head necessarily with anyone. What we're doing is we're going out trying to really service our customers in unique areas of the United States. We look at building and expanding our outposts, which is our coffee shops across the United States. We're really trying to find those communities that are actively connected with the veteran, military, and first responder communities in America. I think we're building a unique experience for all of our customers. So, as you know, we built this on a subscription-based business, but now it's about bringing the brand to life in all of the communities across the United States. So that's where we've earmarked the funds. That's really what it's about, is getting closer to our customer, getting more connected, and continue to serve them, I think, the finest cup of coffee in America.
There's obviously the coffee side of the business, which is your core, but like it or not, you've kind of been placed in these culture war discussions, if you wanted to call it that. Starbucks of the right, and that's kind of what your company has been dubbed as. Do you embrace that? Is that what you want people to think of when they see Black Rifle, or are you looking to kind of expand this beyond a specific segment now that you're a public company?
I don't really pay attention to how others define my company. The company defines itself. If a section of the society defines us as left or right based on the fact that we openly love our country and we celebrate America every day, we celebrate service members and those people that love their communities around the United States. I hoist flags in front of my coffee shops every day. I've never turned away or been shy about my passion and commitment to this country. I took an oath to the Constitution when I joined the Army to become a Green Beret over 20 years ago. I'll never stop loving my country. I'll never stop loving my communities. And if people want to put me to the left or the right because of that, that's up to them. It's not me.
And I think as a public company, I mean, you might be getting a little bit of scrutiny either way for some of these news headlines. But when you think about your business as an underlying coffee business, I mean, what is the importance of a cultural factor there? Because I think even all coffee shops would agree it's a gathering place, it's a community. I mean, So how important is that? Because people might just be looking at your business model and saying, well, it just has to do with the margins on your coffee, but it's got to be more than that, right?
It's all about the customer. It's all about culture. I built something where people can celebrate service and gratitude to the country and to their communities. So when you walk into a Black Rifle Coffee, you're going to see police, fire, military, people that go to work, get up, and hardworking blue-collar folks around the United States feel really comfortable because that's where I come from. And we've really built that atmosphere, the culture around being able to celebrate and love our country and share those things together. It's a very special place. It galvanizes our customers across the United States, not only through our subscription, through our ready-to-drink products, and then now through coffee shops. We've really created a special and unique environment, and that's always been my dream from the beginning, from roasting coffee in my garage until now. I still love pulling shots for my customers in the coffee shops across Texas. I was just in Temple, Texas last week pulling shots for customers and talking to people that work, the baristas, the people that are working in the coffee shops. I love it. I love getting in there, rolling up my sleeves and connecting with customers across the United States. So this is just a continuation of my passion for my customer.
And then lastly here, you have made an announcement, your company's made an announcement that you're going to double down on Joe Rogan with the kind of partnership and putting some of your ad bucks over there. A lot of companies might say, I don't really want to touch that issue right now, given some of the news headlines around how they're dealing, how Spotify is dealing with his podcast. Why'd you decide to make that move here? And again, especially as being a publicly traded company, that's going to get a lot of attention.
Sure. Joe's a friend of mine. He and I have been friends for several years, even before we developed an ad partnership. He's not just an ad partner. He's a really close and personal friend of mine. The controversy around his podcast, we don't necessarily pay attention to it because a lot of it is white noise. I understand, there's different aspects from the conversation, but, as a fan of his show and as a guy that's been listening to Joe, he's created exponential value throughout my community for veterans because he's been able to explain very complex topics and give people a platform to discuss very complex issues. So I don't shy away from that. I don't leave my friends over what I think are ultimately speed bumps in a very long road. So there's really no deterring for me from that.
Evan Hafer, Black Rifle Coffee Company CEO, thanks again and congratulations on the offering.
Thank you very much.
Coming up on the other side of this break, are you looking for last-minute tickets to the Super Bowl? Well, it's going to cost you a pretty penny. We're going to break down what $55,000 tickets could get you at the big game this weekend after the break.
We won't tolerate racism. We won't tolerate discrimination. If there are policies that we need to modify, we're going to do that. And we will absolutely do it. If we've seen evidence of discrimination, we will deal with that in a very serious way.
That was National Football League Commissioner Roger Goodell. And normally when the commissioner speaks before the Super Bowl, it's to pump up the big game. But obviously because of the Brian Flores, the former coach of the Miami Dolphins, allegations, a lot of things in focus for the NFL that they need to sort out. So for a little bit more on this, Let's bring in Yahoo Finance's David Briggs, who's been following this story very closely. David, obviously, the focus of that clip that we just played was really about the issue in minority and black coaches like Brian Flores perhaps not getting a fair look when they're interviewing for head coaching jobs. Give us an update on what the commissioner said yesterday and how the NFL plans on dealing with these allegations.
Good to see you, buddy. Yeah, so Roger Goodell, almost the entire press conference, the State of the State, was dedicated to Brian Flores, was dedicated to some of the accusations made about the business model of the league. Almost nothing throughout this hour on this game, which is certainly not what Roger Goodell wants to be talking about. He did say, I bear some responsibility for the problem that we find ourselves in. He acknowledged that we have not done enough to address the lack of black head coaches in the NFL. But we have to remind you, Roger Goodell works for the owners. It's not the other way around. I hate to break this to people, but there is almost nothing Roger Goodell can do to solve that problem. We thought the Rooney Rule would fix it, which requires minority interviews for both GM and head coaching jobs. It's been an abysmal failure. There are fewer black head coaches now than there were when that rule was instituted. Here's the fact of the matter. There's just nothing we can do unless there's discrimination seen in the interactions, in the emails that may or may not get turned up. That's if Congress gets involved. Nothing Brian Flores pointed to in his lawsuit, and I've read all 58 pages, actually backs up the fact that there was discrimination. Take into account that he got a head coaching job, didn't get it done the way his owner wanted him to do. And quite frankly, Brian Flores would have had another head coaching job, probably in Houston, if he had not been suing the league. This is not what anyone wants to hear. Roger Goodell said they're going to do more to try to address this problem. I'm just afraid there ain't much he can do about it. He cannot tell the owners what to do. His job is to get them rich and to continue to grow the game and the revenues and the television ratings. And he's been an unparalleled success in that regard. There will not be a mandate that they hire minority coaches. There cannot be. You know how well that word mandate goes over with a bunch of older, conservative, white billionaires in this country. Hopefully over time, we will just solve this problem, but that means more black head coaches at the lower levels getting into the coaching profession. There aren't that many at the highest ranks. That means more need to go into the profession, and hopefully the Fritz Pollard Alliance and some of these other groups. The one thing I was watching for, Brian, ahead of the Super Bowl, would the players start to weigh in and criticize the league and support Brian Flores? And that silence has been deafening. If you heard of Patrick Mahomes, a Lamar Jackson, some of the faces of the league talk about it, it'd be a huge problem. They haven't said a word.
Why do you think that's the case?
I think largely speaking, they love this game. They know that they can make Patrick Mahomes, for example, $500 million contract, the highest contract in all of professional sports. They know that this game is beyond healthy. They know that this is a great opportunity for a league that is almost 70% players of color. They don't want to do anything that disrupts that business model. The NFL is largely speaking bulletproof. It doesn't matter what the scandal is. Go back to the Aaron Hernandez situation years ago, the concussions, the CTE, the lawsuits. This league can withstand anything. It is entirely bulletproof. Roger Goodell knows that. I certainly do believe that NFL clubs are urging their players to stay out of this situation, but I have heard nothing to back that up. That's just my assumption. There has been no email from league officials or team officials telling players to stay out of it. They just haven't jumped into this at all because, quite frankly, though the numbers are bad, just 5 minority head coaches out of 32 teams and just 2 black head coaches, again, there is nothing inherently showing discrimination. There are sham interviews because of this Rooney Rule. A lot of those sham interviews elevate these guys to levels at which they would not have had otherwise and do end up getting head coaching jobs. I've heard some saying we need subjective standards so we know why a guy didn't get a job despite his resume. Well, that's just not how it works in this world. Unless you're in that interview, unless you hear the way that head coaching candidate interviews and convinces them and inspires them in that room, this is something that's going to take several more years to address. It's going to come with very slow incremental change. Don't expect it to happen overnight. Goodell also said he'd love to see a minority owner. The only team for sale right now is the Denver Broncos. They will go for north of $4 billion, the highest price in all of professional sports. There's just so many people out there that can raise that kind of cash. Byron Allen is the one we've heard thrown about. In my estimation, he doesn't have the kind of money to make that happen, to offer a competitive bid. I know the league would like to see a minority owner. It's just very difficult to accomplish.
And Dave, kind of underscoring your point earlier about how, look, the NFL is still making money here. Tickets for the Super Bowl, record levels, right? $7,500 a seat is the average. That means I won't be going. What's the trend in the prices of the tickets for the Super Bowl?
I've been saying since the very beginning, the headlines have all said the most expensive ticket in Super Bowl history. And for the time being, that is true. But watch the markets, and I think you're going to see the same thing with ticket prices. I think this is going to be Deflategate 2. You're going to see that price collapse in the next 2 days. I've already seen about between $1,000 and $1,500 drop in the buy-in, which is the cheapest price of a pair of tickets to the Super Bowl. It was around $5,000 48 hours ago. It has fallen on the NFL ticket exchange. You can get there via Ticketmaster to $3,400. That ain't cheap. That ain't cheap, but it is dropping because there's not a lot of demand out there for the Super Bowl. California was expected to be a huge market with the Rams in it, and with SoFi hosting this game, it hasn't been. And the Bengals haven't generated, they're only 10% of ticket prices right now, of ticket purchases. I think you're going to see a huge collapse in this ticket price in the next 24 to 48 hours. If you want to go, get yourself a plane ticket. Don't buy a Super Bowl ticket. I know this is hard to do, but until Saturday, I think you'll see another $1,000 drop in the next 24 hours. You'll still see some ridiculous numbers put on the board, like a $55,000 per ticket pair of seats in the VIP section, around 100. You're always going to see those huge numbers, because what that is people that have those tickets and they say, hey, let's throw a stupid number out there. We want to go to the game, but if someone's going to give me 110 grand to sit home and watch it on my 80-inch TV, I'll do that. But that's not a serious ticket price. Not many people, aside from Antonio Brown, pay those outlandish prices. So you'll see those stay high up until the very kickoff. The low end is what to keep your eye on, and those will continue to fall.
55,000. At that price point, they better let me throw a ball in one play at least. That's a ridiculous amount of money to be paying for one ticket.
Yeah.
Dave Briggs of Yahoo Finance, thanks so much.
All right, buddy. Thank you.
Well, don't miss our special coverage of the big game tomorrow at 12 p.m. Eastern on Yahoo Finance. We'll be speaking with Los Angeles Mayor Eric Garcetti and FanDuel CEO Amy Howe. You won't want to miss that. But coming up on the other side of this break, inflation surging to a 40-year high as pandemic-related supply woes and probably a lot of demand push up prices. White House Council of Economic Advisors member Jared Bernstein will join us to discuss next. Welcome back to Yahoo Finance Live. Just after the noon hour here on the East Coast, let's take a look at where markets are trading. The S&P 500 down 0.3%. The Dow also seeing some red, down 0.25%, as is the Nasdaq. So red across the board after that big inflationary print that we had gotten on the consumer price index this morning. Again, as a recap, the numbers at 8:30 this morning showed that there were price changes on a month-over-month basis between December and January of 0.6%. That was above the street's estimates. And on a year-over-year basis, inflation clocking in 7.5% higher between January of this year and January of last year. So let's get a little bit more color on the inflationary picture with Jared Bernstein, White House Council of Economic Advisors member down in D.C. Jared, it's great to have you on the program this afternoon. A simple question here, I guess. Was the number that we got this morning above your expectations?
Well, it was slightly above market expectations, but we're in a climate where we know American households are facing significant price pressures. And that is something that we knew well before this print. And for us, it just means we have to continue to do everything we can to hit the president's top two economic priorities. The first is to create and continue to maintain a strong, growing economy with lots of job offers. And the second is to lower prices that households are facing from this global problem of inflation related to the pandemic. That takes us right to our agenda to help unsnarl supply chains, increase competition, make sure that we're doing what we can to lower costs, prescription drugs, healthcare premiums, education, child and elder care. All of that are key parts of our agenda, underscored by these results.
Jared, one challenge here is that the inflation is broad-based across all the categories. And I know that there have been some proposals for what the White House can do, for example, suspending the federal gas tax. But gasoline actually went down by 0.8% on a month-over-month basis. How will things like that address the fact that inflation is spread into nearly everything?
Well, I think when it comes to the broad inflation mandate, first and foremost, we're really talking about the Federal Reserve. And this president has consistently underscored his faith, not just in the institution of the Fed and the critical importance of their independence from the White House, but also that of the five nominees he has slated to be on the board. And again, he has deep faith in their ability to achieve full employment at stable prices. I think when it comes to the categories that you mentioned, our goals remain very much the same. We know that supply chain snarls have been implicated in prices, elevated prices, especially on the goods side of the equation. And that's why our interventions at the ports, moving to 24/7, making sure goods are getting from ship to shelf, dwell times of containers down about 30% from their peak. And in fact, 20 to 30% more throughput is going through the ports. We just have very strong demand there, and that's creating some of these price pressures.
Jared, energy, clearly a big pain point. When you think about year on year, a 27% jump, gas is up 40% year on year. We heard Jen Psaki say earlier this week that all options are on the table in terms of this specific issue. Does that include another coordinated release of the petroleum reserves similar to what we saw last year?
Yeah, it's a fair question. Let me give you a fulsome answer. First of all, last year, just to remind listeners, the president coordinated with other countries that also have strategic reserves to do a global release. And lo and behold, the price of gasoline fell about 10 cents per gallon. Now, it wasn't just the reserve release. There are a lot of other dynamics. It's a global price, lots of moving parts. But that option certainly remains one that we can put on the table as need be. We also have diplomatic channels we continue to pursue with oil-producing countries on their proposed production commitments. And the president is also consistently invested in protecting consumers from any kind of abuse. We have volatile markets, but to the extent that any firms are exploiting any volatility to extract profits from consumers, that is not okay with this president, and he will continue to press on that option as well.
And finally, Jared, where does the White House stand right now on removing tariffs on imports coming in from China? I realize those cost increases that come with the additional tax coming in on imports, that doesn't get you to 7.5% inflation we're talking about, and yet it is still a cost increase. We saw the president already extend the solar tariffs. Could we expect additional action on the other Chinese imports?
You know, it's a great question, but when it comes to an issue like that, I'm not an independent actor, and I'm not going to lean over my skis and speak for myself. There's an ongoing process, and it involves many components, not just the executive office of the president, but also, of course, the U.S. trade representative. So we are continuing to discuss precisely those kinds of questions, and when we have a readout, I promise to come on and talk about it.
All right, we'll definitely have to do that. Jared Bernstein, White House Council of Economic Advisors member, thanks for stopping by.
My pleasure.
We want to shift gears now to the Disney earnings that we got after the bell yesterday, beating on both the top and bottom lines. Shares of Disney now up over 4%. Obviously, the big number, 129.8 million paying customers at year's end, but obviously parks and a lot of other businesses in focus as well. So let's bring in Tim Nolan, Macquarie media tech analyst, who's been following this very closely. Tim, it's great to have you on the program this afternoon. Wanted to ask you just about the overall story for Disney, because on a 2-year basis, the stock has still kind of gone sideways here. Is the pop up simply because of maybe some of the depressed expectations over how fast they could onboard people on Disney Plus?
Yeah, I think the stock took a bit of a spill when the company guided a quarter or two ago to a more moderate pace of Disney Plus subscriber additions. That seems to be the focus of most investors. And so the results that we got last night, I think, just countered that completely. I mean, Disney Plus added nearly 12 million subscribers globally, including 4 million in the US. So, you know, a much better number than Netflix reported. And I think it shows that Disney Plus is really back on track. That's largely due, I think, to a combination of some new markets that they're launching in, a few Asian markets in the December quarter, more markets coming in the coming fiscal 22 and fiscal 23 years, and then the timing of content releases. You know, you had that Beatles special, you had the Boba Fett Star Wars on Disney Plus, and I think that attracted a lot of subscribers.
You know, Tim, when we talk about how things could play out this year, I mean, the hope is that the pandemic, the worst of it is behind us. This is kind of the first full year of production, or the slate of production they hope to get across. How concerned are you about the costs adding up on the back of that? Yes, Disney Plus had really strong numbers, but this is just a content business, so you got to spend and spend. I mean, how are you thinking about that cost element?
Yeah, well, it's called the streaming wars for a reason, isn't it? It's a war to gain subscribers, and to get subscribers, you have to spend a lot on content. It sometimes feels like, you know, a lot of these companies, all these companies with streaming direct-to-consumer services, are kind of stumbling over each other to brag about how much they're spending. Disney gave the number on their call last night of $33 billion in content spending in fiscal 22, a third of which is sports, of course. ESPN has expensive sports rights. And they also spoke about increasing pace of investment, particularly in the upcoming quarter, their fiscal Q2, now the March quarter, where they're going to be spending an incremental up to $1 billion for direct-to-consumer streaming content. Now, we did know, conceptually, that this was coming, because they had told us previously that they were going to be investing a lot in content for a big release slate to come starting around summertime, which corresponds with some new international market releases. So it's all very well planned out. A little bit of COVID production disruption, of course, last year, leading to some extra catch up now. But it's really not a surprise in general when you think that the company has said and has stuck to its message that fiscal 22 will be the heaviest year of content investment. After which the investment should be easing up, and they should get to break even on the streaming service investment process by fiscal 24. So it really is part and parcel of the entire streaming wars. We've said for a long, long time, Disney is the one company that is in absolute pole position here, given the brand strength, given the huge library, given the popularity of its content, and this amazing run of content that they're coming out with now over the next couple of years.
Yeah, certainly. I mean, the brand with great power comes great responsibility, as the Spider-Man movie once noted. But I want to ask more about the movies because the in-theater experience was something that Bob Chapek really doubled down on, right? He was saying in the earnings call that that's going to be our North Star, and they really cleared through the Omicron variant when they released Spider-Man No Way Home. So what do you see as the importance of the in-theater experience for Disney?
You know, Disney has, like many of its studio peers, has experimented with, putting some first release films directly on their own streaming service. Disney has gone a step further by charging, $20 in addition to, the Disney Plus fee for several of these films. But at the same time, they've kind of taken advantage of the COVID situation when people were stuck at home to do this kind of experimentation. I think the message has continued, though, from Disney that the in-theater experience is very important. I mean, just financially speaking, it's a great way to generate interest in the film, which can then lead to follow-on viewership or people that missed it in theaters to then watch it now on the streaming services. So I think they still are committed to providing films in cinemas for people to go to. And as you mentioned, the Star Wars film, I forget what the current number is. The global gross is, I think it's approaching $2 billion or something like that. So there is a real appetite still for consumers to go to the theaters, and I think Disney is still very much behind that.
All right, Tim Nolan, Macquarie Media Tech Analyst, thanks so much for stopping by. We'll have you on for the next round of earnings.
Thank you.
All right, well, let's switch gears now to some trending tickers. Obviously, a lot of companies having reported earnings, so Yahoo Finance's Inez Ferre has been on the case following all of them. Inez, give us the update on what are the big movers on this Thursday.
Yeah, the big movers that we're watching are PepsiCo and also Coca-Cola after the companies announced their quarterly results. And bottom line for these companies is that you will be expecting to see price increases, but they are treading carefully around these increases. So let's show you what the results are. Let's first start with PepsiCo, with its adjusted earnings per share coming in at $1.53. Its revenue coming in better than expected. Organic sales are expected to rise 6% this year. Hugh Johnson, PepsiCo CFO, spoke to Julie Hyman and Brian Sozzi earlier this morning, saying that with levels of inflation in commodities, we will have to raise prices. You'll see pricing up a bit. We're in a place where we should be able to keep our margins well intact for the year. Moving on to Coca-Cola, you'll see the results there on your screen with adjusted earnings per share coming in at 45 cents. That beats street estimates. Its revenue also beats street estimates. CEO James Quincy said that the next phase of the price increases will be harder. And he said during the earnings call, while it's easy to respond to inflation by putting up the prices, there is clearly, as there is broad-based inflation, going to be a squeeze on real incomes in a number of countries. He said, we do not want to lose customers. But overall, when you're talking about these companies, they are seeing costs of input costs going up. They are seeing the cost of commodities rising. Their operating costs are going up. Transportation is going up. So they are expecting to increase prices, but they are treading carefully around those.
And as a quick follow-up, I just wanted to quickly highlight Mattel. Shares are up almost 10%. Do you have any commentary on kind of what they reported earlier?
Yeah, so Mattel beat on the top and the bottom line for its latest quarter. And in fact, those shares are up and are set to close at their highest level since April 2017. The company said its turnaround is complete. It's now in growth mode. And you have some positive commentary from analyst BMO Capital saying that the outlook for 2022 and 2023 was confident and robust. And Mattel's CEO, Ynon Kreiz, he spoke to Brian Sozzi earlier this morning. He said, as for inflation, as for prices, inflation is a factor, but the items, toys, are accessible. Take a listen.
We did raise prices in the third quarter of last year, and it is one of the options we consider given these times of inflation. But when we raise prices, we always keep consumers in mind. We are being very thoughtful and are committed to maintaining the highest quality and the best value for consumers.
And he said that demand for toys, yes, COVID has played a part in this, but the industry has been growing over the last 10 years, and he expects it to continue growing beyond COVID, that people will continue to prioritize their children and they will continue to be buying toys for children. And even if prices go up a bit, those prices are still accessible.
And Desiree, thanks so much for breaking that down for us. Coming up, a conversation with the CEO of Sonos. Shares of the company soaring on another strong quarter, even as it tries to navigate some of those supply constraints. Patrick Spence will be joining us after this short break. Well, we are seeing shares of Sonos popping in this session after the company beat estimates on earnings. First quarter revenue for Sonos came in at $664.5 million. Speaker revenue fell just slightly because of supply constraints, but the company saw strong performance from its system components, including port and amp devices. Let's bring in the CEO of Sonos. Patrick Spence is joining us today. And Patrick, let's start right there with the supply constraints, a conversation we've had before. Where do things stand for you right now, and are things improving?
We definitely navigated what I think is probably the toughest quarter I've seen in the last 20 years. And we were able to successfully navigate that and deliver more for our customers and exceed expectations, which just is a testament to our amazing team and the work that they've done. And I do think that the worst is behind us. It'll get better progressively over the year. But I think the other thing is we've navigated it better than most companies. Again, the outstanding work of our team. So that gave us confidence, given the demand we're seeing, and as well our ability to navigate that to increase the midpoint of our guidance for the rest of the year. So we're feeling good coming off what was a very challenging quarter.
Hey, Patrick, Brian Chung here. I know what might be supporting that guidance is the price increases that you implemented. I believe it was back in September. But tell us about the elasticity that you have for perhaps future price increases, because 46% of your existing households came back to add another Sonos product. Obviously, the ecosystem very strong there. Do you feel like you have more flexibility around those price points, or you worry that raising prices more might get people to start turning away?
Yeah, Brian, you hit on one of the most important things that really powers, the unique thing about Sonos is our business model. We're not a one and done kind of purchase company. What happens last year, 46% of our existing customers came back and added an additional product, right? And that's incredibly powerful. Our average home is now up to 3 products, but we believe that can grow from there, into 4 to 6 products over time. And they tell their friends and family all about Sonos, and that generates new homes, which then come back and buy more over time. So we have this amazing flywheel and business model. And, over the past 10 years at Sonos, we've increased prices 3 or 4 times, and our customers continue to buy. And like you pointed out, we anticipated this inflation. I don't think anybody, was surprised by today's inflation read. We all knew that was coming. So we did increase prices. We try to always strike that balance, right? As you hear from most companies in terms of trying to find that right price point where we're delivering as much value as we can for our customers. We're driving that innovation all the time. We did that in anticipation of some of the costs going up and some of the things that we're seeing. And so we're very well positioned right now. And the consumer is really strong. Like, we have a backlog. We could have sold a lot more in the quarter. And so our customer seems to have a lot of strength right now.
Patrick, I want to get back to what you said earlier about this being, one of your toughest quarters. I think you said the toughest quarter. I mean, what's unique about all of these headwinds that have formed? We're talking about price increases, supply constraints, trying to figure out whether, in fact, you pass it down to customers. I mean, you talk a bit about that and how what you're seeing right now is so unique when you compare it to some of the other challenges you've experienced within your company over the years.
Yeah, well, I think having been in tech and tech, really smart hardware for 25 years, we just saw with the pandemic, right, it was such a startling moment where a lot of manufacturing and component generation kind of slowed down. And then all of a sudden, because people continued to buy, it all ramped back up, right? And so hence the inflation we've seen, hence all the supply chain challenges that we've seen. And so that's why I say this particular quarter, and it's different for different companies, we navigated it better than expected, but it was just super challenging in terms of trying to get the components, the container shortages, the port congestion, COVID, right, at manufacturing facilities and through the supply chain. And that just made it incredibly challenging. And why we're so pleased that we were able to navigate it and actually get more to customers, because that's the most important thing, is that we've got all these customers that want more product, and our channel partners as well, our retailers. And so we're trying to do that. And that's what we're really working on every day. But we feel like, the worst is behind us on that front. But it is, as you said, been the most challenging period that we've seen. And I've just been so pleased by the kind of innovation and as well the work that the team's done to make sure that we can navigate it.
Patrick, what kind of social trends do you see also driving some of the trends you're seeing in the business? Because, people moved a lot during the pandemic. I moved during the pandemic, and the first thing I thought of when I moved in was I got to get some speakers to supplement this terrible speaker in my flat screen. So is that also driving some of the momentum that you've seen? And, given the Omicron variant fading now that people are settled into maybe places that they've moved into, is that actually going to be perhaps a headwind to your business?
So we really see like 3 big macro trends that are helping, kind of fuel our growth for, let's say the next 5-10 years. One is the golden age of audio. So we're seeing, podcasts exploding like crazy, more streaming music. We're seeing, TikTok shaped music. So a lot's going on in audio in general. And so there's more listening happening. And obviously that's where we play. You hit on something with TV and a big trend, Hollywood at home, right? You hear Disney investing $33 billion this year in content, Netflix $20 billion. Those numbers are only going up. There's only more great content that's going to come to your home. And if you want to enjoy that content in all its great audio fidelity, you want Sonos. And then finally, work from home is a trend, Brian, that I think is going to last for a long time. We're seeing more and more companies and more startups, right, as a result of all of this. And they're saying people can live anywhere. And we're seeing more people leave the cities. I don't think that's a one-time event. I think it's a really big macro trend that happens over a number of years. And if you're working at home, one of the things that you want is some great sound in your house. And, if you're alone, you want some music, like all of these things. And so I think that is something that's really going to power our growth over the coming years.
Patrick, you want to come on to be our analyst for Netflix and Disney next quarter? Sounds like you're eager to talk. Man, you had those numbers ready. But Patrick Spence, Sonos CEO, congrats on the quarter, and thanks again for stopping by. Well, coming up on the other side of this break, former Today host Katie Couric joins Yahoo Finance's Influencers with Andy Serward to discuss the modern media business. We'll have that interview as the news veteran expresses concerns over streaming news services like CNN+. That conversation straight ahead. In this week's episode of Influencers, our editor-in-chief, Andy Serwer, spoke with former Today host and former CBS Evening News anchor, Katie Couric, for a conversation about the challenges of navigating the modern news business as CNN ramps up its plan for a subscription streaming service. Let's watch.
It's just another way to provide interesting content to consumers. It'll be interesting to see if people are going to pay for those services when there is so much news everywhere. I mean, I'm just inundated with news 24/7, and a lot of it is really high quality. I was just reading a great piece this morning on Joe Manchin in the Rolling Stone that someone brought my attention to. So I think it'll be an interesting experiment to see if people are going to want that content. Will they want to see Chris Wallace doing interviews? I'm not sure. Maybe hardcore Chris Wallace fans will, but it seems to me that there is so much news. It's so ubiquitous now that they're going to have to provide something that is really unique. And I think they're trying to do that with sort of the model of Anthony Bourdain, which, was established on CNN many years ago with Eva Longoria. I just don't know at what point, I guess, is it content overload, Andy? Is there just so much to choose from? Will the cream still rise to the top? Probably, but will it be enough to sustain some of these newer business models? I'm not sure.
Right. And then ubiquity is both a blessing and a curse from the consumer standpoint, because there is so much out there, but then how do you choose? And so I'm sure you're asked this question, Katie. People ask me all the time, what do you look at? What do you read? And how do you decide what to look at when there is so much stuff?
Well, I do rely primarily on newsletters and on Apple News. And, I remember when I was at Yahoo with you, Andy, I begged for them to let me start a newsletter that would basically go straight to people's inboxes and help kind of curate the things they needed to know. They weren't interested in that at Yahoo for a variety of reasons, which we can talk about later, and sort of what Yahoo's ultimate business goals were at the time. But I read a lot of newsletters. I try to read The Economist. I look at Time Magazine. I read the New York Times, the Washington Post. I read various newsletters from reporters from those outlets. I read the Poynter Institute. Tom Jones does a media newsletter. The Pew Research Center does kind of what's going on in media. I'm interested in kind of looking at trends. I read The Information by Jessica Lessin. So I really try to get a good cross section of helpful and useful information. And sometimes I just look at Apple News and see what's trending and if there are articles that I'm interested in. I feel like I really get a good sense of what's going on in the world with the amalgam of sources that I turn to.
It's almost like a full-time job, though.
Yeah, it is. And
I mean,
I think I did something with the New York Times with the Buy the Books section. And I said, I could spend 5 hours in bed in the morning reading everything that I either find or that is served up to me. And that's one of the reasons I wanted to start Wake Up Call is people don't necessarily have time to be glued to their phones. It's not particularly healthy for them to be so attached to their devices. So by curating some interesting things they need to know, I'm providing almost an old-fashioned newspaper in the form of a newsletter with consumer stories, with important news stories that they need to know, using other sources, doing original reporting with our incredible staff on Wake Up Call. So, I think that what's missing is what we had in the old days, and this is good and bad news, Sandy, is somebody to actually edit content, to prioritize things through, how important they are to help kind of illuminate certain topics. The problem is back in the good old days, there were a lot of voices that were not heard, and it was the domain of, primarily white men. And so the idea that all these different voices now have a platform is a really positive development.
Yeah, there's a lot to pick up on there. I want to especially talk about the tech companies. You mentioned Apple News, but I do want to get into going there. You talked about white men dominating the media business. So that's a bit of a segue into your book. Your book is so candid. I really enjoyed it. And I could see how things were cherry picked out.
Yeah.
Where it came out. I got it once I read the whole book.
Right. That was frustrating, but that's unfortunately kind of our modern media environment. You know, people are trying to get clickbait. They're trying to get engagement through enragement. They're trying to get people to stay on sites to, as I said, click things. And as a result, I think things are distorted. You know, this is a tale as old as time, at least as old as the internet and perhaps even newspapers. But I think it's much more obvious online is that, you know, the headlines often have nothing to do with the content of the story, or the story itself is so twisted so to attract eyeballs and viewers and time spent, you know, on said platform. So I think it was really actually an interesting object lesson in how the media environment works today, at least tabloid media. I can't say that all media does it, but it was frustrating that even mainstream media, people who hadn't read the book would then repeat what was on the tabloids or what was in the tabloids. And that's just, unfortunately, when you're a bold-faced name, that happens.
A record 31 million Americans are expected to place bets on the Super Bowl this weekend, with the American Gaming Association forecasting more than $7.6 billion in wagers. But for those looking to gamble on the big game, there may be a big surprise waiting for you in the form of taxes on the other side. Let's bring in Susan Allen, American Institute of Certified Public Accounts Senior Manager, and she's joining us today as part of our Taxes Made Simple series presented by TaxAct. Susan, what do people need to know ahead of their big bets over the weekend? Obviously, we've seen sports betting grow in a significant way during the NFL season, but what are some tax implications they should be thinking about?
Yeah, well, I think when it comes to gambling winnings, no matter how you earn it, where you earn it, how much you earn it, it is taxable income. It will be reported when you file your individual return. It's reported as other income. It's subject to taxation like your other typical income would be, whatever marginal tax rate you are in, which could range from 10% to 37%. It would be subject to taxation. So do expect, if you are doing some gambling this weekend and you are that lucky one who won something, then it is subject to taxation. There are some other considerations when it comes to gambling winnings, such as if you earn a certain amount, you could actually receive an information statement, as they call it. It could be in the form of a W-2G or a 1099 miss or a 1099K. And those are important statements that you must have when you would file your return. And it would show exactly how much you earned. It's possible they could need to withhold taxes, which means you would go ahead and pay some of that right then and there. They would just take it out right of your winnings, and they could have to withhold depending on how much you earn. That rate's typically around 24%. And, you get these information statements. It's possible you could just, with certain types of casinos and places, you could even walk out with that information statement right then on the spot, or you might receive that later on, closer to tax time. They're required to come around January 31st. So you could get an information statement. They could withhold some of your taxes right then on the spot. You would be subject to taxation, federal, potentially state consequences as well. And, lots of things to keep in mind, but you can always consult your CPA and such for specific guidance on your situation.
Yeah, Susan, it sounds like a lot of this is new, and that's simply because it's gone online in a lot of states over the last year or so. But it sounds like it might vary state to state. So is it like there's a certain limit by which it will become taxable? And then should you just expect to get a filing form from DraftKings or whatever platform you did the betting on? Or is it something that you have to do yourself and keep records of?
Well, I would always keep records myself, regardless if I got an information statement. It's just the best practice when it comes to anything with your taxes to keep track of everything, keep your records. For gambling specifically, it's a good idea to keep a log of, how much did you earn? What were the dates? Were there any losses or expenses associated with it? Because I didn't mention earlier, but you could potentially deduct some of those losses to offset some of the winnings. So definitely keep your records, keep your logs. And, from a federal perspective, it's sort of how we already discussed. You're going to report it on your individual tax return. It's considered other income. You could potentially have some losses. States will vary a little bit, but many of them will function similarly, and it will start with taxable income.
All right, very important details for people to remember as they bet on the over/under on the big game this weekend. I think it's 4.5 for the Bengals. But Susan Allen, AI, CPA, tax practice, and ethics senior manager, thanks so much for breaking all of that down for us. Well, on the other side of this break, getting charged up. We're going to break down the details of the Biden administration's $5 billion plan to beef up the infrastructure for electric charging stations across the country. That's next. Biden administration wants to award about $5 billion over the next 5 years to improve the national network of charging stations. We are expecting, or it either already started, a press conference with the Transportation Secretary alongside the Energy Secretary to announce this. So with more details is Yahoo Finance's Rick Newman, who's been following this story. Rick, tell us a little bit more about exactly what they hope to do here with that $5 billion fund.
So this is charging stations for electric vehicles. President Biden wants half of all new cars sold by 2030 to be electric. And the problem with that, even though these are gaining in popularity, is we just don't have enough charging stations to make these cars feasible for a lot of people. There are something like 45,000 electric vehicle charging stations in the country right now. That might sound like a lot, but those are clustered in population centers, mostly on the East and West coasts. And there are large stretches of highways throughout the country where there are no charging stations, or there might only be one or two. And keep in mind, it takes about 45 minutes at a fast charging station to fill up your car from zero to full capacity. So a lot of people just will not buy an electric vehicle because they don't think they'll be able to charge it on a long road trip as easily as they can a gas powered car. And they're right about that. So the idea is to get these new charging stations along the highways first, so that you're enabling people to take long road trips and you remove that fear of running out of juice. And then start to focus on smaller areas and some rural areas. But first, hit the highways. That's what they're trying to do here.
And, Rick, when we talk about that goal of 50% of cars or new cars being sold being EVs by 2030, I mean, that requires a massive infrastructure build-out. You've got $5 billion worth of charging stations going out, but some estimates say it's got to be $50 billion if you're trying to build a national network. They have an additional 2.5 to work with if you're talking about how much was set aside in the infrastructure bill. Do we have any idea how that's going to be deployed?
Right. So $5 billion is actually not a lot in infrastructure terms. Keep in mind, electric green energy investments were a very small part of this bipartisan infrastructure bill that Congress passed and President Biden signed last November. Biden wants a lot more in his Build Back Better legislation. A lot of that is for electric vehicles and other forms of green energy. And of course, Congress is somewhat stuck on that. So I guess, Kiko, you could say this $5 billion is a start. There's, as you pointed out, another 2.5 or so behind that. Again, that will focus more on rural areas, but we need more. And another big factor here is that electric vehicles are still too expensive for many people. So Biden wants to get some expanded tax credits for people buying electric vehicles. We'll see if that materializes at all this year.
Yeah, those incentives included in the Build Back Better Act. So we'll see if they decide to finally spin that out to try and get those incentives going. Rick Newman, thanks so much for that.
Okay.
Well, it is the end of the print era, should we say, Brian? For 6 magazines by Barry Diller's Meredith, announcing that they are stopping publishing of the print version of 6 magazines that they acquired last year. We're talking about Entertainment Weekly, InStyle, Eating Well, Health Parents, and People in Espanol. 200 job cuts here announced. Amounts to less than 5% of the workforce. But this is just kind of another sign of the times. We have seen this transition happen for a while. But if you look at magazines like Entertainment Weekly and InStyle, I do wonder what the circulation is now.
Yeah, I mean, this is going to make the checkout aisle at the grocery store look very different. But I guess it's good news that People is still going to be in circulation. But look, on a serious note, this is kind of showing the continued decline of the printing industry. And I think, less so than about the magazines themselves, the brands live on. That's what Barry Diller was really interested in through Dotdash Meredith's acquisition there. But really, this is bad for the printing press industry. Obviously, just the demand for printing is not as high. There's a small family-owned printing press down here in the Lower East Side in Manhattan that is probably going to go out of business because restaurants don't want to print out menus anymore because everyone's using QR codes. So I think broadly speaking, we have to acknowledge there's a whole industry of people that are working that's probably going to be run out of business here. But, obviously the magazines themselves also very much in vogue here. But, they'll be digital. They'll live on somewhere, Akiko. I'm sure people will be able to get that content somewhere.
Yeah, that's a good point, Brian, to talk about the impact beyond these brands themselves. But I have to say, I can't remember the last time actually picked up a newspaper. I have picked up a magazine, but I've been downloading it on my iPad for years now. And so I'd imagine the demand is, or the interest is still there. It's just not in carrying something physically.
Well, in one place where the interest is still there is apparently Costco. This reporting actually is a little bit old from CNN in 2020, but apparently the fourth most circulated magazine in the country is the Costco Connection. It's the free publication that is sent to Costco subscribers. And, look, I consume it for the articles, Akiko. And, there's good content in there. There's a community. I guess maybe where there's community, there's demand for print publications. Are you an avid consumer of the Costco Connection, Kiko?
Well, not Costco Connection. I am a Costco fan. I will not be shy about that. It's hard to go to a Costco when you live in the city, but every time I go visit my parents in the suburbs, I mean, it is a whole event, right? When you go to Costco, you walk in expecting to buy a few things, then you walk out with the receipt that's more than $300. I mean, that's kind of the power of Costco. But I'm curious how Costco Connection competes with Trader Joe's flyer. Is that considered a magazine, or is that different?
I mean, that might be a newsletter, perhaps, because it's more formatted as like a newspaper than it is a formal magazine. But Akiko, I mean, that glowing review that you had of Costco there seems like you're just fishing for a profile from Costco Connection.
Costco Connection. I do not own Costco shares. Full disclosure, but. I love it. I've tried going here in the city, but it's harder. When I lived in Japan, I used to take my suitcase to Costco so I could buy things and bring it home on the train.
Yeah, trust me, the one in Brooklyn you definitely don't want to go to. It's an absolute disaster. But look, I mean, in the print business, or rather the media business, there's a lot of moving parts here. And you have, for example, in the news today, I think CNBC broke it, Binance is actually going to take a $200 million stake in Forbes. CZ, the head of Binance, has taken up a stake. Again, it's not a full ownership, but you do wonder to what degree maybe the crypto world wants to get into the editorial space. Now, of course, that's not to say that Costco Connection is going to get bought by some cryptocurrency. I mean, maybe they do, but a lot of interesting moving parts. A lot of interesting moving parts there,
starting rumors. Costco wants to go nowhere near crypto just yet.
Oh my gosh.
Just yet. Interesting. That's an interesting move, though. And I'd be curious how that all plays out. Binance and Forbes. Seems like increasing coverage on crypto. I mean, we'll be watching. Let's take a look at the markets before we let you go. And we are seeing red across the board. Obviously, we saw the markets turn early on in the session after we got that inflation print this morning with CPI hitting a 40-year high. And we've got the Dow now down 257 points. The Nasdaq down 124 and the S&P 500 down about 41 points. In terms of sectors that we're watching right now, energy and materials, the only ones that are kind of in the green, financials as well. So certainly a lot of pressure there as people digest the latest set of economic data that came out this morning. That does it for Brian and I in these 2 hours. We've got much more to come here on Yahoo Finance Live. Keep it right here. The trend is no friend. January CPI climbing to 7.5% month over month, climb of 0.6 compared to 0.5% in December. Yields spike and stocks tank as the Fed's Bullard calls for a 100 basis points hike by July 1st. Meanwhile, real wages can't keep up. What's it mean for the consumer and the heat on the Fed to act more aggressively as it continues to buy bonds? Meanwhile, Equinox is seeing a surge in members returning to physical gyms. But what does it mean for the at-home fitness model? We asked the company's president how he's working out keeping both groups in shape. And Game Plan. Spot Hero is a digital leader trying to take the pain out of parking. We talked to the CEO about the rising popularity of his product and how it can make getting to the big game this weekend easier if you're lucky enough to go. I'm Karina Mitchell along with Alexis Christoforous. Thanks for spending some time with us this afternoon. Alexis, no way to cut the pain from that inflation data that we got earlier today. Strong earnings from corporate America, not enough to help. The 10-year yield topping 2% for the first time since 2019.
And Karina, that's where I want to start, because heading into this new year, analysts were saying we would see the 10-year yield hit 2% at the end of 2022. Here we are just 6 weeks in. And as you can see on this chart, we've already hit that milestone. Now we have analysts talking about the yield touching 3% by the end of this year. So we've got that hot inflation report. You couple that with last week's strong jobs report, and it makes a pretty good case for the Fed to get more aggressive when it comes to raising interest rates. We know that St. Louis Fed President James Bullard now on the record saying he favors a 50-point rate hike in March. Investors have been whiplashed, though, today. Let's bring up the equity markets for a moment, because initially when this report came out, we saw stocks tank. In the pre-market, they continued to at the opening bell, and then things turned around late in the morning. And now we're back in the red. So just another day on Wall Street. The Dow Industrial is down 269 points right now, with the S&P off about 42. The Nasdaq down 119. You mentioned those earnings, Karina. You know, we've got this parade of strong earnings reports today from big name companies: Coca-Cola, Pepsico, Disney, Twitter. But that doesn't seem to really be offsetting this high inflation news. Want to hand things over to Jared Blickery now for a look at what he has got his eye on today. And busy Thursday. What are you watching?
Yes, that Bullard news just kind of took market participants by a surprise. You can see the Dow is off 240 points, 2/3 of a percent. The Nasdaq off just a little bit more. The S&P 500, I'm going to pull up a chart here of the intraday price action, turned green very briefly, but just for a couple seconds. And here is that downdraft, about 200 Dow points, a few points on the S&P 500 that we saw there from those comments. So March rate hike of 50 basis points, definitely on the table. We've spoken with a number of analysts over the last few weeks, and they seem to think it's unlikely, but maybe today changes the game a little bit. And you have to think that this is probably some kind of a trial balloon. Powell's watching to see the market reaction. If it can absorb this, maybe that's indeed on the table. Here's a 10-year T-note yield. We were just showing that up 10 basis points, 2.03%. Have not seen these levels since 2019. In fact, the middle of 2019, that'd be right in there, somewhere in there, and just marching higher as we speak. And I also want to point out, and this has to do with what the Fed is, or market participants are thinking the Fed is going to do. Fed's Bullard-backed supersize hike seeks 1 full point by July 1st. And now markets are now pricing in a 75% chance of a 50 basis point rate hike in March, and that is up 50 percentage points from yesterday. So here's what was priced into the market yesterday: 25 to 50 basis points. So that would be 1 25 basis point rate hike. 76% odds of that. Those have gone down to 25%. And instead, the bets are on that 50 basis rate hike. So we'll have to see how the markets digest this into the close today, but very important to monitor this. And just take a look at the sector action here. We can see materials, energy, and financials. It's value and commodities that are doing well today in the stock market. To the downside, utilities and real estate, not surprising that they're the biggest losers. They're very interest rate sensitive. Tech, that's also a big loser. Generally, anytime you see a big march up in rates, tech's going to suffer. And then we get staples. Consumer staples is underperforming. That's probably because of earnings. Now, I just want to show the NASDAQ 100 heat map. A lot of red here. We saw some green briefly a couple hours ago, but no more. Apple is down 1%. Amazon almost right there with it. Microsoft off 2%. And I want to take a look at some of our leaders. We were seeing a lot more green this morning, but now we're seeing cannabis. That's MJ, IPOs, Ark Invest, gambling, regional banks, and it goes on. But those are the marginal leaders here today. We've seen some interest pick up in some of these beatdown sectors, but any gains being paired right now. And then do want to take a look at the transports as well. And we can see Delta Airlines, United, each up 2%. So the airlines not doing too bad, but we are seeing some red in the transports as well. I do want to take a look here and see if I just got a redesign of this space. So I'm looking for my heat maps here. Unfortunately, there we go. Here's mobility. So I was looking for those Uber earnings. Uber, a little bit of a disappointment there. They did halt the stock because they announced that they're going to be EBITDA profitable by the end of next year. DD surging here. You can see that stock up 11%, but DoorDash, Lyft down 5% and 3% respectively, guys.
Okay, Jared Blickery, thank you so much. We'll see you a little bit later on. Let's stay on the markets and bring in our guest, Michelle Girard, NatWest Co-Head Global Economics. Michelle, thanks so much for being here with us today. Have to get your impression on this massive CPI read that we got today, a massive surprise to the upside, right? And the gains were broad-based. We saw energy up 27%, used cars up 40%, food higher as well. Is this the worst of it, or is there more pain to come? And what is the biggest driver of this inflation? How concerned should we be about wage inflation right now?
Well, a couple of things. One more month of surprises. I mean, this has been unfortunately the trend that we've seen for many months. And you mentioned, is it over? We actually think you're going to see the year-over-year rate tick higher still in the month of February. So I don't think we've peaked out yet. You mentioned the fact that the gains were broad-based. I think that's the most unsettling part. That's, again, been similar to a story in recent months. It isn't one special factor that's pushing inflation higher. We saw gains, as you mentioned, across the board: food and energy and airfares and used car prices and medical care. I mean, the list kind of goes on. And I think that's something that the Fed is quite concerned about because it's broad-based. The fear is that it becomes sort of well entrenched and then ultimately gets harder to bring back down. So I think there's a lot here for the Fed to worry about, and you see that's what the market is very much focused on.
So how much more pressure is there now on the Fed to act more aggressively? Because Atlanta Fed, Raphael Bostic, said yesterday expect 3 to 4 hikes. And we just had James Bullard from the St. Louis Fed come out and say 100 basis point hike by July, 50 basis points to start the process off. What's your reaction to that?
Yeah, I mean, there's no question that these numbers put more pressure on the Fed, and the markets going into this, coming into today, we're already thinking the odds were almost even about a 25 or a 50 basis point hike, which of course we haven't seen, in the last several cycles. As you have to sort of go back to 1994 to look at the last time that we've seen the Fed act that aggressively, and certainly not as the first move. Now, the comments today from Bullard have pushed that even higher. I thought it was really interesting what Jared said around, is this potentially a trial balloon, and is the Fed chair watching to see how the market will react? I mean, if the markets stabilize while still pricing in 50 basis points, I think the odds of them moving that aggressively out of the chute increase. I don't actually disagree with the idea of 100 basis points by the summer. We basically have rate hikes coming in, 2 rate hikes in the second quarter and then another one in the third. We ourselves were close to, we have 75 basis points of rate hikes in by the summer. So it sounds like a lot, but actually I don't thinking that we'll be 100 basis points higher by the middle of the year, whether it's July 1st or whether it's, we get past the July meeting. I think that that's very much a possibility here.
And then what do you think happens to QT at this point? Because how worried are you about the Fed, making a misstep here and getting it wrong? Like happened back in 1982 when we ended up with double-digit unemployment and a recession. How worried are you about that?
Well, the Fed is trying to act more aggressively sooner so that they ultimately don't have to take rates high enough that it throws the economic outlook into question. That's their goal. And the idea that even ourselves, as we have put in more Fed rate hikes for this year, we haven't really lifted the end state, the end neutral rate, if you will, the idea that the funds rate ultimately ends up around neutral, being the fact that if they can make policy, if they can stem this rise in inflation sooner, then ultimately they don't end up having to risk that 1980s style situation where they had to raise rates so high to really wring inflation out. It ended up causing a recession. So I think the Fed is trying to avoid that scenario. And in that way, there may be some stabilizing, increase ultimately if markets can get comfortable with the fact that doing more now means ultimately the Fed doing less later. But of course, for today, we have to price in just, more Fed rate hikes.
Michelle, I want to go back to some of that CPI data for a quick second and talk to you about the goods versus the service spending. We're spending so much more on goods. We're continuing to do that, but service spending lags behind. When does that sort of catch up, and what's that telling us about the economy and the consumer right now?
Yeah, that's so interesting. That one of the factors that has continued to hinder the spending on services is COVID-related restrictions. And of course, we went through the, kind of the end of the year, early start of 2022, where, we once again had more restrictions on activities, more concern, even just in general, on the part of people wanting to not engage in a lot of spending in terms of going to restaurants or spending on services that would require more face-to-face interaction. So it's really been the strength of goods that have been driving spending. And of course, it's the supply of goods that are being hindered as well. So the supply-demand imbalance is greatest on the good side. And as a rule, we've seen a lot of inflation pressures as a result there. I think the services numbers and potentially more services inflation will show itself as we move into the summer. Clearly, as more now restrictions are being lifted, the weather gets better, people get out. I think spending on services, like we saw last summer, will really sort of have a stronger leg higher. And some of that shift in terms of the composition in spending towards services, I think, will be seen.
So let me ask you, how does this all impact the consumer? Because a recent poll said from Monmouth says that 3 in 10 Americans are worried about paying the bills on inflation. That's more than double it was just 6 months ago. So it's crept up on consumers, but it's hitting them hard right now. Shelter costs are higher. Everything is higher. Food, we're paying more. How long before it hits them and they cannot keep up and demand starts to slow?
Well, a couple of things. I mean, certainly the consumer is feeling the pain of higher prices. And I think that speaks to why the Fed is actually getting a green light from President Biden himself to take whatever action is necessary to stem inflation. And that's unusual. Normally you see if a president doesn't want the Fed to be raising interest rates, he's not going to stand in the way because, the public themselves don't want inflation going higher. They want the Fed to contain it. So I think that's important to point out. And you're right. Normally what happens is inflation or prices go up and people therefore spend less. And that is one of the factors that helps to bring inflation down. It's just odd now because we still have a lot of pent up cash savings still from the COVID times, as well as the fact we've got some pent-up spending. We talked a minute ago about services. So actually, some of the impact in terms of demand may take longer to show itself. And I think that explains why, we haven't seen as quick a response in terms of demand coming off in the face of these higher prices as you might expect. I think it will happen. I think as we move through the summer, we do expect the economy to slow a bit, still be above trend, but kind of come off the burn a bit. And that will also help to take some of the inflation pressures off of inflation.
Yeah, and some of that pandemic savings now drying up. Credit card spending is higher as well. The president is in a pickle, as you say, and the Fed is walking a very tight line. Interesting times ahead for sure. Michelle Girard, thank you so much for spending some time with us on that. And we want to give you some insight about how you can step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-like experience. You can check it out today at yahoofinance.com/plus.
plus. And we've got much more coming up. We are just getting started. The countdown is on to game day as the LA Rams take on the Cincinnati Bengals. But local businesses are hoping they will be the big winners. That story next. Welcome back to Yahoo Finances. Well, businesses near the SoFi Stadium in LA are hoping for a big payday on Super Bowl Sunday. 70,000 fans are expected to attend the game, and preps are well underway. Here with more is Yahoo Finances' Danny Romero. And Danny, I'm sure those businesses are ready, willing, and able for those fans.
Yeah, Karina, there is a lot of excitement from small business owners in the LA area, but this will also be a lot of work for them, serving all of those people. This level of business is something some of them haven't experienced since before the pandemic. I spoke with a cafe owner that is expecting at least a 50% boost in foot traffic. Just take a listen on how they're prepping.
Well,
staffing up.
Staffing, stocking, praying, breathing, trying to keep everybody safe. Obviously, we're also dealing with COVID in the midst of all of it. So just trying to make sure that we're ready to serve our community as well as all the tourists that are coming to town.
And you can hear it right there. Many are expecting, because of the Super Bowl, that they'll be able to kind of claw back some of those losses from the pandemic. A recent report from Microeconomics, Economics Research and Consulting predicts that the city of Inglewood will see a positive impact of $23 million to $52 million, with $900,000 to $1.8 million in added tax revenue. And not only that, but the annual employment gain could be from 350 to 800 jobs.
Hey guys, I know it seems like
economic benefit.
I think we're having some trouble with Danny. We are going to try to get her back. Sorry, Danny, we're going to try to get you back because that's an interesting story, and talk a little bit more about the hiring challenges some of those small businesses are facing. We're going to take a quick break. We'll be back right after this. Welcome back, everybody. Want to bring in Danny Romero one more time, our Yahoo Finance reporter, who's taking a look at the impact small businesses in and around SoFi Stadium are going to have during Super Bowl 56 this Sunday. And Danny, I know you spoke to a few business owners, and we've heard about the struggles to hire enough workers during the pandemic, especially for small businesses. What has it been like for them during this very busy time leading up to the Super Bowl?
Yeah, Alexis, you're right. Employment has been super difficult for small business owners, but because the Super Bowl will be in town, many projected new jobs are actually expected to be in event production and in the hospitality sector, areas where they were mostly hit hard by the pandemic. LA County lost 770,000 jobs between March and April of 2020, but recently hiring has obviously picked up due to those pandemic lockdowns easing up. And now, as of December 2021, the county's unemployment rate sits at 6.2%. And one restaurant owner told me that because of the Super Bowl, she's able to hire at least 15 more staff workers. So definitely it's going to be a big payday, but also a big bonus for these workers as well. Alexis?
Yeah, for sure. All right. Well, we wish them luck as they get ready for all those crowds there at SoFi Stadium. All right, want to move on to the big story of the day, which is inflation, sticker shock in the grocery aisle, where prices are up a whopping 7.4% in just the past year. So is there any relief in sight? Joining us now is Bert Flickinger, Managing Director at Strategic Resource Group. Bert, good to have you here. And I just want to throw up a graphic real quick to show everybody just the impact these high prices are having at the grocery store, because it looks like it's affecting just about every food group. We've got meat and eggs up by double digits, bread up more than 7%, milk up nearly 7%, you name it. So, Bert, the question is, do you think these prices have peaked, or are we going to move even higher?
Alexis, high and going higher. And part of the problem beyond the cost of raw materials is the packaging materials. 80% is made in mainland China. So there won't be enough Lay's potato chips for the Super Bowl, to your good prior segment, because they can't get the inside film to make the packages. And that applies to salted snacks, cookies and crackers, all the way to sports beverages. So prices high and going higher.
So I was looking a little bit closer at this consumer price index today, and we looked at the cost of eating at home. It's actually climbing faster than the cost of dining out. Does that make going to a restaurant more appealing for people, do you think, or it doesn't really matter?
Doesn't matter, Alexis. Full disclosure, our family, SM Flickinger, was one of the 5 largest suppliers to restaurants. And typically, restaurants mark up the cost of the food about 300% and mark up the cost of the beverages 700 to 900%, where the grocery stores only mark it up about 20%. So to go through a McDonald's drive-through window costs an average family with tax for a value meal about $11, so $50 through the McDonald's drive-in window. That same cost through Albertson, Safeway, Kroger would be less than $10 for fresher and better food.
So, Goldman Sachs took a look at the impact all this is having on the average household, and they came up with a figure that it's costing the average U.S. household about $250 more a month, this rise in prices. And that's a heavy burden for a lot of families. I guess the question is, how much of a hurdle will inflation be to consumer spending and to economic growth in the coming months?
Alexis, you're referencing the perfect report from Goldman Sachs' David Kostin. Is that the average family in the U.S. will spend about $3,000 more per year, food, gas, groceries, home heating, as much as $5,000. And as Kostin said, in the retail sales increases, about 50 to 60% of that is inflation, not increased unit sales. So we're in a supply chain crisis and an inflation crisis. The worst we've seen in 40 years, dating back to 1982, and will continue to be bad through the balance of this year.
We heard from a number of big food companies and restaurant chains just this week alone telling us they have or are about to raise prices. Chipotle, Coca-Cola, Pepsico, Unilever. How much more do you think prices will rise in 2022, especially if we have the Fed get aggressive and raise interest rates enough to rein in these high prices?
Alexis, the prices, typically there's one price increase every fiscal year, every crop year. Last year, there were 2 price increases. This year, there'll probably be 3 price increases. So the brand manufacturers know with a short supply of packaging and product, they can raise prices with impunity because they focus on margins, as you and your team report. So for profitability and increasing the stock prices, the brand manufacturers are raising prices with impunity. And our Strategic Resource Group study with retailers across the country, consumers are revolting as they are in Canada and switching from branded product to private label products. So England, Scotland, Ireland, Canada, NZ, Australia, 50 to 60% of the unit sales are private label versus 20% in the US. You'll see private label sales increase anywhere from 30 to 50% because of this concerning cost of inflation. What you referenced from Goldman Sachs, families paying $250 a month, and that $250 a month's going higher. It's unbudgeted and real crusher for the consumers.
Makes sense. Those private label companies can certainly see an opportunity here. But I want to talk about some of the reasons for this higher food inflation. We keep talking here about the supply chain disruptions because of the pandemic and labor shortages. But also in that Goldman Sachs report, they were talking about the tools farmers need for their crops, things like fertilizer and pesticides. Even those prices are going higher, right? Is that what's going to continue to put pressure on these higher prices this year?
Yes, Alexis, as you and your great team have been listening to the conference calls of the fertilizer suppliers, fertilizer prices are a record high, highest since crop year 2011, and going higher. And the cost of transportation is obviously higher, cost of labor's higher. So while we had a record crop year in the continental US, because of all the shortages, while the farmers are producing more and more productive in yield per acre, because of the costs you're referencing, particular fertilizer, prices on the shelf are going to continue to skyrocket at the local supermarket.
And I want to ask your opinion on how e-commerce fits into all of this and us buying groceries online. Before the pandemic, that was quite a small number and projections were not very big, but that's changed now. And do you think it's changed for good?
It has changed for good, Alexis, in that prior to the pandemic, 12% of sales were online. Now it's 20% going to 25%. So online e-commerce sales for food and consumables going higher, and also as Target, Winco, Walmart to Wakefern, ShopRite, and Stop & Shop are all doing. They're having buy online, pick up curbside, or buy online, deliver, or some people are using takeoff technologies with ShopRite and Stop & Shop to buy their shelf-stable products online and just go in the store to only pick out produce and fresh seafood and potentially meat products.
Yeah, I'm one of them. I like to go pick out that kind of stuff in person if I can, but those other staples, non-perishables, online we go. All right, Bert Flickinger, Managing Director at Strategic Resource Group, thanks so much for being with us. More Americans are heading back to the physical gym. So what does that mean for the at-home fitness revolution? We talk it over with the president of Equinox next. Welcome back, everybody. Americans are heading back to the gym after 2 years of at-home fitness. With a look at how the pandemic is reshaping our workouts is the president of Equinox, Scott Giroux. Scott, good to have you on the show again. I know that Equinox is a global brand. You guys have over 100 gyms all over the world. So just set the stage for us and tell us what foot traffic looks like right now compared to, let's say, a year ago or the height of the pandemic.
Sure. Alexis, thanks for having me, and it's a pleasure to be here. Our business today is stronger than it's been at any point since March of 2020. So if you look at that along two dimensions, check-in volume, just how often and how frequent our members are engaging with us. Just take the last 2 weeks, for example. Each week, we have set new records in terms of check-in volume since March of 2020. So our members are coming back to the clubs. You can also look at it in terms of demand for the Equinox experience in terms of new sales. And if you look at new sales over the last 8 months, we're outperforming sales from 2019. So demand is strong and engagement is increasing.
Scott, this is Karina. I feel like I need to step up my game because I can't get to the gym downstairs in my building, let alone to Equinox. But my two older kids are big fans of Equinox, so they forget about the building and they head over to your facilities. So, that's great. I'm wondering, though, even though you are seeing more people looking to go back to the gym physically and be there in person, are they still looking for flexibility? And if that's the case, how do you adjust your approach? Do you still look at digital training and invest in that space? What is your sort of omni-channel approach, if you will?
Our vision for Equinox is that omni multi-channel experience. And we've positioned Equinox to be the leader in providing an unparalleled luxury experience across both digital as well as physical. And so if you take our fitness clubs, providing an unparalleled luxury experience in the physical environment with our digital products, Equinox Plus, our connected hardware, providing that elevated upscale experience digitally as well. But here's an interesting data point that tells you a bit about how the consumer is shifting. If you look at our digital Equinox Plus content, approximately 30% of that content is consumed in our clubs. And so we're meeting the consumer where he or she wants, whether it's at home, on the road, or in our clubs, both with digital and physical. And that is the Equinox vision. And Equinox is quite possibly the best, most well-positioned company to provide that unparalleled experience across both digital and physical.
Scott, I'm curious how closely you all are watching this Peloton drama unfold. And do you see this as creating an opportunity for Equinox and your brands?
Well, I mean, we're certainly following the news like everyone else, not only with regards to Peloton, but also what's happening more generally in the digital fitness market. And the trends that we're seeing, I think, speak to the power of that omni multi-channel vision that we have for Equinox, where our consumer is telling us they want to engage in our clubs. They're coming back to the clubs at record levels, but they also want that digital experience that can provide a highly personalized, curated experience tied to their goals. And we're integrating that with the clubs in ways that our consumers, our members are really excited about. And that's where we're going in the future as well.
And I'm also curious how inflation is sort of playing out for you at Equinox. I'm curious what membership is now at your club, and I know rents are going up. It's costing more to keep your workers. So how is that playing out for you?
Like every business, almost like every sector, inflation is impacting all of us. And as you noted, it's on the talent side with wage increases, rent, vendors in terms of providing the equipment and the supplies that you need to provide our members with that high luxury 5-star experience. So certainly we're feeling the pressures of that inflation. And like we're seeing in pretty much every sector of the economy with regards to price increases, you're seeing that in fitness generally as well.
And then, Scott, I want to ask you, what sort of plans do you have? I know there was talk about going public via SPAC. Is that something that's still under consideration for you?
At this time, we do not have any plans to pursue a SPAC.
And just really quick, I wanted to follow up on the membership question. How much? What's the average membership right now? And have you had to raise that price because of inflationary pressures?
We have, again, like nearly every business. I was listening to your segment before this one in terms of food and grocery. Certainly prices for fitness, Equinox, but also other facilities have increased over the last 12 to 18 months.
All right, Scott Giroux, president of Equinox, thanks for stopping by today. Karina?
All right, and we've got much more ahead. One company is trying to take the pain out of getting to the big game this weekend. We'll tell you how just ahead. Welcome back. Well, Spot Hero is a digital parking service that touts itself as the only independent off-street provider in North America. Here to discuss how it can help take the stress out of driving and how it may come in handy this Super Bowl Sunday is Mark Lawrence, Spot Hero founder and CEO. Mark, thanks so much for joining us. First, if you would just describe the business model for us, explain how does it work, who are your customers, who are your partners, and it is independent, correct?
Yeah, that's correct. So we're completely independent. What Spot Hero does, we're on a mission to empower people to get everywhere easier. And what we do is partner with different parking companies nationwide or people with individual spots. We bring them together in a marketplace to make it easier to park so you know exactly where you're going and how much you're going to pay. So we've got access to millions of parking spots at thousands of locations in 300 cities in the United States and Canada.
And then how does a payment structure work as far as what's your cut and what's your partner's cut? And how does it compare to, let's say, if you went to park in a garage somewhere, a parking lot?
Yeah, so we are a marketplace. So we have a commission model where we take a percentage for all the parking that we sell. So the way that it works is you can get a discount by paying through Spot Hero, and you also get a lot more convenience. You can book it in advance. You know exactly where you're going to park and how much you're going to pay.
And then net revenue was in 2021 up by 90% year over year. How did the pandemic affect your business model? And then what's your bandwidth nationally as far as how many locations do you have? How many customers do you serve?
Yeah, so we've got millions of customers. We're actually just approaching $1 billion in lifetime parking sold. We have enough inventory where we could sell over $2 billion of parking a year. The pandemic obviously was very difficult for us. There were times where revenue fell greatly, as you could appreciate. But we've since broken through pre-pandemic records across many different places, net revenue, including, as you mentioned, we pretty much have close to doubled since last year. Our growth is accelerating, and we're making a lot of product improvements to make things, as we call, a heroic customer experience for drivers.
And then I was telling you in the break, I'd actually never heard of your service before, but I think it's a great idea. What sort of feedback are you getting from customers? How much easier are you making life for them?
I think there's folks that are saying, I don't park anymore. I Spot Hero. Spot Hero is a verb because, you could drive around in circles looking for a street parking spot, never finding it. You can get ticketed or towed. There are a whole host of things, not just how much it costs, but the whole experience can be very difficult. And so, when I co-founded the company with Larry almost 10 years ago, the whole focus was how do you make things easier for drivers, and millions of people and $1 billion of parking sold. There are a lot of fans.
Now, how do you decide where to deploy your resources to get maximum return on investment? Because in a city like New York, let's say, I was telling our producers earlier on today that I decided to go to the US Open this summer. I went to the men's final. I don't drive, so I took an Uber. It was fine getting there, but getting out of the stadium was a complete nightmare. It took me 2.5 hours for my Uber to finally show up. When I did, I was so miserable. I'm never doing this again. But I can imagine if people have a car and they can go and park and, Spot Hero was available, it takes so much out of the pain out of it. But how does investment in a city like New York, where so many people like me don't drive, don't have a car, use public transport, compared to something like Los Angeles, where the Super Bowl game is this, Sunday in Inglewood? Everyone's going to drive to the game, right?
Yeah, so LA is a much more car dependent city. I'll answer your question about New York, which is simply, even though a lower percentage of people drive, it's actually one of the largest parking markets in the country just because there's so many people. So, we actually have an office in New York, and it is one of our largest markets and very important to us. Los Angeles, very fast growing. We have a lot of Super Bowl parking. In terms of where you want to park, sometimes it can be more convenient to park a little bit further away to avoid just that congestion. Because whether you're taking a ride share or you're driving and parking, you might want to be a little bit further away so that you can get out. And we've done a number of different Super Bowls for parking, whether it's individual spots or working with our parking partners. But where you're going to park for an event like the Super Bowl, which I think there's 150,000 people coming from out of town, and that doesn't even include all the Angelinos that are going to be in the area too. It's going to be mayhem. So knowing where you're going to park is going to be a critical part of your fan experience.
And then, so what are the prices like leading up to the Super Bowl? And then how many, spots do you have available? How does it compare to past Super Bowls? Because this is your 5th Super Bowl that you're dealing with, right?
Yeah. So what I would say is it's consistent with past Super Bowls where you'll see some just crazy aberrations with parking. The demand spikes, even though SoFi Stadium has increased the number of parking spots, most of those are really for season ticket holders or VIPs. So, right now the parking spots are quite expensive. They range from $100 to $500 for most of them. Some are as high as $700. But what we've seen is as it gets closer and spots do get booked up, the prices can rise. And, we've seen $1,000, $2,000 spots in the past. I think there was recently folks selling them for $4,000, not on our platform. Our averages are around $250. You can park a little bit further away for about $100 or $125, but they're quite pricey in the range of $100 to $500, which is consistent with pretty much every Super Bowl that we've seen.
So that's not bad, considering the tickets will cost you anywhere from 5,000 grand up to 500,000 grand, basically. But I'm wondering, so this is to do with the game, and prices are higher, and you say as you get closer to the game, the prices could go even higher. But what about as far as your business model in general? Do you have surge pricing, let's say like an Uber or a Lyft does, at certain times of the day or in certain areas?
So I think the way to think about it is this. So regardless of our service, the event rates are going to rise based off supply and demand. And so regardless of Spot Hero, the prices are set by our parking partners. And so you'll also see them rise on site. What I would say is it's very important if you're going to the Super Bowl to reserve it ahead of time, because what's worse than expensive parking? How about no parking? Because it's just not available. And this happens with the Super Bowl or other events where you'll drive there, you might miss a good part of the game or the event. And it's not so much about price, it's really about availability. So our business model is predicated on two things: price and convenience. We offer both, and they're going to be different degrees in different cities. But the peace of mind, especially for any event, or if you're going to a restaurant, wherever, of not having to worry about where you're going to park or how much you're going to pay, is a core component of what we call heroic customer experience.
All right, all about ease and convenience. We will leave it there. Mark Lawrence, Spot Hero founder and CEO. Thanks so much for your time today. Alexis?
Thanks, Karina. Want to get you a check of the markets because losses are piling up here as we head further into the afternoon and closer to the closing bell. We now have all indexes near their session lows. Investors digesting the hottest inflation in 40 years and readjusting their expectations for rate hikes from the Fed. In fact, St. Louis Fed President James Bullard calling for a 50 basis point hike next month and then another by July. Let's get a check of the bond market because, as you can imagine, we are seeing yields rallying today, and that 10-year yield now above 2%, a place that we thought we'd be by the end of this year. And Bitcoin quietly rallying today, by the way. It is now back above $45,000. Not the case for all the cryptos, though, sort of a mixed bag there. But at least for today, an appetite for the world's largest cryptocurrency. It just got more expensive to finance a home. We have the latest on that big jump in mortgage rates this week, right after this. Mortgage rates jumped again this week to levels not seen since March of 2020. For more on what that means for home buyers and owners is Yahoo Finance's Jana Heron. Jana?
Hi, Alexis. Thanks for having me.
So what is it? First, yeah, tell us first off where these rates even are at the moment. I know the 30-year well above 3%.
Yes, we hit 3.69%. That's up from 3.55% last week. And it's really more than a half point higher than the end of December. So mortgage rates have really been on the move since the end of 2021. And unfortunately, this is not really good news for either home buyers or homeowners. So if we start with homeowners, the last 2 years really have seen some incredibly low, historically low actually, mortgage rates. And it's been a fantastic time for homeowners to refinance and lock in a lower rate and get a better mortgage payment. But that window now is closing very, very fast. So if you're a homeowner who's been sitting on the sidelines thinking about refinancing, that time is now if it hasn't passed you by already. And then for home buyers, gosh, it's such a brutal time to try to buy a house right now, especially for those first-time home buyers. They're already dealing with a really low inventory of homes for sale. There's double-digit home price growth. And now here's like the third whammy, rising mortgage rates. So houses are becoming even more unaffordable for those first-time home buyers. One statistic that really stuck out to me is that the average monthly mortgage payment for a median priced home is $350 more a month now than the same time last year. So you can really see how mortgage rates have moved and how this is actually not such good news for homeowners or home buyers.
Yeah, it is absolutely brutal for first-time homeowners looking to jump into the housing market. Bayan, I want to ask you, based on this red-hot inflation data that we got today, is it likely, it's probably likely, right, that rates will move even higher?
Yeah, so I hate to bring even more bad news, but yes, rates are likely to move higher. Fixed mortgage rates tend to follow the yield on the 10-year Treasury, which you guys were just saying jumped to over 2% this morning after that inflation report. So you should see mortgage rates also follow that in next week's report. Housing economists that I have spoken to expect mortgage rates to hit about 4% by the second half of this year. So I don't want to leave everyone on a very sour note about mortgage rates, because 4%, if you look at it over a historical time period, is not that bad. It's actually pretty good. Just ask your parents or your grandparents. They can tell you about the early 1980s when inflation was jumping just like it is now, and mortgage rates were at 15 or 16%. So if you end up getting that 4% rate, it's really not that bad.
I'm glad you said it. Important to put it all in perspective, because I remember those double-digit interest rate days. Jana Herron, thanks so much.
Okay, and we've got much more coming ahead, more market news ahead. We're going to continue to track that red-hot inflation number and what it's doing to the markets, plus a conversation with the CEO of the Container Store on his earnings and the road ahead. Stay with us.
Sticker shock at the supermarket, the gas station, and just about everywhere else as consumer prices rise at the fastest pace in 40 years. What red-hot inflation means for your wallet, Wall Street, and the Biden administration. Americans rushed to the Container Store during the height of the pandemic to organize their lives. But what happens now that we're spending less time at home? The CEO of the Container Store is here with some insights. And yet another speed bump for automakers. Ford, GM, and Toyota forced to halt production at some plants after a trucker blockade chokes off parts. We have the latest on the trucker protests over vaccine mandates and what they mean for auto sales. Welcome back to Yahoo Finance Live, everyone. I'm Alexis Christophorous here with Karina Mitchell. And stocks just a few moments ago hit their session lows as investors weigh that hot inflation number against some pretty strong earnings today from Disney, Coca-Cola, Twitter, Pepsico, and more. Want to get right to Jared Blickery now, who has his eye on the mega caps and those growth stocks under a lot of pressure, and I can see it on your screen because there's lots of red.
Yes, fortunately not too much dark red. We've seen a lot of this before when the 10-year yield and frankly the whole yield curve was marching up, puts pressure on stocks sometimes if it does it in an erratic fashion. Now you can see Apple, Alphabet, Amazon, Tesla, Nvidia, Facebook all off more than 1%, Microsoft off more than 2%. I've been watching Alphabet. This was a record high on its earnings announcement, came down for several days in a row, filled this gap right here. That was this bar right here. And now we're just kind of going sideways, but a little bit ominous that Alphabet, being as big as it is, and given that strong earnings report, wouldn't be able to capitalize on some momentum there. And I'd be remiss if we didn't show the 10-year T-note yield, and that is up 9 basis points. So let me take this away, and you can see this is a 3-year chart. Haven't seen levels like this going back to 2019. Have to go back to the middle of 2019. So really a lot of pressure on the yield curve here, and you can also see it in the other tenors. 5-year T-note yield is up even more, 13 basis points. And guess what? The 30-year, a bit less, 7 basis points. Even though everything's going higher, the yield curve is tightening. It's contracting here, getting a little bit squeezed. So we know that when it becomes parallel, that is a recession signal. So the short-term rates rise above the long-term. Hasn't happened yet, but we want to keep an eye out for that, especially as the markets are now pricing in just about 100% chance of a 50 basis point rate hike in March. Also a 25% chance of a 75 basis point hike. Those odds were 0 yesterday, at least in terms of 75 basis points. So a lot going on here, and we're going to be tracking it all afternoon.
All right. And a bright spot, Disney, the happiest place on earth for their investors, because on a strong earnings report helped by theme parks and streaming, it is doing very well, bucking the trend.
Yes, you can see that, and the streaming numbers speak for themselves. You can see the stock is up 3% today. Let me just give you a 1-year view. You can see not the best performance. If we show a 3-year, which will include all of the pandemic performance, you can see still maintaining gains from that pandemic low. But let me just skip to the analyst commentary and some of those numbers, because the Disney Plus subscribers came in at 129.8 million. That's up 37% year over year, really trouncing the estimate, which was about 4 million lower. Also, ESPN subscribers, that was a big hit, get there, 21.3 million versus the estimate of 18.8 million. And then Hulu subscribers coming in line, 45.3 million. Add it all up, 196.4 million subscribers for Disney on all their platforms, just short of 200 million. Here's some analyst commentary from Wells Fargo. They rate the stock an overweight with a price target of $196. You can see it's just about $45 above the current price. They say confidence in Disney Plus awakens on these results, and Disney is doing and saying all the right things to make their fiscal year 24 guidance with parks recovering and, quote, in a big way. However, Disney is hardly out of the woods with a long way to fiscal year 24 guidance. We also know they have their theater, their film studios, and that is a huge hit for them. Going forward, there's going to be a lot of capital investment in that. And also, they have to make a decision. Are they going to use those theaters or stream it? I think they're still trying to figure out that mix, as Dan Howley has been writing about.
Yeah, they're keeping their toe in both camps there. And you know what? They're doing it all without Bob Iger, by the way,
yes,
as CEO, so proving that they can do it. Want to get to our Yahoo Finance Plus investment idea of the day. Chipotle, we heard from them this week, great earnings and really strong digital sales there, Jared.
Incredible to think that half of all sales for Chipotle are digital now. That's a really strong showing. So let me get to that analyst commentary by Argus Research. This is a 3-year chart of Chipotle. You can see it got almost up to 2,000. It came back down to 1,500. At least that's the price today. Came back down actually to about 1,300 and change. So really big price movements in this high growth stock. And let's see what Argus is writing today. And this is based on that earnings report that we got from earlier in this week. They're maintaining their long-term target of 1,800. And they're saying, we believe that Chipotle has a healthy balance sheet along with robust mobile ordering and delivery platforms that will help it to recover as the economy reopens. While some consumers may be put off by Chipotle's relatively high prices, we expect its strong brand to continue to attract customers, maintaining our 22 estimates, and also saying our long-term rating is also a buy. We remain confident that Chipotle can achieve its long-term objectives of mid-single-digit comps, high single-digit revenue growth, and mid-teens operating margins. We spoke with the CEO earlier. He seemed pretty confident that he can keep raising prices.
We'll see. We'll see how longer the consumer sticks in there. All right, Jared Blickery, thanks so much. I want to stick with the markets now and welcome in Jordan Jackson to the show, JP Morgan Asset Management Global Market Strategist. Jordan, good to have you here. There is a report out actually from Charles Schwab that showed nearly 9 out of 10 traders are concerned about inflation. Many of them are taking actions to hedge against it. So they're going into things like real estate, crypto, and gold. How concerned are you about inflation, and how are you hedging against it?
Well, I'm still fairly concerned. Obviously we've got the red hot print this morning. We may not be out of the woods yet. We could be looking at the peak inflation print coming potentially in February, potentially in March. I think it is going to be concentrated in the first quarter of this year. But then I think prices begin to moderate thereafter. When I look at what markets are expecting, they are expecting inflation to come down to roughly about a 5% level over the middle of the year, and then roughly end the year at around 3 to 3.5%. So still some moderating inflation. I think investors have to ask themselves, do I want to hedge against inflation, or do I want to beat inflation? And so, I think things like gold, are where you can hedge, but I think there are other areas where you can sort of continue to outpace and see outsized gains relative to inflation. I think that's things like equities. I do think commodity markets are relatively well supported here as well. And so I think investors will need to sort of, again, diversify how they think about hedging and outpacing inflation at the current juncture.
Yeah, I'm intrigued because I like the idea of beating inflation, not necessarily hedging against it. So tell me more about how you are planning to do that, Jordan, and ways that, investors, retail investors hearing this interview can do that.
Well, I think it's certainly still maintain risk on exposure. I think equities broadly can still perform and outpace the rate of inflation. I still think equities this year can deliver low double-digit returns to the market. And so if you think inflation is going to end the year sort of between 3 and 5%, you're still looking at a positive real return. I also think, potentially areas like, commodities, which again sort of serve as inflation hedges, but the supply-demand picture that we're seeing across a host of commodities, things like oil, metals, which are sitting on low inventory balances, prices are likely to be relatively well supported over the next couple of months here. As the global economy continues to recover from Omicron and China comes back online more broadly, I think that commodity demand remains relatively robust. So I do think parts of the market, right? You think you want to do commodity producers. If you're not going to overweight the specific commodities themselves, commodity producers can be a way to do that in this type of market also.
Well, certainly we've learned with all this volatility since the beginning of the year, this really is a stock picker's market. So you say equities in general are a way to perhaps beat inflation, but where within equities? That's a big pie, right, Jordan? So where within there are you seeing the most opportunity right now?
So obviously with the pressure on rates that you're seeing, I think growth stocks are going to come under a bit of pressure here. Obviously, you see some of the high-flying tech names coming under pressure. I think as real yields continue to move higher, the growth complex, which again continue to trade at higher valuations, can come under pressure. So with that being said, I do think some of the more value-orientated parts of the market can continue to perform well relative to growth. Things like industrials, things like manufacturing and mining, which are likely going to benefit from the commodity demand that I talked about. Obviously, you've continued to see very, very strong demand for homes, even in an environment with higher mortgage rates. I think low inventory and strong consumers have continued to drive demand for homes, and even a continued modest uptick in mortgage rates. I don't think takes the wind out of the sails in housing demand. So you think about commodities like lumber and timber and things like that are likely going to continue to be relatively well supported. And again, I think also real estate REITs can hedge to a certain degree some of the underlying inflationary impacts. But again, this is a dividend paying sector, and so higher rates suggest that folks may opt for bonds over real estate investment trusts. So something to be cautious of there.
We have seen a lot of money flowing into those dividend-paying stocks recently, Jordan. Just want to quickly get your thoughts on rates, because we had a Fed president of St. Louis, Bullard, come out today, the president of the Fed in St. Louis, talking about a 1% jump in rates by July. He thinks we're going to get that 50 basis point hike at the March meeting. What are your expectations?
I think that they deliver on 50 basis points in March. The reality is the Fed is very focused. They know that they should be tightening policy. Inflation's got a 7 handle, GDP's got a 7 handle, and the real effective federal funds rate is deeply negative. They've got to start tightening policy, but they are very concerned with making sure they don't jar markets, that markets don't react negatively. And in an environment in which, markets are now expecting a high probability of a 50 basis point increase, this would suggest that it's relatively palatable for markets. And I think they effectively deliver on that 50 basis point rate hike. Now, we have to remember, right, in rate hikes today affect inflation tomorrow. And so even if inflation sort of moderates, we're still expecting inflation to run potentially north of 3% through at least the first half of 2023. I think we're certainly, it's appropriate for the Fed to begin hiking rates and also begin to start to reduce the size of its balloon balance sheet as well.
All right, Jordan Jackson, global market strategist at JP Morgan Asset Management. Thanks so much. Karina?
Okay, we've got much more coming up. We check in with the CEO of the Container Store to see how it's weathering this side of the pandemic and take a look at its earnings. Stay with us. Welcome back to Yahoo Finance. Well, the Container Store was a big winner during the height of the pandemic as more people invested in their homes. But as things open up and as prices climb due to red-hot inflation, there are headwinds. Here to discuss its latest earnings and outlook, let's bring in Container Store CEO Satish Malhotra. Satish, thanks so much for being here today. I really appreciate the time. So the stock has taken quite a big hit on fiscal third quarter 2021 results. It's down a little bit today as well. Just want to go through some of the numbers from your earnings report. Consolidated net sales came in at 267 million. That's down about 3% year over year, but it is up about 17% compared to 2019. Adjusted EPS down year over year as well at about 28 cents. General merchandise sales down. Closet sales were also flat, and gross margins were about 57%, also a little bit lower on online sales. So paint the picture for us, because there were definitely some challenges that you were dealing with.
Yeah, and thank you for having me on. Listen, we look at our business really quarter by quarter compared to fiscal 2019. We feel that 2019 is a solid foundation to really look at our results. And I will tell you, Q3 was indicative of the performance we've had in Q1 and Q2, where we're seeing our growth almost around 17% consistently every quarter. We're seeing great growths when we think about our custom closet business, which is almost around 20% consistently in Q1, 2, and 3, as well as experiencing double-digit growths in our general merchandise categories as well, consistently in Q1, 2, and 3. And so, I don't try to speculate what the market's trying to uncover here, but what I can tell you is that our performance continues to perform exactly as we expect, if not actually better than what we expect. And it's largely due to all the efforts that we've been taking this entire year. Fiscal 21 for us is very much a foundational year for us as we look to build on our strengths, both in our brick and mortar business and in our e-commerce business. And we're seeing great results from that. It's going to really allow us to capitalize as we move into not only our Q4 performance, but into fiscal 2022 as well.
And then how are you enhancing some of the e-commerce experience for your customers? Because I know you're introducing a mobile app, for example, and you're also starting to accept PayPal as a form of payment.
That's correct. I would say, as we started fiscal 21, our e-commerce experience was a bit clunky. We really tried to dissect how we could improve our performance for our customers, whether it was an improvement in our site speed, search capabilities, rating and reviews, as well as putting in new functionality such as saving your favorites and also introducing smart filtering. All of those truly enhance the online experience. And no doubt we've added additional features such as through Narvar, where you're able to get transparent information about where your order is, adding Afterpay, which allows you to kind of split up your purchases and pay over time, and now with PayPal. So it's been a long journey. We've not done yet. There's still a lot more to be done in terms of improving our e-commerce experience, including, as you mentioned, our mobile app, which we're super excited about to be able to deliver by the end of fiscal 21, as well as our new loyalty program, which I think is also going to really enhance our ability to not only attract new customers, but also, really reward those customers that have been with us for decades plus.
And then what are some of the strategic improvements that you've made and that you have planned coming up? I know more Marie Kondo material is also in the pipeline for you guys.
Yeah, well, we have a lot of things coming up in the pipeline. In terms of actually our product, we continue to invest in our private label business, which is more than 50% of our SKUs. We're investing in sustainable products. We have now 1,600 of our SKUs that are now sustainable in nature. With that, we are adding 100 new Marie Kondo SKUs, largely in the Soji collection and the Hikadashi collection as well. We've got a new jewelry box collection that's coming up as well. Consumers really love the look and feel and feature of the Marie Kondo line, and we're happy to extend that assortment. We continue to focus as well on our kitchen and storage, as well as our closet lines as well, which have been doing incredibly well for us, and that's at full price too. So, got a lot in store. I was super excited to be able to bring that to our customers. and let them to fully immerse themselves in what we have to offer. And I think that's been one of the big differences we've made in fiscal 21 as well, is that we've really allowed our specialists, our trained specialists, to come on the selling floor and really engage with our customers and help them with their projects or their issues that they may be having, so that they can find the right product to fit with specialized services so they can feel comfortable around the purchases that they're making.
And Satish, really quickly, only 10 seconds left. I was interested, you commissioned a third-party pay equity study. What prompted that?
Just really our continued efforts about becoming an employer of choice. And as you know, earlier this year, fiscal year, we went out and made the statement of that we are going to be having a minimum wage at $15, and that was the first kind of step in us becoming an employer of choice. Doing an equity study so that we can ensure that we're paying all of our employees fairly and equitably. Completed that study, and we'll make some small modifications based on the results that we saw, as well as putting forth some really great training programs, our foundational programs that we have in place, so people can come to the Container Store and really feel that they can have a long-lasting career with us, and it's not just a job. Which is why we started our fiscal 21 really ensuring that everyone was aligned with our purpose, and our purpose of being transforming lives through the power of organization, because we feel that it's such a transformational moment when we can take consumers from where they are today in their kind of chaotic lifestyles, dealing with clutter in their homes, and for them to truly immerse and experience those transformational impacts that we can deliver for them.
Okay, we will have to leave it there. So many more questions, but we will have you back next time. Satish Malhotra, Container Store CEO. Thank you so much. Alexis, I'll throw it over to you.
Coming up, former Yahoo global anchor Katie Couric weighs in on workplace equity. We are showing you a look at the equity markets right now because things are just deteriorating here as we move closer into the closing bell. Rather, it's been a long day. We've got about 90 minutes left in the trading session, and the Dow down 494 there. It was off about 520 points just a couple moments ago, and you can see tech stocks really taking it on the chin again. And on a percentage basis, the Nasdaq is the worst performer today, down nearly 1.75%. All right, we're going to switch gears now, and in this week's influencers, Yahoo Finance editor-in-chief Andy Serwer sits down with former Today host and CBS Evening News anchor Katie Couric for a conversation about workplace equity.
I think it's early days, but I think maybe early to middle days, Andy. I think this is so important, and I think you can't just wave a magic wand. There's so many factors, I think, contributing to this imbalance of power that have been entrenched in our society for decades, if not centuries. And so one of the things that I hope we can do is have honest conversations about this. I think that's so imperative. And if my book models that, then that's something I'm really pleased about. Because I think what happens is, there's progress and then there's a backlash. There's progress and then there's a backlash. And I think having open and honest conversations and not, canceling people because they say the wrong thing, or not rejecting them out of hand because of the way that they see things, and they're products of their own environments, is a really important component to leveling the playing field for everyone.
You write, of course, we talked about Matt Lauer, or I mentioned him, I should say, in The Problems, and Les Moonves. Are men in TV and entertainment worse than other businesses, or is it just that they're more high profile?
It's hard for me to answer that question, Andy, because I haven't really been in other businesses. But having said that, I do think they're more high profile. I think there's probably a little more, it's not exactly a low key or low profile industry. So I think probably the ego level of men in television in general and sort of media is probably feeds into, or fed into certain behavior for many, many years. So I think that, I think it was just sort of business as usual. It was sort of the status quo for this kind of behavior. I think it was not only tolerated, but in some cases encouraged in television news. And especially as women were entering that industry in significant numbers. I think we forget that, I graduated from college, Andy, in 1979. And this was when women were really entering the workplace in big numbers. And so it was male dominated for quite a while. Women were in positions that were dependent on their male bosses. So that created a dynamic that just, I think, opened up for a lot of abuses. That, and add to that kind of the culture that existed, a bit of Hollywood. We're going to make you a star. I control your fate. You are subservient to me. And I think that provided a recipe for that kind of really unacceptable behavior.
Did any of them come back, or should they be allowed to come back? We're talking about canceling people and people paying the price.
I think a lot of it depends on your response to the allegations. I think people who recognize, I think James Franco did something very interesting that we haven't seen with a lot of these men who had been, and I think that, I don't know, we could have a whole conversation of the word canceled. I think they were removed with cause. I think canceled sometimes suggests that a small, a smaller or infraction or whatever was overly penalized. So I think James Franco talked about getting help, acknowledging his issues, and trying to understand the damage that he did. And I think that other people should probably take a page from that playbook and do some serious introspection, and then try to kind of contribute to, be the change that we hope to see, instead of kind of digging in their heels. But, I think I think with any kind of social movement, there is bound to be some collateral damage.
Right. Good point about how I use the word cancel, by the way. So,
well, I mean, I think
I appreciate that. No,
yeah,
you're right. You are spot on.
To interpretation, you know.
No, you were spot on. I want to switch over and get back to some of those tech companies and the platforms a little bit, because they're so powerful, and you're relying on them. We're relying on them. We're one of them in a way. But Facebook, Twitter, how are you thinking about them, Katie? Are they to blame for the widespread proliferation of misinformation? Should they be held responsible? Should they be broken up? I mean, there are 1,000 big questions there, but just your 1,000-foot take.
It's, I wish I were even, you probably are more of an expert on this, Andy, than I am. I was a co-chair of the Aspen Commission on Disinformation, and obviously we took a close look at some of these platforms. I mean, I think the problem with disinformation in our society is very multidimensional, but the algorithms and the way things are shared and amplified certainly, I think, have been fueled by these social media platforms. It's also lack of trust in mainstream media or more traditional media outlets, and also the democratization of information where everyone who has a digital device or an iPad or a computer can spread misinformation and disinformation and malinformation. And so I think that we really do need to take a close look at the liability of some of these platforms that claim they are not a publisher, that they're just a platform. And Congress should get involved. I think the federal government needs to have a more unified approach.
Okay, welcome back to Yahoo Finance. Well, we've got just under 90 minutes left in the trading day, and the major benchmarks near session lows. The Dow was down by as much as 500, slightly off that now, but fears over a more aggressive Fed leading to the three majors deep in red at the moment. I want to check in on the energy sector as well. Let's bring in our Yahoo Finance's Jared Blickery to see how crude settled. Jared.
That's right. We got crude oil, WTI for March expiry, $89.88 per barrel. Still trading here. You can see just about break even for the day. Had some larger gains earlier, but got another sell-off. It took a leg down with equities here. Just want to make a note as I bring up a longer-term chart. This is a 3-month chart that OPEC also revised its demand outlook for the entire world by 4.2 million barrels per day. That is a big amount. That's an increase of about 4% over the coming year, and it was only yesterday that we got an upping in the supply forecast for the U.S. And so you put it all together, there's a little bit more supply coming online from the U.S. The shale should reach record output again in another year or two, but the demand is such that we're probably going to eclipse that. And guess what? Over the past few days, we've been hovering around $90 per barrel. We got to about 92 here and change, and now we've just been kind of hugging and consolidating here, but you can see really not much of a downdraft at all, still maintaining this very tight trend line on the way up. So we'll have to see what comes in the coming days, but still around $90 per barrel for WTI. Just want to show you the energy sector heat map here. We have most of the left, that would be the majors, are in the red, and some of the smaller players, some of the shale players, those are in the green. Occidental Petroleum up 1.5%, Chevron down about 1%, guys.
Okay, well, it's good to see some green on the screen there. Thank you, Jared Blickery. All right, we're going to shift gears. And as if chip and supply problems weren't enough, now automakers are facing the fallout from trucker protests, turning ugly in Canada, and car prices that continue to soar amid rising inflation. Here to help us discuss it all is Pat Ryan, founder and CEO at Copilot. And Pat, thank you so much for joining us today. So there's a lot going on in the auto industry. Let's start with the ramifications of these trucker protests that are happening in Canada and now impacting the borders, particularly into Detroit, and what impact it's having on automakers. So many are being disrupted at the moment, like Ford, Stellantis.
Absolutely. If you look at the whole supply chain, it's already fragile. So we're starting with a fragile supply chain. We're starting with real shortages of inventory. And with NAFTA, the way it's been, Canada and the U.S. have been interchangeable for a lot of the manufacturers. So Ontario has been a big source of building things. But now you've got minivans like the Chrysler Pacifica, which, by the way, minivans are making a big comeback during the pandemic. Big pickup trucks are really getting slowed down. And then Honda and Toyota make a number of vehicles up there they sell in the U.S. And Honda and Toyota were already very much in short supply. Only 19 days of supply, which means very little selection on the ground for Toyotas versus 60 in a normal market. So you have a really low supply base already out in the world. Anything that ripples into that causes real problems, and it's going to be a real challenge for the next few weeks at a minimum.
And then Unifor, which represents workers at the auto assembly plant, says it's seeing short-term layoffs. Any possibility that those turn into longer-term layoffs?
I don't think so. It's just supply disruptions. I mean, they need to build cars back up. There are a huge amount of demand out there. The new car market continues to be short. We had that big demand spike, started with the stimulus, started with COVID, but really took off with the stimulus. And if you look at what's really happened, that demand has just not been met yet. And so we're going to have big volumes all year this year, as much as people can make. The chip shortage or other supply disruptions are the only reason. If they can't build those cars because of what's happening on the bridge, or what's happening with chips, that'd be the only reason. But the inherent demand remains high. It's going to be a great year for auto workers and employment as long as we can keep the supply chains moving.
Car prices keep rising, and we got that CPI data that showed that used cars up 40.5% year over year. At some point, if you're thinking about buying a used car, when do you decide it isn't the right time? Because at some point, prices will start to come down, right, as inflation does moderate. And then doesn't the owner become underwater in that case?
I think it's a great point. I mean, the reality is new car supplies are low. But near new cars, those 1 to 3 year old cars that are very interchangeable, are actually back at more normal levels, but the prices aren't. So the inventory levels are back, but the prices aren't. So you try to buy a 2019, a 3 year old Honda, it's 103% of the original window sticker that you'd be paying. If you try to buy a 2019 Toyota, it's 97%. So people are paying new car prices for 3-year-old cars. That's just not going to last. There are only so many people willing to do that. We started to see in January a little softening of prices. I think this supply disruption is probably going to pull that back for a little bit. But as a trend, there's no question that we are going to see, as new car supply comes back, we'll see more of a long road back to normal, but a road back to normal on used car prices, particularly those near new car prices. And consumers are going to be the beneficiaries of that in a significant way. And people who buy now are really running the risk of being the people who bought stocks late in the fourth quarter at peak, or bought a home before a housing market busted. So there is a bubble in used car prices and car prices generally. We look for it to ease over the year, but it'll be inconsistent. And I think most importantly, it'll differ by manufacturer. GM's in much better shape than Ford on its chip shortage. So you'll see different ones adjust at different times. Keeping an eye on that market, which we're trying to help our members do, and timing the market well will pay $15,000, $20,000 differences in used car prices versus pre-pandemic, what you normally expect them to be. So these are real big savings or big price increases for consumers, depending if they buy now or they wait.
Yeah, and I was struck by a really interesting statistic I saw from Edmunds.com. Says in January 2021, just 2.8% of new vehicles sold above sticker price. Last month, that figure was 82%. That is astounding. And some, automakers like GM and Ford are starting to clamp down on dealers that are just raising these prices, to exorbitant sort of levels.
Well, the new car price thing is really, we show 86% for that same number. And I would tell you that the average price being paid is $700 over sticker. Now that's influenced by some cars that are very expensive with big markups. But there is no question that the issue that we're dealing with now on prices is real. The manufacturers are concerned about it, but dealer profits on vehicles are over $5,000 for the third month in a row. $5,000 is compared to less than $2,000 before the pandemic started. So these are record dealer profits. We've never seen profits like this for the auto industry. They're making hay while the sun shines, but it's hard for consumers. And a lot of people in the manufacturer side are frustrated because they feel like it hurts their brand equity to be charging more than sticker.
Yeah, and dealers are doing what they can to make what they can right now as, EV makers like Tesla and Rivian ship direct to consumer. Okay, we'll have to leave it there. Thank you so much for coming on. Pat Ryan, founder and CEO at Copilot. Alexis, over to you.
Coming up next, we speak with the CEO of Playfly about the biggest trends in naming rights ahead of Super Bowl Sunday. This Sunday's Super Bowl will serve as an advertising platform for a lot of companies, but perhaps none bigger than SoFi, which paid more than $600 million to have its name on LA's football stadium, which is, of course, home to Super Bowl 56. Here to talk more about sports naming rights is Playfly founder and CEO Mike Schreiber. Mike, your company did not organize that naming rights deal that we just talked about for SoFi, but I know that you help a lot of other venues find partners. What's the trend you're seeing right now in that space?
Yeah, great. Thanks for having me. And great question. There's a huge wind change that's happening in sports around sponsorship, and especially with marquee sponsorships, buildings, even actually the player uniforms is changing inside the US. We're seeing more and more opportunities and more flexibility from pro teams, pro leagues, and even college athletic departments as well, looking at naming buildings and putting brands on different uniforms. If you look at what's happened in Europe over the past bunch of years, you can see a difference between what a European uniform and sponsorship opportunity looks like, and then the US. So the US is actually now getting more and more flexible to be able to actually put a number of those opportunities into play. So SoFi is a great example. We've constructed deals, as an example, Mercedes-Benz in Atlanta. But if you really think about it, these opportunities are driving significant growth for the sports organizations and leagues that they haven't really had access to before by adding more brands going forward. So we're excited to be a partner to the industry. We actually acquired at Playfly Sports a business called Premier Partnerships, which has now become Playfly Premier Partnerships. And that is really driving this industry change forward by using our amazing sales teams and partners to try to find more opportunities that are really native and synergistic when you put both the brand partner and the sports team together.
Hey, Mike, Josh Schaefer here. I wanted to kind of pin down on the growth you were talking about there. I mean, we saw the Crypto.com deal last year that took over the Staples Center, valued at reportedly $700 million. I mean, these numbers are starting to get really big when we talk about growth. Obviously, the Staples Center is a huge venue and very popular. But do you think we've seen kind of the top as far as valuations go for naming rights, or do you think there's still room to grow?
Yeah, there's still room. Some of these numbers are pretty large, and they include not only the naming rights, but they include a lot of other elements, including in-venue signage, even TV and digital. And that's one thing that's really unique about Playfly Sports. Our business is we're a relatively new brand in the space of sports over the last 2 years, but we've combined a number of businesses that have been around for 10, 20, 30 years that now actually we function as a network effect where we can actually support TV, digital, in-venue, and marquee naming rights as a business. We do it in some way or another for every NBA team, every NHL team, every MLB team, as well as a number of marquee college athletic departments. So what you're seeing now is using that stack, and that's really how you get to those big valuations that you're talking about, is using that stack, starting with the naming rights and then developing all of the other categories, whether it's TV, whether it's digital, whether it's in venue, and all the other fan engagement elements that drive up those values that you can create those big numbers. We actually have seen really, when you look at it from number of brand entitlements and venues and properties across the US, it's grown almost 39%. When you actually go down into like the hat, helmet, headset, jersey patch market, you're seeing almost 150% increase in deals inside of that group of inventory. So it's really interesting. So it's not only the size of the deals, as you mentioned, but it's also the amount of deals that are coming to market, and then all the different elements within the deal that creates those big numbers that you referenced.
And I know your company is going to be working with the Nashville Predators to secure their New Jersey Pack sponsor. What do you think? What do you think you're going to see from there? And do you think that would you look at a sports gambling company, a cryptocurrency company? We know those sponsorships have been hot. Are those companies still interested in something like that, you think?
Yeah, and happy to actually break that news with you guys here today, that we have been retained by the Nashville Predators to secure their first ever sweater patch sponsor. So the NHL has August of last year allowed for jersey patches to start for this upcoming season. So we're excited to be partnered with Nashville and the Predators team, thinking through what types of partners, to your point. There's really three categories of brand partners to work with in broad strokes. The first is a major national brand that's looking at more exposure. They're already advertising on a national level and looking for that big property and partner like the Predators to partner with. There's the next category is a local or regional. A lot of times you'll see this with a number of brands, and we actually helped in around the actual Bridgestone arena that the actual Predators play in. But we think there's a regional and local play too, with companies that are part of that region that really want to up their game and associate with a big brand like the Predators, both on and off the ice. And then the third category is these breakout brands. And that's what you were referencing when you talk about the crypto.com and sports betting brands, and even a lot of the digital finance brands, as we started off with the SoFi brand. Those breakthrough brands are brands that are really going from a growth mode into the national sphere, and taking a name on top of an arena or taking a patch like the Nashville Predators patch is a really interesting way to elevate that brand and break through all the clutter. We actually did that for the Pelicans in the NBA, and we did their patch on their jerseys for a company called Ibotta, which is a software company. Again, breaking through a new company onto the national sphere, breaking through, using that as an opportunity. So national, local, and then these breakthrough brands. When it comes to the breakthrough brands, obviously crypto is a big category here that we're seeing a lot of, and we're partnering with a lot of those companies. Sports gambling, as you mentioned, is probably one of the fastest growing. It's the fastest growing category for us here at Playfly Sports. But it's really interesting because it's rolling out market by market. You're seeing each of the states roll out legality of the sports gambling opportunities. So what's ending up happening is we've now got majority of the country legal. So you're seeing bigger and bigger implementations of that. We've actually done some of the largest deals in sports gambling in the sports industry, including in college with our recent deal with Caesars and Michigan State.
Yeah, that's another interview, and there's lots of exciting stuff happening in that space as well. Mike Schreiber of Playfly, the CEO there. Thanks so much, Karina.
Okay, we've got much more coming up. Crypto investments are everywhere, and we're going to tell you about a corporate America tie-in next. Stay with us. Welcome back to Yahoo Finance. Well, crypto exchange Binance, led by the world's richest crypto billionaire, is taking a $200 million stake in Forbes, corporate media giant. With more on that, let's bring in Jen Schonberger. Jen, what's going on with this deal?
Hey there, good afternoon. Yeah, that's right. Binance, the world's largest cryptocurrency exchange, making a $200 million investment in Forbes, helping the magazine go public through a special purpose acquisition company. Forbes is planning to go public through a $630 million SPAC deal in the first quarter, and these new funds will help Forbes execute its plan to merge with blank check company Magnum Opus. Binance will replace half of $400 million in contributions from institutional investors. This comes as investors once hot on SPACs have grown skeptical of the deals, just as the stock market has pulled back amidst major volatility. With the investment, Binance will become the second largest owner in Forbes behind Integrated Whale Media, a Chinese company that bought a 95% stake in the magazine back in 2014. Now, as part of that transaction, Binance executives Patrick Hillman and Bill Chin will join the Forbes board of directors after the SPAC merger is complete. The investment shows just how the crypto sector is creeping into traditional business and financial transactions, investing in SPACs, affixing their monikers to major sports arenas, and now penetrating the major media space. This as digital asset values have started to rise, minting brand new billionaires looking to deploy cash. Now, a date has not yet been set for when there will be a shareholder vote on this merger, the precursor step for Forbes to begin trading, though when Forbes does begin trading, it will list on the New York Stock Exchange. Guys?
All right, Jen Schonberger. We're going to see crypto everywhere during the Super Bowl as well. Thank you so much for that report. Alexis, over to you.
All right. Thanks a lot, Karina. And we've got much more ahead on Yahoo Finance Live, including the latest on the sell-off on Wall Street, which continues to gain momentum here as we near the closing bell.
It all comes down to this last hour of trade in what's been a volatile session. Major averages, they've had consecutive gains this week, but the streak in jeopardy as the markets are digesting consumer price index data for the month of January, which revealed a 7.5% increase above expectations as inflation runs rampant at a 40-year high. Plus, earnings season rolls on after the market close and a few before. Expedia, Zillow, and we've already got some Affirm results. They're going to be out, and we're going to break them down for you live. Plus, more U.S. states are lifting mask mandates. The initial wave and height of the Omicron variant prompted some states to reinstitute the precautionary measure in addition to added testing capacity. But with cases subsiding, jurisdictions are beginning to remove the policies. We're going to dive into the newest states that have joined: New York, Delaware, and New Jersey, who already made their announcements, and the timing of the rollbacks. And later on, before you catch Paul Rudd and Seth Rogen in the Super Bowl, you can see them here as the streaming wars heat up. How are actors and producers bringing their work to the masses and growing in this growing direct-to-consumer entertainment environment? All that and much more during today's show. With 59 minutes left until the market close, you're watching Yahoo Finance Live. Today is Thursday, February 10th, 2022, and I'm Brad Smith.
And I'm Emily McCormick. It's another volatile day on Wall Street after this morning's red-hot inflation report. As we can see, the Dow Jones Industrial Average down by more than 530 points, or about 1.5%. The S&P 500 down by about 1.8%. And the Nasdaq Composite, the laggard during today's session, down 2% as we see Treasury yields spiking across the yield curve. Now, taking a look at the sector action within the S&P 500, materials, energy, and financials are outperforming today, although all 11 major sectors are in negative territory during this afternoon. And then on the flip side, we have real estate, utilities, and information technology, the laggards. But for a deeper dive into today's trading action, let's head over to Yahoo Finance's Jared Blickery, standing by on the touch screen. Jared.
Well, not the greatest news here. We are at session lows. Let me just show you the Nasdaq, which is the worst off right now, down 2%. You can see it started off the day kind of rough, got into the green, if ever so briefly. So did some of the other majors. And now we are pushing towards session lows. Let me just show you what has happened today. I'm going to show the futures in the S&P 500 futures contract. And this was the initial downdraft that we saw on that CPI print that came in at that 40-year high, 7.5%. Take out food and energy, still 6%. Incredible. The market bounced back, but then James Bullard came out and said he would see 100 basis points increase by July. That's a full percentage point, and that's only three meetings away. We now have Fed Fund futures pricing in a 50 basis point hike in March with near 100% odds. So let me get to the 10-year, and we can see it's up about 14 basis points. That is simply a huge move for the 10-year. Also looking at the 5-year, which is up more, 14 basis points, and the 30-year up, the lowest of them all, 7 basis points. So all in all, yields are heading higher, but they are heading higher at the short end, which means we need to watch out for that yield curve inversion, but that's not going to be until later in the year, if it happens this year. Materials, the big outperformer here. It was in the green earlier, along with energy and financials, so the value and commodities trade was doing well earlier today, but everything is in the red now. Worst performing sector is real estate. That is very interest rate sensitive, so not surprised to see that. Tech is in the second place here, down 2.5%, followed by utilities, another interest rate sensitive sector. Want to take a look at the banks. Those were outperformers early on. You can see we still got some green here. Wells Fargo, HSBC, and some others just barely holding on to green, but these had been largely in the green earlier in the day. Also want to take a look at our futures board here. And we can see we saw some more green earlier today. Lumber up another 4%. We have seen crude oil marching higher, although it has been about sideways for the last few days. And we're also taking a look at crypto. Want to take a look at Bitcoin, not doing a lot over the last couple days, did have a nice weekend. And let's see over the last 10 days, we are still at about $44,500 and still in a minor uptrend here. So not a lot of developments on the crypto news here, but it's really been about the yield curve. So not seeing it spill over into crypto just yet, guys.
Jared, want to stick with you for a hot second. We've been keeping close tabs on ticker symbol AFRM as Of course, we've heard of butt dialing in the past, but butt tweeting out your earnings, perhaps? This is what took place here today for the company.
Yes, I'm going to have to get the details of that in a second, as I've been standing here since they came out. But I will say the CFO accidentally tweeted out those earnings just minutes ago, immediately deleted that tweet. You can imagine that was supposed to be scheduled for some time later today. We'll have to see how that stock is trading. I will have those results in a couple minutes, guys.
All right, Yahoo Finance's Jared Blickery, thank you so much for that breakdown. We will keep close tabs on Affirm shares following that earnings report. Well, we want to stick with the topic of the markets now with our next guest of the hour. Marta Norton is Morningstar Investment Management Chief Investment Officer of the Americas. Marta, thank you so much for joining us this afternoon. I want to get first your reaction to this morning's CPI print, getting that fresh 40-year high rate of inflation. What do you think this really signals here for the Fed and what we should be expecting out of that March meeting?
Emily, it's great to be here. You know, I think this number is a trend continuing what we saw starting in 2021 and then moving forward into 2022. I think a lot of folks are expecting inflation to show signs of cooling, if not now, in the coming months, as some of the concerns around supply chains get straightened out, and that being one of the major sources, that and also pandemic driven demand for some of those areas like used cars. So that's the expectation that's built into the markets. But, you know, like other investors at Morningstar Investment Management, we're always going to be preparing for what isn't built into the markets. And so one thing that we're thinking about, of course, is what happens if inflation continues at kind of higher rates than people are expecting, and how do you position for that? So obviously, it's not a single variable world. It's a multivariable world. You have to think about a lot of things rather than just inflation, but that's certainly something that's on our minds right now.
What would you look for in the data, particularly to show or to say that consumers are no longer comfortable with prices at these levels?
Yeah, so Brad, I think that's a good question. So I think it's fair to say that I don't think any consumer likes to see any sort of inflation increase. So I think some of the numbers that I saw bandied about today was this idea that individuals are paying maybe $250 a month more than they did before, and nobody likes paying higher prices. So certainly that's the case already. But I think what we would begin to look for is if there's some sort of reduction in demand, if people are beginning to respond to price increases and some of those discretionary purchases that they don't need to buy, or things that they start putting on hold because they just don't want to pay at the higher price points. But one other element of inflation that can be especially, I guess, you know, self-reinforcing is this idea that if people expect inflation to be higher than it is today, then maybe they won't defer those purchases because they just think at some point they're going to have to pay for them, and they don't want to pay for them at even higher prices than today. So it's a bit of kind of searching around to understand how consumers are going to react to this, but, you know, kind of watching how consumers behave from a demand perspective is one way to get a gauge on that.
And in terms of the market response that we're seeing to this morning's CPI report, is the volatility we're seeing coming right now because of the fact that the Fed is going to be tightening, or because of the uncertainty about how quickly and what exactly the Fed is going to be doing at each meeting in order to address this inflation?
Yeah, so as I was listening to Jared walk through those numbers in terms of the day's performance, I mean, if you can clearly see both an inflation and interest rate story playing out there. So just for example, with technology stocks selling off, one of the concerns about an area like technology that has really high valuations is that investors expect those interest rates to make the companies a little bit less attractive. So there's clearly an inflation or rate story that you can pull from today's price movements. I think generally speaking, what we're seeing is a market that has been priced to perfection, especially those market darlings like the big tech stocks. And so any sort of surprise is going to rattle investors. Now, whether investors are reacting to an eventual just steady increase in inflation, or in interest rates, or whether they're reacting to the idea that there's going to be aggressive movement, I think some of the volatility is a sign that they're not quite sure what to expect. But certainly what we're seeing in some of the comments about 100 basis points move and in pretty short order, that's certainly something that investors are trying to digest today and in the days to come.
And so what would you be advising in a market like this, with the volatility in play, with the uncertainty about the size or the pace of some of the impending rate hikes and tightening?
Yeah, it's a good question. And I'm going to come back to that comment I made earlier that we are in a multivariable world, not a single variable world. And I think, certainly all of us have kind of a linear way that we think. We think, one variable, inflation, and the impact that that's going to have on portfolios. But obviously, there's a myriad of things that are interacting. There's inflation and interest rates and high valuations and the potential for something surprising, a COVID resurgence that we can't predict. And so as investors, we're kind of thinking through all of those different scenarios and thinking about how to position portfolios. And how we're handling that is we're thinking probabilistically. How likely is there to be an inflation surprise? How likely is there to be some sort of pullback based on valuations? And so as we position in the market, we're certainly thinking about those assets that are protective of inflation. We're thinking of maybe lowering our duration profile. We're thinking about some of the areas that we've liked for quite some time, like energy, remaining somewhat attractive within the portfolios. But we're also thinking, what happens if there is disappointment on the economic growth standpoint? In that case, long-term treasuries do have some merit. So even if you're concerned about inflation and interest rates, there still is a case to be made for some of these asset classes if, the expectations that you have today are a little bit different from what actually plays out.
What's your expectations for the stock market broadly in terms of how resilient it's going to be, whether it can continue to climb even in the face of this elevated inflation we're seeing right now, and if the Fed does embark on this aggressive interest rate hiking and quantitative tightening path?
I think near term, I'm aligned with what I'm hearing from a lot of other people in the sense that we're expecting continued volatility. And one of the reasons I say that relates to where valuations were and the longer term trend of the market. I mean, it's just been a tremendous time to be an investor, really from the global financial crisis on. Yes, certainly we've had periods of disappointment, periods of volatility, but by and large, people have made money hand over fist. And so leaving 2021, you could argue that we were really priced for perfection. And so any disappointment, any concern about the economy, I think that can really lead to short-term volatility. So that's one of the expectations that we have. Longer term, just given where valuations were, lots of areas of the market just weren't that attractive to us. So whether we're looking at fixed income or whether we're looking at equities, we didn't see great long-term returns coming out of those different areas. And so what we're trying to weigh is, okay, maybe equities broadly speaking aren't attractive, but what areas are a little bit more attractive than others? And so that's led us to energy. It's led us to financials. It's led us to value leaning areas more broadly, small caps on a marginal basis. And that's how we've positioned. Now, whether that means year over year, we're going to see positive returns, my guess is no better than anyone else's, but that's how we think in the long run, we're better positioned to drive returns for investors.
Marta Norton, who is the Morningstar Investment Management Chief Investment Officer of the Americas. Great to have you here with us today, and thanks so much for the analysis and breakdown on what has been a very volatile session for certain. Marta, appreciate the time. And everyone, we want to turn back to Affirm shares as we've been tracking those here with just about 48-ish minutes left in the trading session. This was an earnings report that was supposed to come after the bell, but we had a error go out via Twitter, at least, and it went out before the bell. And so let's bring in Jared for that. We're taking a look at shares down 21% in reaction. Jared?
That's right. In trading, they call that a fat finger. So let's go over the results. And you can see the stock down 20%, had been down as much as 33%. Loss per share for the quarter came in at 57 cents. And I'm not sure about the comparison here. It's not immediately clear, but the what I have in Bloomberg is 30 cents. So it could be a lot wider than expected. Revenue came in at $361 million. That is up 77% year over year, but it is greater than the Wall Street estimate of $332.5 million. They had a net loss of $159.7 million, and their gross merchandise volume was $4.5 billion. But the weakness, I think, is coming from their third quarter forecast. They're only seeing revenue of $325 to $335 million. Estimate was for $334.8 million, so they didn't quite catch the median point there or the middle point there. They see gross merchandise volume of $3.61 billion to $3.71 billion. And I have a couple more stats here. They see full year gross merchandise volume, 14.5 billion to 14.78 billion. What I was telling you before was for the quarter. They're also seeing full year revenue coming in at 1.29 billion to 1.31 billion, and the estimate was for 1.29 billion. Second quarter loss of $159.7 million includes an increase in stock-based compensation following their IPO and $34 million in additional expenses recognized based on the change in fair value. And let's just take a look at the chart here. This is a pretty ugly intraday chart that we're seeing. This was the fat finger event that you see here. Let's go to a max chart because we are already testing all-time lows here that we had in May of last year, and looks like we dipped down to that level right here. So going to be an interesting call later. I'm sure they're going to get some explanation or give some explanation on why they had to release early. But of course, investors just focusing on the numbers. This had been a high growth stock, and when you disappoint in this earnings season, in this environment, you're going to see your shares get knocked. That's what happened today.
Yeah, certainly is. All right, Jared, thanks so much for the breakdown there on shares. We'll continue to track those for a firm going into the closing bell as well, and ahead of the earnings call set to still happen after the bell. Coming up, everyone, Washington and Nevada are the newest U.S. states looking to lift mask mandates as COVID cases spurred by Delta and Omicron variants. They are on the decline here. We're going to give you the latest on where state policies are changing and how soon. Next.
Welcome back. A growing list of U.S. states are easing mask mandates and other social distancing restrictions as COVID-19 cases move lower following the surge of Omicron. Yahoo Finance's own Anjali Kamlani joins us now with the latest developments. Anjali, what is the state-by-state situation looking like right now in terms of easing back some of these mandates?
Dropping their mask mandates effective immediately. And then we have Washington State joining along with California next week. So really putting that East Coast, West Coast sort of wall up. We knew that the Northeast corridor, largely speaking, Mid-Atlantic Northeast corridor is starting to drop those this week, including New York, New Jersey, of course, Connecticut, Pennsylvania, and the rest. And this is all coming at a time, of course, as we see those cases drop, hospitalizations drop, and even now, deaths coming down by just a little bit. Still some concerning numbers there with 2,500 deaths on average per day. So still seeing the impact of Omicron, but largely speaking, looking to a better outlook here right now. There are some areas of the country where either mask mandates are still in place. We know that about a fifth of the country never really had any of these mandates in place. Some cities sort of taking it on their own. Twin Cities, for example, Minneapolis, St. Paul area, dropping the vax or test mandate, but still keeping the masking in place, especially in indoor areas. And that, by the way, is sort of true for California as well. Sort of mixed rules there, where the mask mandate is being dropped for vaccinated individuals, and unvaccinated individuals will still need to in indoor spaces or congregate areas. So it really is a mixed bag approach once again in how we're seeing all of this pan out across the country.
Anjali Kamlani, thank you so much for that breakdown. Our next guest joins us for more on the virus. Dr. Matisse Lachwayo Davis is Director of Health for the City of St. Louis. Doctor, thank you so much for coming on this afternoon. In the City of St. Louis, a battle in court is currently playing out over the legality of mask mandates. How have lawsuits like the one that just returned to courts this week in the city, with some pushing back against these mask mandates, been impacting the effectiveness of efforts to tamp down on COVID-19 cases?
So we're in an interesting position here. The legal case that you refer to is in the county, which is directly next to the city where I'm the director. And what's made this very challenging is that within the city where I'm the director, we have a different legislative process that allows us to enforce mask mandates through our charter and our Board of Aldermen process. Right next to us in the county, they do not have the same setup. And so they are under different pressures to be able to do the job of public health. The reason why it impacts us all is that we're not an island, right? What happens literally right next door impacts us all. And so our ability to be able to really respond to the pandemic when such measures have been taken has been really, really challenging. I honestly, as an infectious diseases physician and public health expert, it's been astounding to see public health under assault in this way.
And we've been taking a look here on screen for our viewers at some of the most recent numbers coming out of Missouri, particularly when you think about the voice that the healthcare community and professionals also have at a time like this, when states are reconsidering, states such as Missouri, reconsidering exactly where mask mandates and precautionary measures need to remain in place. Where have you been able to guide that dialogue, guide that discussion, and provide advisement along the way?
So it's been very important for me to meet with other directors of health in health departments within the region. I've also been meeting with leaders in the hospitals because, like you say, there isn't any one metric that you make this decision. You have to look at COVID-19 cases, hospitalizations, and deaths all in concert. And I think what people sometimes lose the perspective of is we are just coming out of the largest COVID surge in the history of the pandemic here in the United States. And when you're coming up, right, people think that's the only time we're in trouble, and that couldn't be further from the truth. As you're coming down a curve, you're getting as many cases, hospitalizations, and deaths as you were on the way up, right? Yes, it's reassuring you're coming down, but you cannot stop mitigation strategies right at the beginning of that downward surge or even halfway. Here in the city, our case positivity rate, for example, at its peak was 36%, now down to 19%. Great numbers, but 19% still way off from where we need to be at that WHO recommended 5%. So what my recommendations are to continue with a multi-layered approach to mitigation strategies until you are down all the way to where we need to be, and there stably for at least 2 to 4 weeks.
And at the same time that we're seeing certain mandates in the U.S. getting lifted, travel advisories have been growing. The CDC now has more than half of the world's destinations listed within the highest risk category for travel. How are you thinking about when it might be safe for individuals to travel internationally, given the phase that we're at right now in the pandemic?
You know, this is what's been so challenging for the public is for them, it has to feel like, and I completely agree, that there are conflicting guidance. And so what we need to see is a federal response, a standardized response that doesn't give way to these differences across states. And certainly this is seen here where you have one sort of recommendation around travel and mitigation strategies in conflict in other places. So let's start with this. Number one, unfortunately, the size of this country means that we have seen that the epidemiologic curve is different in different regions. On the coast, I would say New York, for example, is about 2 weeks ahead of where we are right now in Missouri. So for folks who pick up a national newspaper and say, well, New York's, able to come down and ease restrictions, why can't we? Is because the data is not the same, right? Having said that, international travel, we have had very clear guidance, at least within the public health community, about how this should be handled. In my mind, we should require vaccination and boosting as well as masking for all international travel. I do not believe, though, it is realistic to assume that we can shut down or otherwise restrict travel.
Doctor, we appreciate your time and insight this afternoon. Dr. Matish Lachwayo Davis is Director of Health for the City of St. Louis. Coming up, Brompton's president of North America joins us for an update on the outlook for the biking industry. Stick with us.
Welcome back to Yahoo Finance Live, everyone. As commuters and delivery gig workers tap into cleaner methods of mobility, bikes have long stood in the gap. But after the pandemic, heightened demand for personal bikes, shortages ensued for an industry that isn't insulated from the supply chain issues that others are facing. Joining us now is Juliet Scott Croxford, who is the Brompton President of North America. Julia, great to have you here with us today. We got to know, how is Brompton actively managing the bike demand from customers even now?
Thanks, Brad. It's great to be here. And it's been an incredible couple of years for the industry as a whole, but also for Brompton. We were seeing double-digit growth prior to the pandemic. And we've seen that trend continue. Obviously not, we've been affected like a lot of other people with our supply chain issues, but the growth of the bike industry and the brand, as people want to move around cities more freely and had less inclination to go on public transport, has obviously, we've seen a huge demand and surge in growth. and obviously with that launched some new products as a result as well.
Juliet, this is Emily here. Thank you again for joining us. I'm wondering, in terms of supply chain and some of the issues and disruptions that have been facing your company as well as others within transportation, where have most of the concerns been coming from? Has it been coming from certain materials, certain issues with production? And how have you been seeing these trends either easing or staying the same or improving in recent weeks and months?
Yeah, thanks, Emily. I mean, over the past 2 years, the supply chain has retrenched further and further back. And now, the problem became you simply couldn't get hold of aluminum, you couldn't get hold of steel, you couldn't get hold of raw materials, supplier lead times in some instances shot out to 2 years, with obviously supplier rising prices due to their own challenges and requiring earlier and larger commitments up front. Then inbound logistics and lead time has grown with greater uncertainty. And then obviously with that, outbound logistics has faced equal challenges, amplified considerably by Europe and post-Brexit. However, we've really sort of tried to navigate this. We are in a sort of more fortunate position that we do a lot of due to the amount we do in-house and due to the uniqueness of our product and closer relations from those we buy from, we're not a straight up commodity buyer, which has helped hugely. And demand for Brompton bikes has grown enormously across cities across the world whilst we've been navigating this. So whilst we've seen actually things improve slightly, we're definitely not sort of out of the challenges quite yet.
The consumer is very aware of inventory constraints, but also pricing. Is there any part of the business that you've been able to kind of look across and say, well, this is where we don't need to pass prices on to consumers, or is it the alternative of that where you have needed to kind of funnel that down to who is buying the bike at the end of the day, and what kind of increase in the actual product is the consumer seeing at the end of the day too, with that price increase too?
Yeah, I mean, fortunately, we've managed to protect our consumers from this. They obviously were constrained by supply, but that is definitely improved in the last few months. We have increased prices by a small amount, but actually we've managed to control costs and maintain pricing, giving us an advantage over our competitors. And we've managed to hold only a sort of minus 7% price rise on standard bikes and nothing on our electric bikes. So there's definitely an opportunity for consumers, and we've also got some great new products that have come in and are available now as well.
Well, and speaking of your electric bikes, I'm wondering, how have sales and demand looked like and been different for your electric bikes versus your standard bikes at Brompton?
Yeah, electric, we've seen a huge surge in popularity for electric. It is definitely reaching a new consumer that Brompton hasn't reached before, particularly for those consumers that are thinking about their first or last mile, or people that perhaps hadn't cycled before to get to meetings or to get to social events. The great thing about electric is you don't necessarily break a sweat like you do on a standard bike, but you still feel happier, and I think it's still better for your well-being and for your mental health by traveling in that way. So electric is a huge part of our plan for future growth, and we're excited by the product, and I think the industry as a whole is going electric.
I don't think I've ever biked more than over the past 2 years, Juliet, so can certainly attest to that. It's great to have you on and discuss the state of micromobility, especially in the form of bikes, here with us today. Juliet Scott Croxford, who is the Brompton President of North America. Appreciate the time once again. And everyone, coming up, we're going to be sticking with the theme of mobility solutions broadly, but we're going to shift our attention to the infrastructure prerequisites for an electric vehicle future, plus how automotive production and delivery is being delayed by some of the protests taking place by truckers. Stay tuned.
Welcome back. Let's get a quick check of the markets as stocks trade near their lows of the day. Selling pressure is continuing to mount after this morning's CPI report showed the fastest rise in inflation in 40 years. Now, taking a look across the three major stock indices, the Dow Jones Industrial Average down by more than 578 points now, or about 1.6%. The S&P 500 down nearly 2%, and the Nasdaq Composite down about 2.3%. Now, taking a look at the sector action within the S&P 500, we have information technology, real estate, and utilities, the biggest laggards during today's session, although all 11 major sectors are trading in the red this afternoon. Then shifting gears to the Dow Jones Industrial Average, the biggest laggards in that index are Amgen, Microsoft, and Home Depot. All three of those stocks down by at least 2.7% during this afternoon session and final 24 minutes of the trading day. But shifting gears now, we're continuing to monitor the ongoing disruptions taking place in Ottawa as demonstrators protesting coronavirus mandates continue to block a crucial U.S.-Canada trade artery. The impact of this to the U.S. auto industry has mounted further, and Yahoo Finance's Rochelle Akufo is here with the details. Rochelle.
That's right, Emily. On Thursday, General Motors joined a growing list of car makers impacted by this closure of the Ambassador Bridge along the U.S.-Canada border by these protesting truckers. You have Ford, Chrysler, Stellantis North America, and Toyota already facing issues ranging from part shortages to some halted production as a result of this gridlock that started about 2 weeks ago. Now, the Ambassador Bridge runs along the border with Windsor, Ontario, and Detroit, a key supply route for Detroit's car makers as well as their agricultural products. Now, more than 2/3 of the $511 billion in goods traded annually between Canada and the U.S. comes via road. So there's a lot at stake in getting this resolved quickly. And we'll also have to see how much of the lost revenue from these disruptions ends up getting passed on to consumers in terms of a higher cost of cars. Now, if you'll remember, this so-called Freedom Convoy of truckers began by protesting vaccine mandates, testing, and some of these quarantine requirements for truckers that were entering Canada. But then the protests expanded to other cities and more broadly into COVID restrictions, things like mask mandates and lockdowns. Now, all this is adding pressure to an already stressed supply chain that's been disrupted by COVID. And of course, you have these semiconductor chips, as a lot of automakers waiting for those for their new cars. So that's where things stand at the moment.
And so, Rochelle, do we have a sense of when this situation that is impacting the production ability for auto manufacturers, as you laid out, is going to de-escalate at the end of the day?
At this point, still very hard to tell. We know that police in Ottawa are saying they're going to take stricter action on protesters, but that pandemic weariness that we've seen from truckers is now starting to spread to other countries. We've seen, according to Reuters, similar copycat protests popping up in Australia, New Zealand, and France, especially. Now, we know that the U.S. Department of Homeland Security is also warning that copycat protests might pop up in the U.S. as early as this weekend in California, possibly disrupting the Super Bowl. Brad?
All right, I'll take it from here. Yahoo Finance's own Rochelle Akufo, thank you so much for that report. The Biden administration has unveiled a new 5-year plan to make $5 billion available to states to build out an electric vehicle charging network. Yahoo Finance's auto reporter Pras Subramanian is here now with the breakdown. And Pras, what specifically is included in this plan, and how would electric vehicle companies potentially be affected by this?
So, Emily, it's mostly for the states and local governments to actually spend money to build out public EV infrastructure. It's part of a $7.5 billion plan, $5 billion of which is available right now to states to build out a network of EV charging stations along the interstate highway system that covers 49 states and DC. Now, to access those funds, the state must submit an EV charger deployment plan by August 1st to the federal government, and the plans will be approved by September 30th. Plans filed earlier will be approved on a rolling basis, and note the government will pay 80% of the projects under the plan. Also, funding must be consistent with the White House's environmental justice guidelines that call for 40% of all benefits to flow to disadvantaged communities. But this doesn't really solve everything, right? Because it takes time to build out all these chargers, and the majority of which will be these slower level 2 chargers, which can only do about 25 miles of charge per hour. And that's because level 2 chargers cost a lot less. They're a few thousand dollars to make, whereas DC fast chargers that you might have seen here and there across different communities can be 50 to 100 times more expensive. So the big picture is most EV buyers will likely be getting most of their charging done at home. But officials hope that this funding will act as a catalyst to encourage more build out that's going to be needed. Research firm Alix Partners says that $50 billion additional will be needed in the US alone just to build out a full EV infrastructure charging situation there. And compare that to the fact that, guys, that we have 41,000 public charging stations right now in the US versus more than 136,000 gas stations in the US, guys.
Wow. Okay, so those are astounding numbers to figure out exactly how we are going to get the EV charging up to speed, Frost. But we do know that Tesla has been building out its supercharger network for years now, and they're going to continue to move that forward. And so how have they gone about kind of taking this on by themselves this far and even into the future?
You know, Brad, about 10 years ago when the Model S came out after the Roadster, Tesla knew that they needed to build out their own EV infrastructure because the US government and other state municipalities couldn't do it. It was going to cost them too much money. They didn't see the value in it. So they did it alone. They went out and they built out their supercharger high charging network. We're talking about almost 40,000 of these chargers across the country. And obviously now they're global too, building out in places like Europe and South America too. So Tesla sort of is showing how manufacturers can do it alone. But I fail to see how the GMs of the world and Fords of the world want to implement that kind of plan, given the amount of money it would take to do that when the federal government might actually do it for them. So I think that's sort of where Tesla, they did it on their own, but it also gave them a huge first mover and natural advantage versus the other EV companies because you have this massive network to rely on when you're outside the home.
All right, Yahoo Finance's own Prost Supermanian. Thank you so much again for that breakdown. Trading across markets has been volatile lately, but one area that's been especially rocky has been the cannabis trade as the overhang of regulatory concerns continues to weigh on the industry. We'll discuss what's next for weed stocks on the other side of this break.
Welcome back, everyone. Cannabis ETFs are trying to hold on to green territory today while the space overall has seen a move lower to start 2022. Dan Aarons, portfolio manager of the Advisor Shares Pure U.S. Cannabis ETF and the Advisor Shares Pure Cannabis ETF, joins us now. Good to have you here with us today. And Dan, the upside here is still deeply connected to the federal reforms. So what advances has the industry made in the interim?
Well, in the interim, especially on the U.S. side of the border, companies continue to grow, operate, really knocking it out of the park, if I can say, on a fundamental value. Sales are up. state by state, we see new approvals, whether it's for medical marijuana or for adult use cannabis. It's now legal in some form in 40 states. But as you say, I hate talking about politics, and I hate waiting on politicians to follow through on the campaign promises they made well over a year ago. But companies in the U.S. are performing very well on their own. Go ahead, sorry.
So no. That's great context, and particularly in this interim period, if they are performing so well, why do you believe that isn't showing up in the shareholder value right now?
Well, I can say I have never seen an industry or a sector with such a big disconnect between company performance with revenue growth and other fundamental metrics versus the stock price. So there's a big misunderstanding between cannabis on the Canadian side of the border and the US side of the border. These Canadian companies that had a lot of excitement when they legalized in Canada at the beginning of 2019, these companies get to list on Nasdaq or even the New York Stock Exchange. And they're big names that people are familiar with, like Canopy and Tilray. But sales are declining in Canada. It's not that big of a market compared to the United States. In the United States, we have these multi-state operators that until the feds fix it, like they've promised to fix it, these companies can't list on the major exchanges. They list on secondary exchanges in Canada and then trade OTC in the US. They can't get access to federal banking. They have limited institutional investment. They have a big uphill battle banking-wise and investing-wise. But fundamentally, these companies are multi-billion-dollar companies with fantastic revenue growth, but they're held back by these disadvantages that we're waiting to get fixed federally.
When thinking about the long-term opportunity here, what companies, broadly speaking, are the better bet here when thinking about cultivators versus distributors or retailers and other sellers, or are vertically integrated companies really the primary place to be looking?
Yeah, I'm glad you said that term, vertically integrated, because that's really the way things work in the cannabis space. We're talking about companies that grow their product, package their product, and in many cases sell the product in their own dispensaries. Now, there has been a lot of advancement. There's a lot of deals. There's wholesaling, and there's partnerships where people are selling cross products. But that's what we get, vertically integrated and on a state-by-state basis. Even with a lot of the federal reforms that have been proposed, they've talked about the ability to keep it to states' rights, individual states that want to approve whether it's medical or adult use. So we have a nice situation in U.S. operators. And what I mean there is I like all 4 or 5 or 6 or 7 of the biggest top operators in the United States. I'm talking about companies like Trulieve. I'm talking about companies like Green Thumb Industries, Curaleaf, Verano, Cresco Labs. I could go on, but those are really the 5 largest MSOs or multi-state operators in the United States.
As the midterm elections, and of course coming forth in 2022, are anticipated to really kind of rebalance or extremely shift at least the framework in Washington, D.C. for where you would even see some type of reform in the cannabis space. Is this the critical year or this the critical kind of run up or lead up time where if any type of movement does not happen in these next few months prior to the midterm elections, and we know that there typically is a ton of logjam or just people sitting on their hands in Washington, D.C. leading up to a midterm election, are these the critical months where if something does not happen, then we're looking at years down the line from now?
No, I don't see it like that at all. I do like the midterm elections coming up to put pressure on the politicians once again to act on promises they've already made. This is another chance for them to get in front of the cameras and say that they're coming through with their campaign promises. And a big part of that is talking about social justice. We're talking about a lot of people sitting in jails for marijuana possession, and about 70% of the US population wants to change that. They want to decriminalize, and social justice is an important piece here. Now, we have a great deal of momentum. I don't see the midterms as a make it or break it deal or time frame. We're seeing a lot of positive momentum from both sides of the aisle now. The ball was in the Democrats' court to get this done. They haven't got it done yet. We're seeing a lot of Republican support now for changing the way things are done when it comes to marijuana.
All right, we're going to be watching that milestone event for sure. We know you will be as well, especially with regard to the impact in the cannabis industry. Dan Aarons, who is the portfolio manager of the Advisor Shares Pure U.S. Cannabis ETF and the Advisor Shares Pure Cannabis ETF. Thanks so much for joining us here today, Dan. Appreciate it. Everyone, we want to take a quick check of the markets here as we are continuing to watch markets move lower and acceleratingly so. With just about 9 minutes left in trade, take a look at the Dow. It's down more than 600 points right now, taking a look at declines of about 1.7%, a little over 1.6%. We'll round that off to 92 points lower for the S&P 500, 2% in the red there. And the Nasdaq, that is down by more than 2.3%, 340-ish points in the red. As we continue to track these major averages, we are hitting these fresh lows intraday here, and so we'll continue to see and aggregate exactly what this means in the throes and the context of the broader week as well as we get closer to the closing bell. We've got much more analysis on the declines that we're seeing in the session lows on the other side of this short break.
We're counting down to the end of the trading day as stocks accelerate to the downside heading into the close. Jared Blickery is here to break down the selling action. Jared?
That's right. Looking at the S&P 500 intraday, you can see just hit those session lows a couple minutes ago, hovering around there right now. And you can see since about the 10 a.m. hour, it's been from the upper left to the lower right, kind of the opposite of what you want to see. Just want to take a slightly longer term view on the candlesticks, just noting that we sold off from the 4,600 level 2 times here, and we're still in this no man's land, as I've been calling it. Now, we break through this, probably going to head down and test these lows, and I don't think they're going to hold. But for now, still in that medium space. So here's the sector action. Everything in the red still to the downside. Real estate really taking it on the chin, down 2.8%. Tech not far behind. And then utilities, those are the underperformers. And let's just take a look at some of the heat maps here, because growth stocks really taking it on the chin today after that high inflation print that we got earlier today. Apple up 2%. So is Microsoft and Alphabet and Tesla. And if I said up, I meant down, topsy-turvy there. Nvidia's down 3%, and we're starting to see a lot more dark red pop up on this board. So hopefully we're not entering another risk-off scenario as markets contemplate 50 basis points in March.
All right, Yahoo Finance's Jared Blickery, thank you for that, and we'll check back in with you in a bit. We have the closing bell coming up next and more on today's market sell-off. Stick with us. Welcome back to Yahoo Finance Live. I'm Emily McCormick here with Brad Smith, and this afternoon we're joined by our market panel to break down more of today's trading action. Tracy McMillian is Wells Fargo Investment Institute Head of Global Asset Allocation, and David Spica is Guidestone Capital Management President. But before we turn it over to you both, want to take a quick check on the markets here as we see stocks still selling off heading into the closing bell. As we can see, the Dow Jones Industrial Average down by nearly 500 points, or about 1.4%. It is off the lows of today's trading day, but just barely. The S&P 500 also down by about 1.8%, and the Nasdaq Composite down by about 2%. Now, taking a look at the sector action in the S&P 500, we have the real estate, information technology, and utility sectors leading to the downside in the S&P 500. All 11 major sectors still in negative territory during today's session, whereas on the flip side, though, materials, energy, and financials are outperforming, but again, still in the red as we head into this closing bell. Now, taking a look at some of the major components in the Dow Jones Industrial Average, Amgen is the biggest laggard during today's session. That healthcare stock down by about 3.9%, followed by Microsoft and Home Depot, also leading to the downside in that index. And here's the closing bell this Thursday, February 10th.
And there was a live look at the closing bell at the New York Stock Exchange. Markets officially closing here on the day. And as we have been showing you, during these final moments of trading, and especially during this final hour of trading, an accelerated move, but to the downside. The Dow closes off of its session lows, but still ends the day in the red by about 1.5%. 526 points lower on the day for the Dow. The S&P 500 also settles down by about 1.8%, 83 points in the red. And then additionally, the Nasdaq Composite, the tech-heavy average, closed down 304 points, 2.1% in negative territory. I want to bring back in our panel here today to help us break down the markets. We've got Tracy McMillian, who is the Wells Fargo Investment Institute Head of Global Asset Allocation, as well as David Spica, who is the Guidestone Capital Management President. And Tracy, I want to begin with you. Particularly, it seems like the markets really just latched onto the idea that the Fed may, and in an accelerating fashion, have to quell inflation concerns that have been persistent and clearly by the CPI data have run hotter than their expectations. And they might have to do so with a higher basis point rate hike than anticipated even at the outset of the year.
That's right. You know, the Fed's gotten two upside surprises within the last week. That employment number last Friday was an upside surprise. And then the inflation number this morning was an upside surprise. So they've gotten surprises on both of their mandates. And that is probably going to cause market participants to think that they're going to be on a more aggressive path this year. And so that's what we think is causing a lot of the disruption today in the market. The Fed doesn't want to surprise the markets, though. And, you know, credit markets have been really well behaved, and they don't want to do anything that's going to cause a disruption to those markets. So, you know, while calls for a 50 basis point move are probably going to intensify, if the Fed is going to take that path, then we think they're going to start communicating that fairly soon because, again, they don't want a surprise for markets if they do decide to raise by 50 basis points.
David, we still have about a month until the Fed's March meeting. Between now and then, what additional catalysts or events or data releases do you think investors should be really keeping a close eye on to inform that ultimate next move and path forward for the Fed?
I really think the cat's out of the barn. The cat? I mean, the horse is out of the barn. Didn't know cats lived in barns, so I should know that living in Texas. Inflation hasn't been this high since I was in high school, so that really puts it in perspective for me. And it feels like the Fed is really behind the curve. So Bullard, Fed member Bullard, saying 100 basis points by July and QT starting in the second quarter, that's not out of the realm of possibility. I think we're there. The Fed realizes they have to start moving. Powell has said this isn't transitory back in November, finally admitted that. We're running at 7.5% inflation. Consumers are getting killed with this inflation. The Fed has to move and has to move quickly if they want to rein this in.
And as we think about where this sets us up for the near term as well, David, you know, do you expect more volatility to persist? We just had Jared showing us charting a moment ago, this no man's land that we're in right now.
Yeah, absolutely. We've already seen a deeper drawdown this year than we saw all of last year. Volatility is here to stay. If you go back, even back to the end of the financial crisis, monetary policy has been the key factor in driving returns and really providing that Fed put that allowed investors to come in and buy the dip. That's gone. Those days are behind us, and particularly with the inflation we're seeing now. And the market does not like this. It's like a kid that's never been told no, that is now being told no and is throwing a temper tantrum. This will continue. Earnings growth is absolutely the key factor, but even if earnings continue to grow, we're going to see multiple compression. Historically, when inflation has been above 7%, PE multiples for the S&P have been between 10 and 12 times, compared to 20 times today. Now, I don't think we're going to get down to that level, but clearly multiple compression is on the horizon. That's going to create volatility, and that's going to make it a difficult year for equity investors.
Tracy, I want to get your take on what David just mentioned a moment ago with St. Louis Fed President James Bullard saying he now wants to see interest rates up by a full percentage point by July 1st. Do you think that Bullard may be testing the market here in terms of the market response and reaction to this kind of a move? Or is this the most likely path forward now for the first half of the year on interest rates?
Sure. So I don't know so much that he's testing the market here as as giving his opinion. And his opinion certainly is that the Fed should be moving faster here. It's our view that the Fed will remain cautious. We did get a very hot number today for inflation, and it was broad-based, and that is adding to the concern. But we also think that this first quarter is when we'll see inflation peak. And so the Fed is going to be raising rates into an environment where we believe inflation is going to be subsiding. And we think that, that number is going to come down as we see supply chains heal, as consumers shift their spending away from goods, which was the bulk of this high number today. And, they're going to move more towards services as COVID subsides. Now, services were also higher than the Fed's target. But again, first quarter should be the peak. We'll see lingering effects of tight labor, supply-demand imbalances. We think inflation is still going to be up about 5% this year, but cooling. So, the Fed, we believe, is going to raise interest rates probably 25 basis points in March, and then 3 more 25 basis point increases through the year as they watch what's happening and respond to that data.
All right, Tracy McMillian is Wells Fargo Investment Institute Head of Global Asset Allocation, and David Spica is Guidestone Capital Management President. Thank you both again so much for your time and insight. We have some breaking news on the vaccine front from Novavax. Yahoo Finance's own health reporter Anjali Kamlani is back with the breakdown. Anjali, give us the details.
Thanks, Emily. So we heard that Novavax has results from its adolescent trial for ages 12 to 17, saying that the vaccine is proving 82% effective against the virus, mostly looking at Delta. Actually, the trial lasted until just about before Omicron became really prevalent. So they don't have any data on that right now, but they do have pretty strong indications of the vaccine in that group, especially compared to the older age group. No adverse events or severe adverse events really noted there. No known indications of heart inflammation, which we know has been an occurrence with the mRNA vaccines. So they do plan to file for that emergency use authorization in this quarter, following suit, of course, what we've seen with that 18 and older filing just last month. No update from the FDA filing just yet, but they do have it in place. Meanwhile, just some updates about the vaccine itself and its shipments around the world. Have been some reports about delays in Europe. The company says that is a result of local distribution issues, but that is going to be sorted out by the end of the month. Meanwhile, in South Korea, we're seeing that vaccine roll out next week. They do anticipate that there will be some word, hopefully, from the FDA soon, but nothing yet. And as we recall, this is the 4th vaccine from that initial Operation Warp Speed program. So this is still waiting and pending here in the U.S. Back to you.
Yeah, shares higher by they were up 1% in after-hours trading on this efficacy news. Anjali Kamlani, thanks so much for breaking this down for us and raising this to our attention as well here in after-hours trading. We're also in after-hours trading tracking shares of EXPE, Expedia. And for that, we have Jared Blickery standing by with the latest earnings results. Jared.
That's right. We're getting a nice little pop here, 4% up in after-hours trading. And let me get to the numbers here. It's kind of mixed. Now, they had a huge beat on profits. Adjusted EPS coming in at $1.06 versus the estimates of 60 cents. So basically up about 45% for that number. It was $2.64 it was a loss of $2.64 year over year. So coming back from those pandemic woes, revenue $2.28 billion versus $920 million a year ago. The estimate was for about the same, $2.29 billion. And when you break it down, retail revenue coming in a little bit shy of estimates, $1.73 billion. Estimate was for $1.84 billion. And then business to business revenue. Here's where they had that big beat, $481 million. They beat by about 30 million there. And finally, Trivago revenue. That came in at 99 million versus 109.2 million expected, so about 10 million short just there. Here's another number where they fell just a little bit short. Gross bookings, $17.46 $17.46 billion. Hopefully it wasn't that low. It is in the billions. Estimate was for about $2 billion higher, $19.46 billion. Also, room stayed. That was up 74%, but Wall Street was hoping for 97% improvement off of those disastrous numbers last year. Finally, adjusted EBITDA coming in at $479 million versus a loss of $160 million a year ago. The estimate for Wall Street was $390.2 million, so about an $80 million beat right there. Also, I have a note from Peter Kern. He is a vice chairman and CEO. He's saying, while we experienced yet another significant travel disruption from COVID this quarter, we were pleased to see that the impact was less severe and of shorter duration than previous waves. Notably, the travel industry and traveling public, they proved more resilient with each passing wave, and we continue to expect a solid overall recovery in 2022, barring a change in the trajectory of course, the COVID front. I just want to chart this real quick for you. Expedia Group kind of trending sideways for most of the year. This is a trailing year, but hitting record highs today. And you can bet if we keep these gains, it'll be hitting those highs tomorrow as well.
All right, Jared Blickery, I know you're also watching shares of Zillow Group, that company also reporting earnings here in the after hours. Those shares have been bouncing around a bit here in the late session, but how did they do in their latest quarter? Yeah,
Zillow Group up 4% in after hours trading. And let me get to these numbers for the fourth quarter. Revenue coming in at $3.88 billion versus $789 million a year ago. IMT segment revenue, that came in at $483.2 million. The estimate was for just a little bit lower, $481.9 million. Their premier agent revenue, that came in at $353.8 million. Estimate was for a bit higher by about $6 million, $359.4 million. And then home segment, that revenue came in at $3.35 billion. The estimate was for quite a bit lower, $2.31 billion. So that's where those gains were made. The mortgage segment revenue, finally, $50.8 million, and that is what the street was expecting. Do have some commentary here from the Zillow and co-founder, CEO Rich Barton. He's saying, more interestingly, we have major untapped business potential due to our leading audience, brand, partner, network, and R&D leadership. So again, Zillow here up about 4% in after hours trading, and we will chart this one as well. We can see it's been a steady slog down. They had some problems with one of their segments where they're experimenting with turnkey solution for people selling their houses. That didn't quite work out, so trying to regroup here. Over the last 2 years, you can see just kind of coming back to earth after that excitement from the pandemic lows. Guys?
Yahoo Finance's Jared Blickery, thank you for bringing us both of those results. We'll be right back.
Welcome back to Yahoo Finance Live, everyone. Safely, a brand co-founded by Emma Grede and Kris Jenner, touts cleaning products that leave out the harsh chemicals, and they just landed a major deal, a retail deal with Walmart. Safely co-founder Emma Grede joins us now. And Emma, great to have you here with us today. This comes within a year of Safely's launch. Considering the supply chain challenges that we know many businesses have encountered, how have you been able to scale production this quickly to meet the inventory demands a retailer as large as Walmart would require?
Thank you. I'm so happy to be here today on the day that we launch in over 1,700 Walmarts. It's incredible. But you're absolutely right. It hasn't been without its challenges. I mean, for us at Safely, we started this brand in the middle of COVID. And so we've always had challenges. It's something that we've been used to. But in actual fact, Walmart isn't our first big retailer. We're also in over 1,000 doors with Bed Bath & Beyond. And so for us, we've been able to really scale our production. And of course, you don't really start working with Walmart overnight. These are part of longer, more protracted conversations. And so we've been able to steadily amp up to the point where we're able to really meet their needs.
Emma, we've seen for legacy household products companies like Clorox, for instance, which just reported earnings earlier this month, that there has been a lot of pressure hitting these companies after a jump in demand for cleaning products earlier on during the pandemic. I'm wondering, what have you been seeing in terms of demand trends, and has that been something that shifted over the past several weeks or several months?
Well, it's very different in a new company like Safely, right? We have a very, very big mission in this company, and that is to really rid America's homes of harsh toxins. The goal is to provide, accessible and plant-powered home care products to all of Americans. And we really believe in bringing about that positive change. And that's, a slow and an education for a lot of people. The majority of people are using very, very harsh chemical cleaners that are both harmful to them and potentially to the environment. And what we're trying to do is remove all the barriers for somebody switching to harsh chemical cleaners. So I don't really think the trends are, exactly the same in the more traditional cleaning space as they are to people that are making the switch and trying to really work in this new space and work with, plant-based cleaning.
When people think about the products that they're purchasing, whether they be in bulk or whether they be on an individual basis, the pricing at the end of the day is also one of those consideration points. How have you been able to navigate the pricing scenarios that many consumers are having to think even more closely about right now?
Yeah, absolutely. Accessibility is at the core of what we do. And so the idea of providing plant-based products that are affordable, but also really effective. And I think that we have to remember that a lot of people in the past have not been able to see how incredibly effective a plant-based product would be. And we're really giving you, highly, highly concentrated cleaning products that are also affordable and almost retraining people's habits. It was important to us that we could offer product, at a Walmart level, so starting at $6. And it really is about a retraining for people. We're asking people to keep their bottles. They're supposed to be used as refills and switch to more of a refill model. And so all of that is about a retraining of consumer habits, I think.
You have a number of ventures that you've spearheaded, in addition to, of course, co-founding Safely with Kris Jenner. You've also co-founded Good American with Khloe Kardashian and co-founded Skims with Kim Kardashian West. I'm wondering, with that perspective, what do you think makes a celebrity brand successful? Because even the turbocharge in recognition that a brand gets from having a celebrity on board, I'm sure does have its limitations.
Absolutely. I never think about the brands that I run as celebrity brands. I'm a product person, and what we do is solve problems and create best-in-class product. At the end of the day, what you get with incredible business partners like I get is an audience that's built in from the beginning. But you can't sell an audience a bad product twice, no matter who is trying to sell it. And so we're really focused on making best-in-class products, whether that's at Good American or at Skims or indeed Safely. We're taking problems, we're making things better, and we're using the platforms of Kris or Khloe or Kim to really talk about those products. But like I say, customers are not so easily fooled, and it's about product first over and over and over again.
They must have a lot of trust in you, because we know that they're strapped for time on any given day of the week. Working with Kris, Khloe, Kim, do you have a favorite one that you've worked with over the years?
If I did, I certainly wouldn't tell you. No, like anyone, Chris and Kim and Chloe, they're all incredible businesswomen, and I think that they probably got that from their mother. Let's say that for sure. But I have, a relationship that goes back 10 years with Kris Jenner. And so we really have a way of working together that's enabled us to build these businesses. You're talking about really big businesses with both Skims and Good American, and we hope that Safely becomes that way too. But yeah, I mean, a favorite I would never say.
Emma, great to have this discussion with you, and congratulations on the expansion for the brand, as well as all of the other successes that you've seen with Skims and the other brands that have been launched as well. Emma Greed, who is the Safely co-founder, joining us here today. Appreciate the time once again. And everyone, coming up on the other side of this short break, we got to check in to see what Seth Rogen and Paul Rudd, the world's sexiest men, I believe, what they're up to on the other side.
Welcome back. Paul Rudd and Seth Rogen have reunited for a new Lay's chip ad airing at the Super Bowl. Our own Brooke DePalma had a chance to sit down with both of them for more on the ad campaign and to chat the streaming wars, of course. Brooke, what were some of the highlights?
That's right, Emily. Well, Seth actually co-wrote with the Lay's team, along with his longtime partner and friend, Evan Goldberg. And he told me that while creating this commercial, I said, what was the inspiration behind it? And he said, he was just trying to make people laugh this Super Bowl Sunday. Now, of course, the Super Bowl will be on NBC, but it'll also be available on the Peacock app. And with that, later on in the conversation, we had the chance to talk about how streaming services like Hulu, Amazon Prime, and HBO Max, among so many others, have transformed Hollywood.
It's created a lot more content, and as a result, many more jobs. So, that's been great, and not just for actors, but for everybody, working on crews and all of that has been great and challenging to try and figure out how to make all of that work during a pandemic. But I think that they've done an admirable job. At the same time, there's just so much stuff that there are shows and I don't even know what they are. I don't know how to watch them. I don't know. And so it's like all a bit deafening. And so that's, I think that's still being kind of figured out, but it can be a little noisy, I think.
And Seth, how about you?
Yes, I very much agree with all that. And I think from a creative side, It's interesting. I think, when I was starting, these studios and stuff were much smaller and I think less accountable to like corporate giants, you know what I mean? And in some ways there's something that is nice, that is an unexpected kind of bonus about now working for these companies that are held accountable to these corporate giants, is that they just have to release things at a certain time. And even if it costs them way more money to release them at that time, they will do it, which is not how generally a lot of like production worked. Like often a movie studio or TV studio would be like, well, we wanted it to come out in May, but it'll be way too expensive to have it come out in May. And so we'll have it come out, in January instead of spending more money. But these big companies now like are accountable to have material be released in May. And if we're like, it's going to cost way more money to have it released in May, they'll be like, we will pay it. We need it to come out in May. And that actually is like, it's interesting. Like we are plugged into this like wheel that can't stop spinning now at times with these big streamers. And that's not how traditional studios were. They were wheels that could very easily stop spinning at any moment, and would love to remind you of that fact. And now, there's something nice about kind of being on like an unstoppable train at times because
There's also, I think because of the competition and the fact that there are so many shows, and audiences are pretty savvy and they demand something new, and quality is important. It feels like so more so than ever before. So a lot of these, they are on these deadlines. They will spend the money, but their interest in making their shows or their movies or whatever it is they're doing be really good seems to be heightened.
For sure. I'd say over these last few years, we've had more resources and less oversight, like with some of these streaming things we've been doing than the years previous.
Now, of course, right now, Seth Rogen is getting a lot of attention in his new role on Hulu called Pam and Tommy. And Paul Rudd, he recently appeared in the Apple TV Plus limited series called The Shrink Next Door alongside Will Ferrell. But I said, is there more content to come from the both of you? And they said, perhaps we can start teaming up today after the Zoom call. So you never know what could happen with the two of them.
Absolutely something to be keeping an eye on going forward. Yahoo Finance's own Brooke DePalma, thank you so much for bringing us that conversation. Well, that will do it for Brad and me this afternoon. We'll be back at 3 p.m. Eastern tomorrow, but do keep watching Yahoo Finance because in this week's episode of Influencers, our editor-in-chief, Andy Serwer, is joined by former Today host and former CBS Evening News anchor Katie Couric as they discuss the challenges of navigating the modern news business. That's up next.
this episode of Influencers, Katie Couric, former Today Show host and author of Going There.
I think that people who spread it, who are quote unquote super spreaders, should be held liable for spreading this disinformation, whether it's about COVID or vaccines or about Sandy Hook. I think journalism is still a really noble profession. The problem is so much of journalism has seeped into commentary. I hope that I'll be seen as somebody, who did what my father told me my entire life. Do your best. And that's what I've done.
Hello, everyone. I'm Andy Serwer, and welcome to Influencers. And welcome to our guest, Katie Couric, of course, former host of the Today Show at CBS Evening News, co-founder of Katie Couric Media, and author of the book Going There, and my former colleague at Yahoo, which we'll get to, I'm sure. Katie, welcome. Great to see you.
Hi, Andy. Great to be here. Thanks for having me.
Of course. Why don't we start out before we talk about the book? I'm curious to know about Katie Couric Media and what you're up to and what's that all about?
Well, I love sort of being the boss of me, as our kids used to say, Andy. And about 3.5 years ago, my husband and I saw that the media landscape was changing dramatically. I had actually noticed that over the past decade or so. And instead of depending on, people to give me a job, I decided I wanted to be a job creator. I wanted to try my hand at being an entrepreneur, and that I thought the brand that I had established over 30 to 40 years in media was as powerful as some of the bigger brands and would enable me to really personalize the news and view it from my perspective. So we decided to be pan media. We have a newsletter that goes out to well over 500,000 people with a very high engagement rate. We have a podcast. I'm going to be recruiting other talent to contribute, and we already have done that. We have somebody who's our book editor. We have a very vibrant relationship with Bobby Brown, also, who used to be at Yahoo. And so we're really establishing a collective of voices. And in the meantime, I'm also developing documentaries. I have a couple of scripted projects in development. I was an executive producer of a series on Netflix called Unbelievable. And what I realized, Andy, is storytelling has changed dramatically. It's no longer siloed. Disintermediation allows you to go direct to consumer, just as brands are doing. And we now have about 35 people working at the company. And really what I'm trying to do, we also have a shop that has picks of what we think are purpose-driven brands and female-founded, BIPOC-founded, LGBTQ+ founded companies that we're supporting and really shining a light on. So it's been really exciting because it's hard working for a big, lumbering, bureaucratic organization at times. And I find that I can be much more nimble, and I can create content at the drop of a hat, or I can do longer profiles and series and really explore topics I'm interested in that I think are worthy of a listener or reader or viewer's attention.
What do you think about TV news right now, Katie? And, we're seeing the emergence of streaming services like CNN Plus, and what does that mean for the industry? How would you describe it?
Well, I think it's just another way to provide interesting content to consumers. It'll be interesting to see if people are going to pay for those services when there is so much news everywhere. I mean, I'm just inundated with news 24/7, and a lot of it is really high quality. I was just reading a great piece this morning on Joe Manchin in the Rolling Stone that someone brought my attention to. So I think it'll be an interesting experiment to see if people are going to want that content. Will they want to see Chris Wallace doing interviews? I'm not sure. Maybe hardcore Chris Wallace fans will, but it seems to me that there is so much news. It's so ubiquitous now that they're going to have to provide something that is really unique. And I think they're trying to do that with sort of the model of Anthony Bourdain, which, you know, was established on CNN many years ago with Eva Longoria. You know, I just don't know at what point, I guess, is it content overload, Andy? You know, is there just so much to choose from? Will the cream still rise to the top? Probably, but will it be enough to sustain some of these newer business models? I'm not sure.
Right, and then ubiquity is both a blessing and a curse from the consumer standpoint, because there is so much out there, but then how do you choose? And so I'm sure you're asked this question, Katie. People ask me all the time, what do you look at? What do you read? And how do you decide what to look at when there is so much stuff?
Well, you know, I do rely primarily on newsletters and on Apple News. And, you know, I remember when I was at Yahoo with you, Andy, I begged for them to let me start a newsletter that would basically go straight to people's inboxes and help kind of curate the things they needed to know. You know, they weren't interested in that at Yahoo for a variety of reasons, which we can talk about later, and sort of what Yahoo's ultimate business goals were at the time. But, you know, I read a lot of newsletters. I try to read The Economist. I look at Time Magazine. I read the New York Times, the Washington Post. I read various newsletters from reporters from those outlets. I read the Poynter Institute. Tom Jones does a media newsletter. The Pew Research Center does kind of what's going on in media. I'm interested in kind of looking at trends. I read The Information by Jessica Lessin. So I really try to get a good cross section of helpful and useful information. And sometimes I just look at Apple News and see what's trending and if there are articles that I'm interested in. I feel like I really get a good sense of what's going on in the world with the amalgam of sources that I turn to.
We'll be right back with more from Katie Couric, former Today Show host and author of the new book, Going There. Welcome back to Influencers. I'm Andy Serwer, and I'm joined by Katie Couric, former Today Show host. What inning are we in when it comes to a reckoning with women and diversity in the workplace? I mean, is it early days, middle days, 10 times?
I think it's, I think it's early days. But I think maybe early to middle days, Andy. I think this is so important. And I think you can't just wave a magic wand. There's so many factors, I think, contributing to this imbalance of power that have been entrenched in our society for decades, if not centuries. And so one of the things that I hope we can do is have honest conversations about this. I think that's so imperative. And if my book models that, then that's something I'm really pleased about. Because I think what happens is, there's progress and then there's a backlash. There's progress and then there's a backlash. And I think having open and honest conversations and not, canceling people because they say the wrong thing or not rejecting them out of hand because of the way that they see things, and they're products of their own environments, is a really important component to leveling the playing field for everyone.
You write, of course, we talked about Matt Lauer, or I mentioned him, I should say, in the problems, and Les Moonves. Are men in TV and entertainment worse than other businesses, or is it just that they're more high profile?
It's hard for me to answer that question, Andy, because I haven't really been in other businesses. But having said that, I do think they're more high profile. I think there's probably a little more, it's not exactly a low key or low profile industry. So I think probably the ego level of men in television in general and sort of media is probably feeds into or fed into certain behavior for many, many years. So I think that, I think it was just sort of business as usual. It was sort of the status quo for this kind of behavior. I think it was not only tolerated, but in some cases encouraged in television news. And especially as women were entering that industry in significant numbers. I think we forget that, I graduated from college, Andy, in 1979. And this was when women were really entering the workplace in big numbers. And so it was male dominated for quite a while. Women were in positions that were dependent on their male bosses. So that created a dynamic that just, I think, opened up for a lot of abuses. That, and add to that kind of the culture that existed, a bit of Hollywood. We're going to make you a star. I control your fate. You are subservient to me. And I think that provided a recipe for that kind of really unacceptable behavior.
Did any of them come back, or should they be allowed to come back? We're talking about canceling people and people paying the price.
I think a lot of it depends on your response to the allegations. I think people who recognize, I think James Franco did something very interesting that we haven't seen with a lot of these men who had been, and I think that, I don't know, we could have a whole conversation of the word canceled. I think they were removed with cause. I think canceled sometimes suggests that a small, a smaller or infraction or whatever was overly penalized. So I think James Franco talked about getting help, acknowledging his issues, and trying to understand the damage that he did. And I think that other people should probably take a page from that playbook and do some serious introspection, and then try to kind of contribute to, be the change that we hope to see, instead of kind of digging in their heels. But, I think with any kind of social movement, there is bound to be some collateral damage.
Right. Good point about how I use the word cancel, by the way. So,
well, I mean, I think
I appreciate that. No,
yeah,
you're right. You are spot on.
To interpretation,
you were spot on. I want to switch over and get back to some of those tech companies and the platforms a little bit, because they're so powerful, and you're relying on them. We're relying on them. We're one of them in a way. But Facebook, Twitter, how are you thinking about them, Katie? Are they to blame for the widespread proliferation of misinformation? Should they be held responsible? Should they be broken up? I mean, there are 1,000 big questions there, but just your 1,000-foot take.
It's, I wish I were even, you probably are more of an expert on this, Andy, than I am. I was a co-chair of the Aspen Commission on Disinformation, and obviously we took a close look at some of these platforms. I mean, I think the problem with disinformation in our society is very multidimensional, but the algorithms and the way things are shared and amplified certainly, I think, have been fueled by these social media platforms. It's also lack of trust in mainstream media or more traditional media outlets, and also the democratization of information, where everyone who has a digital device or an iPad or a computer can spread misinformation and disinformation and malinformation. And so I think that we really do need to take a close look at the liability of some of these platforms that claim they are not a publisher, that they're just a platform. And Congress should get involved. I think the federal government needs to have a more unified approach, because I don't think there's really a centralized policy arm of the government to deal with this. President Obama says disinformation is the biggest threat to our democracy. Certainly when you look at things like the big lie and the fact that more than 60 courts and judges have said there's no merit to the argument that the election was rigged, that it was one of the fairest elections in our history. But the fact that this persists, that a huge percentage of the public, and particularly the Republican Party, continues to believe that the election was rigged. Obviously, they're getting this information and it's being reinforced over and over again. People gave me a hard time because when I was on Bill Maher, I talked about the need for people to be deprogrammed, which really meant just kind of separating themselves from the information that they're being almost brainwashed to believe through the repeated serving up of disinformation. So I think we need to take a multi-pronged approach, Andy, and get everyone involved. And I think that people who spread it, who are quote unquote super spreaders, should be held liable for spreading this disinformation, whether it's about COVID or vaccines or about Sandy Hook. And I think that platforms need to be more aggressive about monitoring it. Of course, the problem, and it's not a problem, but the sticky wicket in America is free speech. And how do you balance free speech with the need to have outright lies be removed and not see the light of day, where unfortunately an audience is receptive to believing them?
Yeah,
it's a complicated topic, isn't it, Andy?
But it all does go back to, can you yell fire in a crowded theater? I mean, it's also timeless, but now it's just this new way of getting the information that's sort of, it's a super spreader.
Yeah, and I think the Supreme Court said you cannot yell fire in a crowded theater.
You're absolutely right. They did.
And similarly, I think this is the semantic version of yelling fire in a crowded theater. And I think the technology has almost outrun the ethical considerations of all this, but it's a really serious problem. I think it's shaping up to even be more serious in 2024, and so it's something that we need to pay attention to.
We're going to take a quick commercial break. We'll be back with more from former Today Show host Katie Couric. Welcome back to Influencers. I'm Andy Serwer, and I'm back with Katie Couric, former Today Show host and author of the new book, Going There. I was going to ask you if you would let your kids or tell your kids to get into journalism, but I think one of them is. So I'm wondering how you feel about that, or what you would tell young people or young women, maybe in particular, about journalism.
Journalism is so important, and there's some amazing, high quality, excellent journalism that's being done on a daily basis. So I think journalism is still a really noble profession. The problem is so much of journalism has seeped into commentary. And, there's a big argument going on in newsrooms across the country. When should you be an advocate and when should you be a journalist? And is there a way to be both? My daughter is working on a documentary about the origins of the conservative movement and William F. Buckley in particular. And she was an American Studies major at Stanford. She is extremely smart. And I think exploring this is really, really interesting and really important. And so I think that we need to have great people attracted to journalism. We need smart, curious young people, men and women, and people who represent this country demographically. So we're talking about people from all kind of socioeconomic backgrounds, Andy, people from who've had different experiences because of their race, and ethnicity. We need to be kind of this great American quilt. By 2044, white people will be in the minority in this country, and we just need to make sure that our journalists represent the people they're serving. Having said that, I do think we need to look at the model of journalism, and I know a lot of people are thinking about this and talking about it. How can we restore trust in the media? How can we be less polarized and speak to just one audience or the other? I think that's a really challenging question, but I think it's one that deserves a lot of attention and thought. And I think we need a lot of people, young people, smart young people, who can maybe look at it in a different way. And, are we forever going to be siloed and have, our own information? My friend Nicole Seligman talks about affirmation instead of information. I think these are all big, heady, meaty topics, and we need the greatest minds in the country to focus on them. So, I would encourage people, especially idealistic people, to go into journalism.
Great. We're almost out of time, Katie. So quickly, if you can, what do you see as your legacy?
Well, I hope that I contributed to the national conversation and help people understand complicated issues. I hope that, I helped show that women were capable, and that, it's interesting to think about the fact that in 2006, it was such a big deal to have a woman do the evening news. And now we see the evening news is, declining in terms of its influence and importance. They still have a lot of people watching, but much older demographics. And I think very few young people are watching the network evening newscasts. But I hope that I helped, move the ball a little bit forward for women. It wasn't easy. I write extensively about my experience at CBS. And I think, I was met with a lot of resistance there, partially because I think, there are a whole lot of reasons which I detail in the book. But I hope that I moved the ball forward for women, whether it was asking that I had a 50-50 division of labor on the Today Show with Bryant Gumbel, or, took the leap and became the first solo female anchor of an evening newscast. And I also hope that I try to explore important topics and do it honestly, and that I have the vulnerability and humility to say when there were times when I didn't get it right. I don't know any journalists who have batted 1,000 for decades. And I think that, I'm proud of myself that I had the courage to say, maybe I could have done something differently, or why did I approach a topic this way? Or here were some of the factors that were influencing me when I was making decisions. Because when all is said and done, journalists are human beings. They're not perfect. They try, I think, to do the best job they can, mostly. And so I hope that I'll be seen as somebody, who did what my father told me my entire life: do your best. And that's what I've done. And sometimes, it's been great, and sometimes I've fallen on my face. But to me, that's kind of a life well lived. And the ability to admit that is, I think, takes a lot of guts.
Katie Couric, thank you so much for your time.
Thanks, Andy.
You've been watching Influencers. I'm Andy Serwer. I'll see you next time.